Please like, share, and subscribe. Wishing you happiness and good luck every day.
When you hear the words day trading, you probably picture a world of high-speed, high-stakes finance, right? But what does it really take to get started? Well, in this explainer, we're going to break down the essential playbook for beginners, covering everything from your very first trade to, maybe most importantly, the mindset you'll need to succeed. To build our playbook today, we're diving into the key insights from Alexander Peace's Beginner's Guide to Trading. We've taken all of his comprehensive advice and we've distilled it down into a clear, step-by-step guide for anyone who's curious about the world of day trading. So here's our game plan. We're going to start with the absolute basics. What is day trading? Then we'll get into the tools you'll need, how to pick the right broker for you, how to actually make your first moves in the market, and then we'll tackle the most critical part of all, mastering the mental game. All right, first things first. Before you can even think about playing the game, you gotta understand the arena. So what exactly is day trading? You know, the name really says it all. The whole idea is that you are in and out of a trade within a single day. You're not holding anything overnight. Your goal is to make a profit from these tiny, rapid price movements in assets that are easy to buy and sell. Think of it less like a marathon and more like a series of really, really quick sprints. Okay. This is a really key distinction for beginners. When you trade stocks, you're literally buying a small piece of a company. You own it. But with futures, you're not trading the asset itself. You're trading a contract based on that asset's future price. That's why futures usually require less money to get started and give you way more flexibility, like being able to bet that a price will go down. So, what's the big draw? Why do people jump into this arena? Well, the attractions are pretty clear. The potential for quick profits is, obviously, a huge one. And since you close out all your positions every single day, you don't have to worry about some crazy news story tanking your investment overnight. You're in direct control. And you can even make money when the market's going down through something called short selling. Okay, so you get the concept. But what do you actually need to get started? Let's take a look at your essential starting toolkit. First up, let's talk money. Now, while some platforms might let you start with as little as $1,000, a much more realistic starting point is somewhere between $8,000 to $10,000. And here's why. With less than that, the potential profits often just don't justify the risk you're taking. You've got to think of this as a serious financial commitment, not a casual hobby. Next, your tech. And this is where you realize that day trading is literally a game of seconds. A slow computer or a glitchy internet connection, that can create a tiny delay. But that tiny delay could be the difference between making a profit and taking a loss. Trust me, when it comes to your tech, trying to go cheap can end up being very, very expensive. All right, you've got your capital, you've got your tech. Now you need a partner, your gateway to the market. Let's talk about the absolutely critical role of choosing a broker. So, what is a broker? Well, simply put, they're the middleman. You can't just stroll onto the floor of the New York Stock Exchange and start buying things. A broker provides you with a platform, and they're the ones who actually execute your buy and sell orders. They are your essential connection to the entire financial world. So how do you pick a good one? Here's a quick checklist. First, check the commissions. Every little fee eats away at your profits. Second, execution speed. Just like your computer, it has to be lightning fast. Third, what happens if things go wrong? Good customer support is your lifeline. And finally, and this is probably the most important, make sure they are regulated. That's what protects you and your money. Okay, you're all set up with a broker. Now it's time to learn the basic commands. This is where we cut through all the jargon and get into the actual mechanics of how to make a trade. These are the two most fundamental orders you're ever going to use. A market order is all about speed. It basically screams, get me in or out of this trade right now at whatever the current price is. A limit order, on the other hand, is all about control. It says, I will only buy or sell at this specific price or better. So the choice is simple. What do you need more, speed or control over your price? All right, let's do a quick lingo blitz on a few other key terms. First, the spread. That's just the tiny price difference between what a seller is asking for something and what a buyer is willing to pay. Next, short selling. This is that cool trick we mentioned earlier. It's how you can potentially profit when a market is going down. And finally, liquidity. This one is so important. It just means there are tons of buyers and sellers around, so it's really easy for you to get in and out of your trades. So far, we've covered the what, the how, and the who, but honestly, none of that matters without this final piece. Let's talk about mastering the mental game. because day trading is just as much about psychology as it is about strategy. Now, this might be the most counterintuitive piece of advice for new traders. Your goal should not be to make money. I know, it sounds weird, right? But the logic is, if you focus on a perfect process, making smart decisions, managing your risk, the profits will take care of themselves. Your number one job, always, is to protect your capital. Think defense first, offense second. And this is exactly why that mindset is so critical. The book puts it perfectly. If you fail to control your emotions, you may lose any profits and capital accumulated over time in a single trade gone wrong. Think about that. You could be the smartest analyst in the world, but if fear or greed are calling the shots, you can wipe out weeks of hard work in a single bad trade. Discipline isn't just part of the game, it is the game. So there you have it, the beginner's playbook for getting into day trading. We've walked through what it is, the tools you need, the partners to look for, and the basic rules of the road. But as we've just seen, the plan is only as good as the person who's executing it. The knowledge is all here. The real question isn't whether you can learn all this stuff. It's whether you have the discipline to actually stick to the plan when the pressure is on. All right, let's dive right in. Today, we are talking all about futures, a really fascinating corner of the financial world, especially for day traders. You know, if you've ever thought about trading but got put off by the insane amount of money you need to start with stocks, then you are definitely going to want to understand how futures work. So let's get into it. So what on earth is a futures contract? Well, at its heart, it's just a deal. The easiest way to think about it is like pre-ordering the hottest new gadget. You agree today to buy it at a locked-in price, but you don't actually get it until it's released, right? A futures contract is pretty much the same idea. You're locking in a price now for something that will be delivered way down the road. And this brings us to a super important point. See, when you trade stocks, you're actually buying a little piece of a company. With futures, though, you're not buying the thing itself, not the oil, not the gold, not any of it. You're just trading the contract and basically betting on which way its price is going to go. So that begs the question, right? Why do it? If you don't actually own anything tangible, what's the big deal? Well, for day traders, the upsides can be, pretty huge. Let's break down exactly what makes futures so appealing. Take a look at this number, $5,000. Believe it or not, that can be a totally realistic starting point for trading futures, and sometimes it's even less. This is probably one of the biggest draws. It's just a much, much lower barrier to entry compared to day trading stocks, which, well, that can take tens of thousands of dollars just to get in the game. And this really lays out the key differences perfectly. With futures, you've got those lower capital requirements we just talked about, but you also get this amazing bit of flexibility. No restrictions on what's called short selling. All that means is you can bet on an asset's price going down just as easily as you can bet on it going up. Trying to do that in the stock market is often way, way harder. So the magic is really in this combination of perks. You can get started with less cash, and maybe most importantly, you can act on your gut or your analysis, whether you think the market's headed up or down. That freedom to go short, to bet on a price drop without all the red tape you find in the stock world, is a massive, massive advantage for traders. All right, so the appeal is pretty clear. But how do you actually, do it? How do you get started? Honestly, the process is probably more straightforward than you'd think. Let's walk through the basic requirements. It pretty much boils down to these three things. First, find a broker who deals with futures. Second, make sure you have enough cash to meet their minimum requirements. And third, you pick the actual futures contract you want to trade. Simple enough, right? But that last step, step 3, that's where the real strategy kicks in. Because, not all contracts are created equal. You got to look at stuff like trade volume. Is this a popular contract? Can you get in and out of your trades easily? And of course, you have to look at how its price has behaved in the past. Making a smart choice here is absolutely critical if you want to set yourself up for success. Okay, we've spent a lot of time on the good stuff, the low cost, the flexibility. But now we absolutely have to talk about the other side of this coin. And this is where the conversation gets really, really serious. We have to understand the massive, high-stakes risk that's involved here. Just read that sentence again. It really captures the incredible power of trading futures. A tiny, tiny shift in the market can create a gigantic return on your money. It sounds amazing, right? But this is the other edge of that sword. That exact same power that creates those huge wins, it can also create absolutely catastrophic losses just as fast. The very thing that makes it so profitable is also what makes it so dangerous. And that thing is called leverage. Leverage is what lets you control a huge contract with a pretty small amount of your own money. It's basically a magnifier. When things go your way, it magnifies your gains into something huge. But when the market moves against you, it magnifies your losses with the exact same brutal force. So let's be crystal clear about the biggest risks. Because the profit potential is so high, traders often use borrowed money, which is always risky. And thanks to leverage, if a trade goes south, your losses can actually be more than the money you put in to begin with. This isn't just about losing your investment. You could end up owing even more money. It's a huge deal. So, how do we wrap our heads around all this? We've seen the incredible appeal and the really scary risk. Let's try to pull this all together into a final balanced picture of what day trading futures is all about. I think this chart just says it all. The capital you need to start, pretty low. The potential for profit, sky high. But that risk level, it's right up there, almost maxed out. You are basically accepting an enormous level of risk for the chance at that huge reward. That right there is the fundamental trade-off of futures. Which leaves us with this one big question. We've laid out the mechanics, the pros, and the very serious cons. Futures trading offers this intense combination of high leverage and high potential. But when you look at that trade-off, you really have to ask yourself, is the risk actually worth the reward? And that's something every single person has to answer for themselves.
All right, let's talk day trading. If you've been thinking about jumping into this super fast-paced world, well, consider this your personal launch sequence. We're going to break down exactly how you can get started, step by step.
So, you're ready to enter the market, right? You're standing right there on the edge, looking in, and I bet you're feeling that mix of, excitement, maybe a little bit of nerves too. You're curious, you're ambitious, you want to know what it's all about. So, let's begin the countdown.
Okay, but hold on. Before we hit that big red launch button, let's just get real for a second. The source material, well, it puts it pretty bluntly. It says there are plenty of fat risks coming your way. So yeah, it's a world of massive opportunity, for sure, but it's also a place where you absolutely have to be prepared. So, first things first on our checklist, fueling the rocket. And in the world of trading, your fuel is your capital. I mean, this is the very first decision you've got to make. You can't even think about a trade without it. So, how much do you really need? That's the big question, right? Is it $1 million? Maybe not. What's the real price of admission to get into this game? Let's actually break down the numbers.
Okay, so the source says the absolute rock bottom minimum you need to start is $1,000. But, and this is a huge but, the source is also really quick to point out that trading with just that amount might make the whole thing, well, not worthwhile. It's really just the bare minimum to get your foot in the door.
Now, here's where it gets interesting. That was the minimum, but what's recommended? We're talking $8,000 to $10,000. And you might be thinking, whoa, why such a big jump? Well, it all comes down to one thing, risk management. With a bigger pile of cash, you can follow that golden rule of never risking more than 1% on any single trade. And that, my friends, is how you stay in the game for the long haul.
All right, so you've got your fuel. Check. Now you need a co-pilot, a navigator for this whole mission. That's your broker. And let me tell you, picking the right one is probably one of the most important decisions you're going to make.
I want you to think of this like you're putting your potential co-pilot through a gauntlet, a series of tests. You've got to ask some really tough questions to make sure they're the right fit, because believe me, their performance is going to directly impact yours.
First up, how fast are they? In day trading, we're talking prices changing in literally the blink of an eye. The source uses the word massacre to describe what a delay of just a few seconds can do to your profits. So yeah, you need a broker who is lightning fast. Instant execution, no excuses.
Next question for them. What are your commissions? Let's be real, you're in this to make money, right? High fees and commissions can just bleed you dry, eating away at your profits, especially if you're making a bunch of trades every day. The advice here is simple. Find a broker that's not going to cost you an arm and a leg. Okay, and what happens when stuff hits the fan? Because it will. Just picture this. You're in the middle of a huge time-sensitive trade and your computer crashes. What happens then? Does your broker have your back? You need to know exactly what their customer support plan is before you're in the middle of a 5-alarm fire. And this last one, look, it's a total non-negotiable. Is your money actually safe with them?
You have to confirm they're regulated by a real agency and that their cybersecurity is top-notch. Bottom line, do your homework. Check out their history, their security, everything.
Okay, so you've got your fuel, you've got your co-pilot, now it's time to equip the cockpit. We're talking about the essential tools you absolutely need right at your fingertips to trade like a pro.
So this really breaks down into 3 key areas. First up, your hardware. You need a fast setup. The source says a great line: cheap is expensive. A slow computer or a spotty internet connection could literally cost you a fortune in missed opportunities. Second, you gotta practice. Use a demo account. It's like a flight simulator for trading. Learn the moves before you put real money on the line. And third, have a plan, a real financial plan. Set realistic goals and stick to that rule. Never risk more than 1 to 2% of your capital in one trade. Manage your cash.
You know, I really love this quote from the source. Keep up, champ. It's encouraging, but it's also brutally honest. It says consistent losses will be incurred, so you gotta prepare for that. Look, losses are just part of the game. They're gonna happen. The trick isn't trying to avoid them completely. That's impossible. It's about managing them, learning from them, and just keeping on. All right, we're in the home stretch now. Last section. Think about it. Before you can navigate a new country, you gotta learn the language, right? Same thing here. So let's do a quick lightning round on some key lingo. This is your passport to the market.
First up, you'll hear this all the time: the spread. So what is it? It's just the tiny price difference between what a buyer is willing to bid for a stock and what a seller is asking for it. As a day trader, that little gap, that's where you live and breathe. Next term, market liquidity. This one is so important for day traders. It's basically how quickly you can buy or sell something without messing up the price. You want high liquidity. That means there are tons of buyers and sellers at all times, so you never get stuck holding something you need to get rid of, like right now.
And finally, let's talk about resistance. The easiest way to think about this is like a price ceiling. You'll see it on a chart. It's a price level that a stock just seems to struggle to break through. Why? Because that's where sellers tend to jump in, take their profits, and that selling pressure just overpowers the buyers.
And that brings us to a really interesting final thought. Kind of a conflict, actually, in our source material. On one hand, it strongly advises you to practice first with a demo account, paper trading. But then it points out that a lot of brokers actually discourage that. Now, why would they do that? Maybe it's because trading with real money brings out real emotions you just can't fake in a simulation. Or maybe they just want you trading with real money sooner. So I'm going to leave you with this question. What's your first trade going to be? Are you going to play it safe with paper, or are you going to dive right into the deep end with real cash? It's your call.
So you're ready to start trading, but picking a trading platform can feel like you're lost in a maze, right? There are hundreds of them out there. How in the world do you find the one that's actually right for you? Well, in this explainer, we're going to give you a map. You've done the homework, you've got your watch list ready to go, you're psyched. But there's this one huge question standing in your way before you can even think about making a move. There it is. The question that stops so many new traders right in their tracks. But you know what? It really doesn't have to be that overwhelming. We're going to break this all down so you can make a choice you feel really good about. All right, here's our game plan. First, we'll talk about this like you're choosing a partner. Then, we'll dive into the best all-around platforms, the heavy hitters with the most powerful software, the top choices for options traders, and of course, the platforms with the lowest margin rates. By the time we're done, you'll have a super clear idea of your perfect fit. Okay, so let's think of this like a buyer's guide. The goal here isn't to just name one broker as the best. Nope. We're going to find the best broker for you, based on what you care about the most as a trader. First up, let's look at the all-arounders. These are kind of like the Swiss Army knives of trading platforms. They do a little bit of everything, and they do it really, really well. This is for when you want that perfect sweet spot between powerful tools and a low price tag. And in this category, 2 names always seem to bubble up to the top: Interactive Brokers and Options House. They both give you that awesome combination of features and price, but they get there in 2 totally different ways. Now, the big difference here, and you really got to pay attention to this, is the pricing. Interactive Brokers charges you per share. So let's say you're trading, 2,000 shares of a $1 stock. Your commission could be super, super low. The catch? You need a pretty hefty $10,000 just to open an account. On the flip side, Options House is way more straightforward. It's just one flat rate fee, doesn't matter how many shares you're trading, it's simpler, there's no minimum to get started. But you do miss out on things like Forex, foreign currency trading, and futures. So what if the price tag isn't your main worry? What if you just want the absolute best engine under the hood? If your number one priority is having the most powerful, most robust trading software you can get without getting nickeled and dimed with extra fees, then this section is for you. In this arena, you've got two titans, TD Ameritrade and Charles Schwab. Both of them offer these incredible platforms that are just universally respected in the industry, and what's wild is how accessible they make them. TD Ameritrade gives you two amazing options. You've got thinkorswim, which if you ask the pros, they'll tell you it's one of the absolute best platforms out there, period. But they also give you Trade Architect, which is a much simpler, more streamlined version that's absolutely perfect if you're just getting your feet wet. Charles Schwab has a very similar playbook. StreetSmart.com is like your on-ramp to get started, and then StreetSmart Edge is the express lane for when you're ready for more advanced charts and tools. So with both of these guys, you have a clear path to grow as a trader. Just a little heads up, Schwab does have a $1,000 account minimum, but honestly, it's often waivable if you ask. All right, let's get specific. If you're an options trader, you already know that the one-size-fits-all platforms don't always cut it. You need specialized tools, you need lightning-fast execution, and you need a pricing model that doesn't kill you on complex trades. In the options world, there are two names you just have to know, TradeStation and Options Express. And figuring out which one is right for you really comes down to one simple question. How much are you actually trading? So TradeStation is aimed squarely at the professional, high-activity trader. I mean, it is an incredibly powerful piece of software, but it's built for people who are in the market all day, every day, firing off a ton of trades. And that power, it comes with a price tag, $99.95 a month. For a casual trader, that's pretty steep, but if you're a pro, you can get that fee wiped out completely. And how you get it waived tells you exactly who this platform is for. If you're trading more than 5,000 shares a month or more than 50 options contracts, poof, that fee is gone. If those numbers sound like your normal activity, then TradeStation is absolutely something you should be looking at. Now, if those numbers seem totally out of reach, don't even worry about it. That's where Options Express comes in. It's designed for the trader who wants great options tools and competitive pricing without having to hit those crazy high activity levels. Their pricing is super easy to understand. For active traders, it's just $1.25 per contract. And if you're doing smaller trades, like 10 contracts or less, there's a minimum charge of $12.95. It's just a much more accessible and predictable model for most people. All right, finally, let's talk about margin. This is when you borrow money from your broker to make bigger trades. It's definitely a high-risk, high-reward kind of strategy, and the interest rate you pay on that loan, oh man, it is a huge factor in whether you make a profit. Seriously, even a tiny difference in that rate can add up to thousands of dollars over time. And when it comes to those margin rates, the verdict is just crystal clear. The source material pretty much says that nobody else can even come close to Interactive Brokers. They are in a league of their own. So yeah, Interactive Brokers is the undisputed champ for margin rates. But if their account minimums are a little too steep for you, eOption is a really solid, more accessible alternative that still gives you very, very competitive rates. So here's the trade-off. Interactive Brokers has the best rates, hands down, no question. But you have to be an active trader to avoid getting hit with fees. eOption is a bit more forgiving. The rates are still really good, the barrier to entry is lower, but just watch out for that $50 inactivity fee if you make fewer than 2 trades a year. Okay, we have covered a lot of ground. We've looked at the best all-arounders, the most powerful platforms, and the top dogs for options and margin traders. Now, it all comes back to you. You know, it really all boils down to this one question. What's your number one priority? Is it keeping your costs as low as humanly possible? Is it having the most powerful tools money can buy? Or do you need a platform that's a specialist in a certain type of trading? Let's just recap real quick. Which one of these sounds like you? Are you the all-arounder, looking for that perfect balance of low commissions and great tools? Are you a power user who just needs the absolute best software? A specialist who lives and breathes options? Or maybe a margin trader, where every single fraction of a percent on your interest rate really, really counts? Once you know what your priority is, the right platform for you is going to become so much clearer. So ask yourself this. What's your non-negotiable? Is it a feature, a price point, a specific tool? Answer that one question and you are well on your way to finding your perfect trading partner.
Welcome to The Explainer. Today, we're diving into a really key player in the world of finance. We are talking about brokers and how they can basically be your personal guide to the entire market.
You know, if you've ever glanced at stock charts or seen headlines about currency trading and just felt like it's some kind of private club that you're not invited to, you are definitely not alone. It can feel super complex, even a little intimidating from the outside looking in.
Okay, so let's get right into it. How does an ordinary person, someone who doesn't have a fancy finance degree, actually get a seat at the table and take part in this massive global economy? Right, that exact feeling of being on the outside, looking in at this whole world of opportunity, that is the exact problem we are going to solve today. Turns out there is a way in, and it's probably more straightforward than you think.
The solution really comes down to finding a guide, an intermediary who can help you navigate this whole landscape. And in the financial world, that essential guide, well, that's what's known as a broker.
So at their very core, they're professionals who buy and sell assets on behalf of someone else. That's you. And for that service, for organizing the whole transaction, they earn a fee or a commission. It's really that simple.
And what's interesting is that this basic idea of a broker, it isn't just for finance. It's a pretty universal concept, really. It's just a go-between who helps a deal happen.
You've absolutely seen brokers in other parts of your life. A real estate agent, they connect home buyers and sellers. An insurance broker, they connect you with the right insurance companies. A stockbroker does the exact same thing, just with stocks and other financial stuff. Okay, so if a broker is just a middleman, why not just do it yourself? What's the real value they're providing? Why are they so important in so many different industries?
And this chart just illustrates the difference perfectly. If you go it alone, you're facing this huge learning curve, you have a really small network, but with a broker, you're tapping into expert knowledge, a network that's already built, all these specialized skills, and you're saving a ton of time.
So, what do you actually get? Well, our source highlights 5 key advantages. Let's call them superpowers that a good broker brings to the table. This one is huge. I mean, experienced brokers have spent years, sometimes decades in the market. They've seen the good, the bad, and everything in between. They know what to expect, and that is absolutely crucial when you're just starting out, and every little market swing feels totally new and unpredictable. Just imagine trying to build a whole network of buyers and sellers and market makers totally from scratch. It would take an incredible amount of time and effort, right? Well, a broker already has that network ready to go, giving you instant access and reach.
And this isn't just about knowing the market. It's about having special skills in things like client management, navigating complex rules, and the art of money management itself. These are skills that take years to master, but you get to tap into that expertise right away.
A good broker is not just an order taker. Their whole job is to understand your unique goals, what level of risk you're comfortable with, and what you're actually trying to achieve. Then, they go to work to find the best possible options to meet those specific needs, making sure you get what you want.
Honestly, this might be the most valuable advantage of them all. Because they know their field inside and out, they can execute strategies and find opportunities way more efficiently. And the time you save can be spent focusing on, well, the other parts of your life, trusting that your investments are being handled by a pro.
Okay, so let's see how this all works in a real-world, pretty high-stakes example. The world of foreign exchange, or Forex trading. That's where different currencies are traded against each other.
So this is a market that literally never sleeps. It is incredibly fast-paced, always moving. In that kind of environment, a broker is your essential link. They give you the platform and the access you need to trade currencies on a global scale.
And this is a really crucial point. A broker's job goes way beyond just placing trades. One of their most important functions is helping you understand and navigate all the risks that come with being in the market. This quote from our source really drives the point home. Things can go wrong, and sometimes they go wrong fast. A skilled broker is like your guide and your risk manager, helping you make the right calls when the pressure is on. A broker helps you deal with all these complex risks. For example, exchange rate risk is just the danger that the currency you're buying suddenly drops in value. Or country risk. That's the chance that some big political or economic event in a country could just sink your investment. A good broker helps you get a handle on these factors and use strategies, like setting loss limits, to protect your money.
Okay, so we've established that a broker can be an incredibly valuable guide for your financial journey. But that leads us to the most important question of all. How in the world do you find the right one?
The market is crowded, and believe me, not all brokers are created equal. You've got full-service brokers who give you personalized advice and research, and then you've got discount brokers who just execute your trades for a lower fee. Our source is crystal clear on this. You have to do some serious research, because this is a really critical partnership.
You should think of it like you're hiring a key employee for your personal finances. Your research has to include understanding their fees. Do they get paid a commission on trades, which might push them to trade more often? Or do they charge a flat fee? Getting referrals from people you trust and reading testimonials is vital. But most importantly, you need to have a real conversation with them to make sure they actually get you and your goals.
So here's the bottom line. A broker is the key that can unlock the entire world of financial markets for you. They bring access, expertise, and guidance to the table. But choosing that guide wisely, making sure you understand their services and how they get paid is the first, and you could argue the most critical trade you will ever make.
Day trading. You've probably heard the term, right? Maybe you've seen the flashy lifestyle promised online. But what is really going on behind all those charts and numbers? Well, today, we're going to cut right through the hype and give you a clear-eyed look at what it actually takes to be a day trader.
We've all seen the pictures, haven't we? Someone on a beach with a laptop, seemingly making a fortune in minutes. But what's the reality behind that screen? Is day trading a real, viable career, or is it just a high-stakes spin of the roulette wheel? That's the big question we're going to tackle.
So, here's our game plan. First, we're going to cover the absolute basics. What is this thing anyway? Then, we'll get into the essential toolkit every trader needs. After that, we'll walk you through a day in the life of a trader, what it actually looks like. Then, we'll dig into the mindset, which is so crucial. And finally, we'll lay out the pros and cons side by side.
Okay, let's start at square one. What exactly is day trading?
At its heart, day trading is all about speed. You're buying and selling things like stocks, but you're doing it all within a single trading day. The whole point is to catch these tiny, rapid price moves. And here's the golden rule: you close out every single one of your positions before the market closes for the night. Now that's a huge deal, because it means you're totally safe from any crazy news that might break overnight and send the market haywire while you're sleeping.
But to even play in this super fast-paced world, you can't just guess and click. You absolutely need a specific set of tools. And the most fundamental one is just knowing the language of the market. In other words, how to place an order.
You see, an order is just your instruction to your broker. But, and this is important, not all instructions are created equal. The type of order you choose can literally be the difference between a great trade and a really costly mistake.
The two big ones you gotta know are the market order and the limit order. Think of a market order like shouting, "Get me in this stock right now. I don't care about the exact price." It's all about speed. A limit order, though, is much more careful. It's like saying, "Hey, I'm only willing to buy if the price drops to this exact number or even lower." You get total control over the price, but there's a catch. The stock might never hit your price, and you could miss the trade completely.
And then, you have your single most important defensive tool, the stop order. Honestly, just think of it as your automatic eject button. If a trade starts to go bad, a stop order automatically gets you out at a price you already decided on ahead of time. This isn't just some nifty feature. It's how a disciplined trader protects their money and makes sure they can come back and trade tomorrow. So, you've got these tools. Now, what does a day in the life of a trader really look like? You can forget that image of some chaotic gambler just randomly clicking buttons. For the pros, it's a super structured, really disciplined process.
A typical day really breaks down into three very distinct parts. You've got your preparation before the market even opens, then the trading session itself, and finally, a review after the day is done.
You know, the real work actually begins long before the opening bell. This is the prep phase. A serious trader is reviewing their strategy, creating a very specific game plan for the day, and, this is the most important part, deciding exactly how much they're willing to risk. They're scanning the news, checking their tech, making sure everything is perfect. No surprises.
And here's where we bust a common myth. Successful traders are not glued to their screens for 8 hours a day. Nope, they often focus all their energy on the first hour or two after the market opens. Why? Well, that's when the market is the most volatile, it's moving the most, which creates the biggest opportunities.
And the day is not over when the trading stops. The review phase, that's where the real learning kicks in. Traders go back and log every single trade. They analyze what went right, what went wrong, and, most importantly, why. This isn't just bookkeeping, it's how they get smarter for the next day.
This brings us to what is, maybe, the single most critical part of trading, and it's the one thing that trips up almost every beginner. We're talking about the mental game. Now, this is going to sound completely backwards. I mean, if the point is to make money, how can your goals not be about profit? But the pros will tell you that focusing only on the dollar signs leads to emotional decisions, taking huge risks, and eventually blowing up your account.
So instead, the winning traders focus on process-oriented goals. They ask themselves questions like, did I actually follow my plan today? Or did I stick to my stop loss on every single trade? The thinking here is, if you can just execute your process perfectly, day in and day out, the profits will eventually take care of themselves. It's a huge shift from playing offense to playing defense.
So, if the main goal isn't just about raking in cash, what's the biggest thing standing in your way? Well, the answer is pretty simple. It's you. It's human nature itself.
And this slide right here perfectly illustrates that battle against our own instincts. Professionals have these hard and fast rules to keep their emotions in check. You know, if you have a couple of huge wins, you walk away before you start feeling invincible and get sloppy. If you take a few bad losses, you step back to avoid revenge trading, that desperate scramble to win your money back. And maybe the biggest one, stop staring at your profit and loss number all day. It's the fastest way to trigger the two emotions that absolutely kill traders: fear and greed.
Okay, we've seen what it is, how it's done, and the mindset you need. So now let's bring it all together and really weigh the dream against the cold, hard reality. On one hand, you've got this undeniable allure of day trading, the freedom, the control, the idea of quick profits. But on the other hand, you have the stark reality of what it actually takes to make it.
And look, the appeal is obvious. You have the potential for pretty quick returns, and because you're out of the market every night, you don't have that overnight risk. You're your own boss, on your own schedule, and hey, you can even make money when markets are going down through something called short selling.
But, and this is a huge but, the reality can be absolutely brutal. The risk of losing your money is extremely high. This isn't some part-time hobby. It demands a massive amount of time and intense, unwavering focus. The emotional pressure is constant. And yeah, there's a lot of info out there, but so much of it is just junk. Success really comes down to making perfect, split-second decisions under a ton of pressure.
So we come all the way back to our original question. Is day trading a career or is it a gamble? The consensus seems to be that without discipline, a defense-first mindset, and rock-solid emotional control, it is nothing more than a high-stakes gamble. But for that tiny fraction of people who can master themselves first, it can become a profession. So the real question isn't whether it's a career or a gamble in general, but which one would it be for you?
All right, let's talk about day trading. A lot of people see it as just high-stakes gambling, right? But what if I told you it's actually way more about careful prep work than just making risky bets? We're going to break down the blueprint for trading with a real plan, not, just crossing your fingers and hoping for the best. I want to throw a number at you right off the bat. 40%. Just 40%. Now, what do you think that means in the world of day trading? Is it the failure rate? The chance of having a good day? The real answer? Well, it's probably not what you're thinking. Get this, you can actually be profitable even if you only win 4 out of 10 of your trades. Seriously, that's what that 40% is all about. It just goes to show you, success in day trading isn't about being right all the time. Nope, it's about making sure your wins are big enough to crush your losses. Your system has to be set up so that when you do win, it really, really counts. And that right there brings us to a huge idea. Winning before you even trade. See, the most successful trades, they're not just lucky guesses. They're the result of a solid plan for your money and your strategy, all worked out long before you even think about hitting that buy button.
Okay, so where do you start? Your very first, most practical decision is picking a broker. Now, this might sound kind of boring, but for a day trader, the fees, man, they can be an absolute silent killer. Just think about it. Say you make 20 trades in a day. A tiny little $5 fee per trade, that's $100 a day. That's almost $2,000 a month, just gone, boof. And that's before you even know if you've won or lost.
So these brokerage fees, they come in a few different flavors. If you're just starting out, maybe making 1 or 2 trades a day, a simple per trade fee is probably your best bet. But if you're a high volume trader doing a lot of buying and selling, then a staggered or fixed rate plan could save you a ton of money over time. The key is just matching the fee plan to how you trade. And listen, your broker isn't just a middleman. They've got some seriously powerful tools for you. Trading platforms, historical data, charting apps, you name it. A lot of this stuff comes included, which is awesome. But you gotta be careful about those expensive add-ons they'll try to sell you. My advice, just stick to the tools that you actually need for your strategy. Don't pay for bells and whistles you're not gonna use. Okay, so you've got your broker picked out. Now we get to the real heart of it, your strategy. You've got to think of this as your blueprint, your roadmap. I mean, trying to day trade without a strategy, that's like setting sail across the ocean with no map and no compass. You're just asking for trouble. And this quote right here, this is pretty much the golden rule, the number one thing you have to remember. It says emotions should be completely out of the strategy development process. That means your plan has to be built on facts, on logic, on real analysis. You have to leave fear, greed, and those gut feelings at the door. They have no place here. So what is a strategy really? It's your framework for looking at the market. A big part of that is something called technical analysis, and that's just a fancy way of saying you're looking for patterns in price charts and using indicators to try and figure out where the price is going to go next. It's all about using data, not drama, to spot your opportunities. All right, so you've built your emotion-free blueprint. Now what? Well, you can't just jump in the deep end. The next step is to test it. Think of it like a flight simulator for a pilot. It's your chance to see if your plan actually works without risking a single penny of your own money. And this is the million-dollar question, isn't it? You have a plan, you've done all the research, you've built this amazing system on paper, but does it actually work? Does it hold up when things get real? This is where you take your strategy for a test drive. There are two main ways to do this: simulation and backtesting. A lot of brokers will give you what's called a paper trading account. It's awesome. It lets you trade with fake money in the real live market. So, what's the difference? Well, simulation is like practicing in the present moment, in real time. Backtesting is when you go back in time. You take your strategy and you apply it to historical market data to see how it would have done. Both are super important because they give you a realistic idea of whether your plan has a shot, and they help you remember to factor in costs, like those pesky brokerage fees. Okay, last big piece of the puzzle here. Let's talk about mindset. Because being a successful day trader requires a totally different way of thinking than being a long-term investor. It's not even close. Yeah, check this out. It really breaks down the difference. A long-term investor is digging into a company's health, its future value, thinking in terms of months or even years. But a day trader, we're focused on what the price is doing right now. We're using that technical analysis we talked about to predict moves happening in the next few minutes or hours. It's a completely different sport. Let me put it this way. As a day trader, you honestly don't care about a company's 5-year plan. You care about what its stock price is going to do in the next 5 minutes. And that's exactly why all that deep research into a company's fundamentals, which is so important for investors, is, well, it's pretty much irrelevant for a day trader. So let's leave you with this final thought. The market is open. Are you trading with a plan, or are you just trading with a hunch? Because at the end of the day, success in this game all comes down to the work you do before that opening bell ever rings. The only real question left is, are you prepared? All right, today we're going to talk about something that is so important for anyone in the trading world, but honestly, it gets overlooked all the time. We're diving into the relationship between trading and time. Let's get right into it. You know this feeling, right? We live in a world where we want everything, and we want it now. This whole instant gratification thing, it's not just a buzzword, it's practically wired into us at this point. So here is the huge question. What actually happens when that need for speed, that everything now mindset, crashes head-on into the stock market? Well, the answer is, it can be an absolute disaster. It might just be the single biggest thing holding you back from real success. Okay, so let's start by breaking down this trap, this everything now trap. We're going to look at how our culture sets us up with some really unrealistic expectations right from the get-go. And look, the source material is crystal clear about this one. You just can't expect to become a pro trader in a month, or even crazier, in a week. I mean, think about it. You wouldn't expect to become a master chef overnight, right? Same thing applies here. This is a skill you have to build, not a lottery you win. So we know that trying to become an expert instantly is a dead end. But what about just rushing your day-to-day moves? Let's take a closer look at why hurry is probably the worst companion you can have on this journey. The source calls hurry a bad companion, and that is just the perfect way to put it. It's that little voice inside your head screaming, "Do something, act now or you'll miss out." It's the total opposite of a solid, well-thought-out strategy. And it's exactly why so many people bail on a winning trade way too early or jump into something sketchy without doing their homework. In this slide, right here, it lays out the two different paths perfectly. On one side, you've got the impatient trader, always chasing that quick hit, reacting to every little blip on the screen. And on the other side, the strategic trader, the one who gets that the real magic happens when you let a good strategy play out over time. The difference in the end result, well, it's night and day. So if being impatient is the enemy, then what's the solution? Well, it's all about making a mental shift, moving your focus away from speed and onto time. Let's dig into how a little bit of patience can actually build a much stronger foundation for success. This slide gets to the heart of it with a really powerful idea: giving money to mature. That's the core of patient trading. It means you've got to have the discipline to let your strategy and your capital do their thing, without you jumping in and messing with it every 5 seconds. But here's the thing. Patience isn't about just sitting on your hands and doing nothing. It's an active choice. It's understanding that the market has rhythms, it has cycles. It's about having the guts to stick to your plan, even when the market is going haywire. It's about trusting the process, not just hoping for a lucky break. Okay, to really make this hit home, let's walk through a scenario from the source material. This example is going to show you exactly what can happen when you try to force huge results in way too little time. So imagine this. You get presented with this amazing opportunity. It's super high risk, but also super high reward. It's the kind of thing that promises to make you a ton of money fast. But there's a big catch. It's really only meant for seasoned pros. But you're feeling bold. You're in. You start with a nice, round $10,000 in your account. And the strategy? It's aggressive. You're putting half of everything, $5,000, right on the line. And here's the kicker. The goal is to double your money in just 3 months. I mean, come on. That is the ultimate everything now temptation right there. The stakes are incredibly high. Best case, you walk away with double your cash. Worst case, you lose everything. And not just lose it, but lose it fast, maybe in a few weeks. That incredible speed of the potential gain is also the speed of your potential ruin. Now let's flip this whole thing on its head for a second. Forget about the dream of doubling your money. Ask yourself this instead. How would you feel if you lost half of your entire account in 2 weeks? Suddenly, that shiny, fast money dream doesn't look so good, does it? So what's the big lesson here? What's the main takeaway from all of this? It really all boils down to one simple but really powerful idea. See, in trading, time isn't just a clock on the wall. It's an asset. It's a form of currency. Every minute you spend studying, planning, and letting your plans develop is an investment. And every minute you waste chasing some quick, flashy win, you're just burning through your most valuable resource. And that leaves us with one last thing to think about. In this world of super fast trading and complicated computer algorithms, what if the most powerful tool you have isn't on your computer at all, but inside your own head? What if the ultimate trading strategy isn't a strategy at all, but simply patience?
All right, let's dive into day trading demystified. We're going to tackle a huge question today. When you look at those chaotic stock charts, is it actually possible to find predictable patterns in all that noise? Let's find out. You know, for most people, the stock market looks like total chaos. Just a random, unpredictable mess of ups and downs. But what if I told you that hidden inside all of that daily movement are patterns that show up again and again, all driven by something super predictable: human emotion.
See, successful day trading isn't about getting lucky or just rolling the dice. It's a skill. It's about training your eyes to spot very specific, repeatable setups that pop up almost every single day.
And that brings us to the core idea of day trading. Look, no 2 days are ever going to be exactly the same, but profitable patterns absolutely do repeat. The real trick is learning how to find that signal in all the noise.
This is pretty much the day trader's whole mission statement. Your job is to spot these recurring setups that are kind of hiding in plain sight in what looks like just random price action. You're learning to see the order in the chaos.
And here's what's so fascinating. These patterns aren't just some technical blips on a computer screen. No, they're driven by people. They show up at these tipping points when other traders are feeling intense greed or fear, which forces them to buy or sell in ways that are actually quite predictable.
Okay, so enough theory. What do these patterns actually look like? Let's break down a few of the most common setups that you can really learn to spot and act on.
First up, we've got a real classic, the impulse, pullback, breakout. This is a super powerful pattern that you'll often see play out right after the market opens for the day. You know, when all that initial energy is just unleashed.
So here's how it works. First, you get this big, strong push in one direction. That's your impulse. Then, the market kind of takes a breath. That little pause is the pullback and consolidation part, where the price just moves sideways for a bit. And then bam, you get the breakout, which is the next leg up, continuing that first big move. That's the part you're trying to catch.
But what happens when the trend just completely flips on its head? Well, that's where the consolidation reversal breakout comes into play. This pattern is all about spotting a total change in who's in control.
So the key here, and this is really important, is to focus on that second bigger move. That massive reversal is your new signal. It's telling you exactly where the power has shifted, and that's the direction you want to be trading in.
And finally, let's talk about a really cool concept, how the market's own memory can give you a trade. The support and resistance reversal is all about finding these historical price levels that have acted like a floor or a ceiling in the past.
With this setup, you're literally using the market's history to your advantage. You find a price where the stock has reversed a couple of times before. You wait for it to get there and stall out, and then you trade the breakout, basically betting that history's going to repeat itself.
Okay, so you get the patterns, but how do you actually turn this into a profession? Well, there are pretty much two main paths you can go down.
You can either trade for a firm or you can go to loan. Now, working for a firm is great. You get structure, professional training, and you're trading with their money, not yours. But you'll need to get licensed. On the other hand, as a self-employed trader, you have total freedom. But it's your own money on the line from day one.
So whether you're at a firm or at your kitchen table, just knowing a few patterns isn't enough. Not even close. Success really comes from having a disciplined strategy. So what are the basic rules for building one?
Okay, listen up, because this is probably one of the most important rules you'll hear. Don't, and I mean don't, try to trade the entire market. The key is focus. You want to narrow your whole world down to just 1 to 3 stocks. That's it.
So why so few? You're probably thinking that sounds crazy, but the goal is to become a true expert. You want to know these stocks inside and out, how they move, what their personality is. This way, you're not scrambling to do new research every single morning. You're building deep, real expertise.
And when you're picking those 1 to 3 stocks, here's your checklist. You need high volume. That just means a lot of people are trading it, so you can get in and out easily. You need volatility, because if a stock doesn't move, you can't make money. And you want something that's connected to the news, because those events are what create the big moves in the first place.
So at the end of the day, knowing all the setups we've talked about, that's really just the first step. The real challenge, and honestly, the true difference between making it and not, is having the discipline to patiently wait for those patterns and then act without hesitation when they finally show up. So the real question isn't can you see the pattern, it's do you have the discipline to actually follow it.
So, if you're thinking about day trading, there is one absolutely huge mindset shift that could mean the difference between winning and, well, losing badly. It's all about moving away from that desperate scramble for cash and embracing a totally different way of thinking, treating trading like a true calling, a vocation. Right off the bat, our source material is incredibly blunt about this. It hits you with this stark warning. If you're looking at trading as some kind of quick fix for your money problems, you're already on the wrong track. This just completely shatters that whole get-rich-quick fantasy that so many people associate with the markets.
So that kind of begs the question, right? If trading isn't some magic money machine, then how should we be thinking about it? Let's dig in and break down what the right mindset actually looks like.
First things first, we've got to understand the why not. We need to explore the massive dangers of trading from a place of desperation. Trust me, it's a recipe for disaster. You see, desperation completely short-circuits your brain. You literally can't think clearly. Your focus shifts away from strategy and data and becomes totally fixated on what you stand to lose. You get this intense tunnel vision, you lose the big picture, and honestly, it's almost like that desperate energy is a magnet for failure.
Okay, so now that we know the danger zone, let's flip the script.
This brings us to the absolute core idea we're talking about today, making that crucial shift from seeing trading as just a way to make income to seeing it as a real vocation. And look, these two paths are like night and day. The whole income generation mindset, it's a total trap. You see trading as a quick fix, and that path almost always leads straight to desperation and disaster. But the vocation mindset, that changes everything. You reframe it as a calling, an adventure, a chance to learn about yourself, and the difference in the outcome is just massive. Think about it. When you start treating trading like an adventure, the market's chaotic nature suddenly becomes exciting instead of terrifying. Every single day is a brand new puzzle to solve, a new challenge to figure out, and a new experience to learn from. And you know, this new perspective unlocks rewards that go way beyond just money. It turns trading into a genuine journey of discovering who you really are. It's like the market holds up a giant mirror. You're not just learning about charts and patterns, you're learning about crowd psychology. And even more importantly, you're learning about your own psychology. What makes you scared? What makes you greedy? How disciplined can you actually be when the pressure is on? Can you set goals and stick to them? These are the real tests. And the trick is to completely reframe these challenges. Becoming more disciplined isn't just some annoying hurdle you have to jump over to get to the money. No, becoming more disciplined is the reward. That ability to control your own emotions is like a superpower you can use in every single part of your life, way beyond trading. So if desperation is the enemy, what's the antidote? Well, this is where passion comes in. Let's talk about how passion becomes the real engine for your success. Our source puts it so simply. Desperation just seems to push success away. The more you desperately chase after it, the more it slips through your fingers. It's like trying to hold on to water. The tighter you squeeze, the less you actually hold. The difference is just so clear. Desperation clouds your thinking. It makes you obsess over what you could lose. But passion, it does the exact opposite. It fuels this incredible curiosity. It makes you fall in love with the process of learning and discovery. Every little insight becomes this exciting aha moment. And this passion-fueled curiosity, it's not just some feel-good idea. It has a very real practical benefit. It's what drives you to actually learn the patterns, to analyze your wins and losses, and to focus on what really works, instead of just freaking out and reacting to every little market swing. Okay, so we've talked a lot about the mindset. That's the what. But what about the how? How do you actually put all this philosophy into practice, day to day? Let's get into the nitty-gritty. The source lays out this incredibly simple but really powerful weekly routine. Now, the goal here is not to chase every hot stock that's buzzing. Nope, the goal is to build deep expertise. You start by screening for a tiny list of stocks, we're talking just 2 to 4, that perfectly fit your strategy. Then, and this is key, you trade only those stocks all week. You get to know their personalities, inside and out. Then, over the weekend, you repeat the process and get a fresh list. This whole routine is designed to do one critical thing. It forces you to replace impulsive emotional guessing with a focused, research-based strategy. You're trading from a position of knowledge, not just reacting to market noise. This is what discipline actually looks like in practice. And in the end, even this strict discipline serves a bigger purpose. Yeah, the money is a goal, of course, but the real focus, the true north, is the adventure of it all. It's about the process of watching yourself change, learn, and get better over time. So I'll leave you with this question to chew on. And this applies to anything, not just trading. Are you approaching the hard things in your life as a dreaded job you have to do, or as a fascinating journey you get to be on? Because your answer to that question, well, that could make all the difference in the world. Have you ever made a great trade and then wondered, man, was that skill, or did I just get lucky? It's a question every single one of us has asked, but what if you could take luck out of the equation? Well, today we're going to dive into a playbook for momentum trading, a strategy that's all about doing just that. And that right there is the whole idea. The goal isn't to stumble upon winning stocks by accident. It's to build a process, a repeatable system that gives you predictable results. You know, this is what separates the pros from the amateurs, and it's a skill that you can absolutely learn. So here's our game plan for today. First, we're going to shift our mindset away from luck and towards real strategy. Then we'll get into the nitty-gritty of what a momentum stock actually looks like. After that, we'll cover how to find them using tools called screeners, how to read charts for your entry and exit points, and finally, and this is the big one, the essential disciplines that tie this whole thing together.
You know those day traders who seem to pull in a consistent income? They're not just getting up every morning and rolling the dice. No way. They've moved way beyond luck. They use disciplined, proven strategies to get predictable results day in and day out. And the best part is, if they can do it, so can you.
So, what are we really trying to do here? What's the main goal? We're on the hunt for stocks that have the potential to make these huge, massive moves, like 30% in a single day. Now, look, a move that big is rare, for sure, but that's the kind of explosive potential we're looking for. And believe it or not, this isn't some wild goose chase. These high-flying stocks all tend to share a few common identifiable traits.
I mean, think about it. There are thousands and thousands of stocks trading every single day. How in the world could you possibly pick the right one? Well, you don't have to guess. By looking for 4 key characteristics, we can slash that massive list down to just a small handful of high-potential candidates. Okay, first up is something called float. It's a simple concept. It's just the number of shares that are actually available for people like you and me to trade. Now, here's the key takeaway. A lower float often equals higher volatility. Why? It's just basic supply and demand. With fewer shares to go around, any new wave of buying or selling can move the price a lot.
Next, you gotta pull up the daily chart. We're looking for proof that a strong trend is already in motion. We want to see a stock that's already trading above its moving average, which is just a simple way to see its recent trend. And we also want to see it breaking away from old price levels, those ceilings and floors that might have held it back before.
Trait number 3 is a big one, relative volume. This tells you what's happening right now. If a stock is trading 2, 5, even 10 times its normal daily volume, that's a huge signal. It tells you that a crowd is gathering, that there's unusual interest, and that's exactly what we're looking for.
And finally, there's the catalyst. This is the why behind the big move. Now, you don't always need one, but an external event, like a great earnings report or some big news from the FDA, that's like throwing gasoline on an already lit fire. It gives the stock a real fundamental reason to be soaring. Okay, so we've got the 4 ingredients of a perfect momentum stock. But how do we actually find them without spending our entire day searching? Well, let's talk about the tools of the trade, stock screeners. For this strategy, these things are absolutely essential. There are a ton of screeners out there, but here are 4 really popular ones. StockFetcher is awesome if you love to build complex, custom filters from scratch. FinViz is super user-friendly and has great pre-made scans ready to go. ChartMill has some really cool specialized indicators, and StockRover is fantastic if you're trading both US and Canadian stocks. So, how do we actually use these things? Well, here's a quick example of a scan for what we can call steady volatility. First, we filter for stocks that have moved at least 5% a day on average. Then, we set a reasonable price range, say between $10 and $100. Then we make sure there's enough daily volume, over 4 million shares, so we can get in and out easily. See? It's all about systematically finding exactly what we're looking for. All right, finding the right stock, that's only half the battle. The real skill, where the pros really shine, is in the execution. Now we need to look at the charts to find that perfect moment to jump in and, just as important, the exact signals that tell us it's time to get out. Let's look at 2 super common patterns. Over on the left, we have a pennant. Think of this like the stock is just taking a quick breath before it continues its big run-up. A breakout from that little triangle is often a fantastic signal to get in. But on the right, we have a double top. This is a reversal pattern. You can see how the price tried to hit a new high, failed, tried again, and failed again. That's a huge warning sign that the momentum might be fizzling out. Knowing when to sell, this is where discipline really pays off. You have to have clear exit rules. First, don't get greedy. Stick to the profit target you set before you even entered the trade. Second, if you see a candle close in the red after a strong run-up, that's your visual cue to take your profits and run. And third, if you get a sudden massive spike up, what some people call an extension bar, don't hesitate. Lock in those profits right away. And this brings us to our last section. And honestly, it's the most important one. You can have the best strategy in the world, but it's totally useless without the right mindset. Long-term success is not about one amazing trade. It's about the boring, consistent daily habits of discipline and managing your risk.
And this right here, this is rule number 1. You need, at a bare minimum, a 2-to-1 profit-to-loss ratio. What does that mean? It means for every single dollar you're willing to risk, your goal should be to make at least $2. This gives you a massive mathematical edge. It means you can be wrong more often than you're right and still not lose money. That's how powerful this is.
And believe it or not, when you trade matters a lot. The highest probability for success in momentum trading is in the first 2 hours of the day, from 9:30 to 11:30 a.m. Eastern. That's when the volume and the volatility are at their absolute peak, and that's where the best opportunities are.
So let's just put it all together into 3 pillars of discipline. 1. Be precise with your stops to manage your risk. 2. Focus all your energy on that best trading window, 9:30 to 11:30. And 3, you have to analyze your results. Look at your trades every week to see what's working, what's not, and how you can get better.
And that really brings us to the final thought. We've just walked through the entire playbook, from how to find the stocks, to how to trade them, to how to manage yourself. The strategy is right here. So the only real question left is a personal one for you. You have the playbook. Do you have the discipline to actually execute it?
All right, let's talk about something that affects your wallet pretty much every single day. The big fight between inflation and deflation. Now, I know it sounds a little complex, but stick with me, because getting this is absolutely key to understanding how the economy really works.
So, let me just start by asking you a question. When you see the price of something you really want, a new phone, a TV, whatever, start to drop, what's your first thought? Awesome, a bargain, right? Of course. But what if I told you that for the economy as a whole, falling prices can actually be a total disaster?
And that's where we get to this really surprising economic truth. You know how a slight fever can actually be a good sign, showing your body's fighting off an infection? Well, in a weird way, the economy is kind of similar. A small, steady rise in prices, a little bit of economic fever, is actually considered healthy. I know it sounds completely backwards, so let's break down why.
First up, let's look at the condition that economists and central banks are actually trying to create. We're talking about healthy inflation.
So what even is inflation? Well, put simply, it's just a general rise in the price of stuff. Goods, services, the whole shebang. But here's the crucial part. When that rise is slow and predictable, it actually gets people to, spend money. It gets the economic engine moving.
And believe it or not, there's kind of this magic number that most central banks around the world are shooting for. And that number is 2%. They see a 2% inflation rate every year as that perfect sweet spot. It keeps the economy warm and growing, but not, overheating.
Okay, to make this all make sense, let's use a super simple example. Imagine you're in the market for a new computer. You've done your research, you've picked one out, and you're all set to pull the trigger.
Okay, now here's where your personal decision creates this awesome ripple effect. In a world with that gentle 2% inflation, you know that computer is probably going to cost a little bit more next month. So what do? You buy it now, right, to get the better price. Well, your purchase helps the store, which then orders more from the manufacturer. That keeps the factory busy and keeps people in their jobs. See that? It's a healthy, positive cycle, all starting with you just wanting to buy a computer.
But what happens when that whole process flips on its head? What if prices aren't slowly rising, but are actually starting to fall? This is where that idea of a bargain suddenly becomes incredibly dangerous for everyone.
Let's go right back to our computer example. You're watching the price, and instead of creeping up, it's actually dropping. Your first instinct might be, yes, I'll wait for an even better deal. But what does that decision actually cause?
Well, this whole phenomenon has a name. It's called deflation. And this isn't just a weekend sale we're talking about. This is when inflation goes negative and prices across the entire economy are in a sustained nosedive.
And this is why it's so dangerous. They call it a deflationary spiral for a reason. If you expect that computer to be even cheaper next week, you wait. The problem is you're not the only one. Everybody waits, and suddenly, stores can't sell anything. Their warehouses are full of stuff nobody's buying, so producers have to slam the brakes, shut down production lines, and start laying people off. What started as a totally rational choice for you becomes a collective disaster, a full-blown recession.
So here it is, plain and simple. Think of it as a showdown. Inflation gives you a little nudge to buy things sooner rather than later. But deflation, it basically screams at you to wait, to postpone every purchase you can. And an economy where everyone is waiting, well, that's an economy that's grinding to a dead halt.
So what do we do about it? Is there anyone who can step in and fix this mess? Well, yeah. This is where central banks come in. You can think of them as the economy's doctors, with a toolkit designed to keep everything stable.
And here's their main playbook. If the economy gets too hot, that inflation fever spikes way above 2%, they raise interest rates. That makes it more expensive to borrow money, which kind of drains a little cash out of the system and cools things down. But if that economic chill of deflation hits, they do the exact opposite. They slash interest rates, sometimes even into negative territory, to make borrowing super cheap and try to jolt everyone into spending again.
So after looking at both sides of the coin, which one is the more dangerous fight for an economy? Well, the evidence here is pretty overwhelming. It's not really a fair fight.
Honestly, the source material says it best. We can say without a shadow of doubt that deflation is far worse for an economy and population than inflation is. End of story. It is just so much harder to break free from that freezing grip of a deflationary spiral than it is to cool down an economy that's a little too hot.
So the big takeaway here is this. Nobody loves paying more for stuff. We get it. But a little bit of that economic fever, that small, predictable rise in prices, is actually a sign of a healthy, functioning economy. And it is way, way better than the spreading chill of deflation that can freeze everything solid.
And that really just leaves us with one final thought. For decades, 2% has been that golden number. But in the crazy, rapidly changing world we live in now, you've got to wonder, is 2% still the perfect temperature for economic health? It's definitely something to think about.
Hey there, and welcome. Today, we are going to tackle one of the most important ideas in all of finance: portfolio diversification. Look, whether you've been investing for years or you're just getting your feet wet, figuring out how to spread your risk is, without a doubt, the key to winning in the long run. All right, let's jump right in. First things first, we've got to talk about the elephant in the room: day trading. I mean, who isn't tempted by the idea of making a quick buck, right? But here's the deal. It is loaded with risk, especially if you're new to the game. The source material we're drawing from is super clear on this. This is not a casual hobby. It's a high-stakes, full-contact sport. And this slide just lays out the two paths so perfectly. Over on the left, you've got that high-octane world of day trading. Think of it as a full-time job with a crazy steep learning curve, tons of leverage, and yeah, a very real chance of losing big. Then on the right, you have the slow and steady path of investing. It's a completely different mindset. It's all about playing the long game and managing risk for that sweet, sustainable growth. So how do you actually shield yourself from that kind of wild volatility? From that nightmare scenario where one bad bet just blows up your entire account? Well, the answer is a strategy that's as old as the markets themselves. It's the golden rule, and it's absolutely fundamental. You have to diversify. Come on, you've heard this a million times, right? And there's a really good reason for it. This one simple phrase, it's basically the soul of diversification. It just means you don't tie your entire financial future to the fate of a single stock or a single asset. Simple as that. Okay, let's put a slightly more formal definition on it. At its heart, portfolio diversification is a risk management tool. The whole idea is to invest in a bunch of different things to smooth out those inevitable market bumps. But here's the thing. When you spread out your investments, you're not just playing defense against losses. You're actually playing offense too, opening up the possibility for better returns over time. And what's so powerful about this chart is just how clear the difference is. I mean, look at that. Putting all your money in one stock, that exposes you to a huge risk of catastrophic loss. If that one company goes down, so do you. But when you have a diversified portfolio, that risk just plummets. You're no longer at the mercy of one company's bad quarter. All right, so we get the what and the why. Now, let's dig into the fun part, the how. How do you actually build this financial fortress? A portfolio that's designed to weather the inevitable storms. Well, it all kicks off with a concept called asset allocation. So here's the secret sauce. You want to own assets that are non-correlated. Now that's just a fancy finance term for things that don't all move in the same direction at the same time. Think about it. When one part of your portfolio zigs, you want another part to zag. That way, if one investment is having a bad day, another one might be doing great, and it all kind of balances out, keeping your overall portfolio much more stable.
And this is so important. Real diversification isn't just about owning a bunch of different stocks. No. It's about investing across totally different types of assets. Just look here. You've got stocks for growth, bonds for stability and income, currencies for hedging, real estate to fight inflation. A really strong portfolio is a cocktail of all these different ingredients.
So you might be asking, okay, but what's the magic number? Well, to make this a little more tangible, the source material actually gives us a target to aim for. For a really well-balanced, risk-reduced portfolio, you're generally looking at holding somewhere between 25 and 30 different securities. That gives you that broad exposure you need without things getting totally out of hand.
Okay, let's pause here, because this next part is absolutely critical. It is surprisingly easy to think you're diversified when you're actually not. There are a few common and pretty dangerous traps that even really seasoned investors can fall into.
And this right here is the biggest trap of them all. We're talking about false diversification. It gives you this illusion of safety. You might own, say, 30 different stocks, but if they're all in the same sector and they all react to the market in the exact same way, you're still incredibly exposed.
This chart just nails the point. I mean, someone could look at this portfolio and think, hey, I own 5 of the biggest, best companies in the world. I'm diversified. But what happens if the whole tech sector takes a nosedive? They're all likely going down together. This isn't a fortress. It's a house of cards built in a single neighborhood, waiting for a strong wind.
And the plot thickens, because you also have to worry about these things called hidden correlations. See, in our modern world, everything's connected. A crisis on the other side of the planet can send shockwaves to the US market in minutes. It means that even assets that are supposed to be opposites, like stocks and bonds, can suddenly start moving in lockstep during a panic. And as the slide points out, sometimes all it takes is one massive hedge fund making a big move to create a ripple effect that messes with everyone's portfolio.
So after all that, what's the big takeaway here? It's this. Diversification is not a set it and forget it kind of deal. Not at all. It's an ongoing, active process. It's really a strategy for your entire investing life.
To really make this work for you in the long haul, the source material points to 4 key disciplines. Number 1, invest regularly. Building a portfolio is a marathon, not a sprint. 2, rebalance your assets. You got to periodically trim what's overgrown and feed what's lagging. 3, watch those fees. Commissions and expenses are like termites. They can eat away at your returns over time. And finally, number 4, and this is the tough one, have an exit plan. Know when it's time to cut your losses on an investment that just isn't working out.
And all of this brings us to one final crucial question. I want you to take a hard look at your own investments and ask yourself this. Is your portfolio really built to handle whatever the future throws at it? Or is it just built for the market we're in right now? Honestly, the answer to that question could make all the difference in the world.
Welcome to The Explainer. Today, we're going to tackle a skill that is, honestly, one of the most important things you can learn: how to manage your money.
So, have you ever gotten to the end of the month, looked at your bank account, and just thought, where did it all go? If that sounds familiar, trust me, you are not alone. That exact feeling is pretty much the starting line for millions of people on their financial journey.
You know, the source material puts it perfectly. Trying to manage your money without a plan, it's like hopping in your car and just driving. No destination, no GPS. You'll burn a lot of gas, for sure, but you won't get anywhere meaningful. So today, let's build that financial map for you.
Okay, first things first. To create our map, we've got to know what we're actually talking about. So, what is money management?
Well, at its core, it's really just a set of skills for handling your money. It's the whole shebang. Budgeting your income, saving up for the future, investing, and even planning for those big life purchases.
Right, so before you can map out any journey, you have to know the terrain, right? You need to know where you're starting from. In the world of finance, that landscape is basically made up of 2 big things: your assets and your liabilities.
And this distinction is super simple, but absolutely crucial. Assets are the things you own that have value. Think cash, your car, maybe some investments. Liabilities, on the other hand, are what you owe. We're talking student loans, a mortgage, credit card debt. You get the picture.
Okay, so here's where it all comes together. You take what you own, your assets, and subtract what you owe, your liabilities. And that number? That's your net worth. It's literally the "you are here" pin on your financial map. It's your starting point.
All right, so we've defined our map and we've dropped that "you are here" pin. Now it's time to pack your toolkit. Let's dive into the 4 essential skills you're going to need to get started on this journey.
These 4 skills are pretty much the foundation of solid money management. It all kicks off with setting a budget. Then you've got to track your spending, figure out your goals, and finally, start to think like an investor so you can actually make your money grow.
Okay, let's start with the budget. If your overall plan is the map, think of your budget as the turn-by-turn directions from your GPS. It's a plan that gives every single one of your dollars a job to do each month, so you're not just, spending aimlessly.
A really popular place to start is the 50-30-20 rule. It's pretty straightforward. The idea is that 50% of your after-tax income goes to your needs, 30% goes to your wants, and a really solid 20% goes towards savings and paying down debt. Now, look, it's a guideline, not a strict law, but it's a great way to make sure you're not just spending for today, but you're also building for tomorrow.
But to make any budget work, especially that one, you have to get real with yourself about the difference between a need and a want. Needs are the absolute essentials for survival. We're talking shelter, food, utilities. Wants are, well, they're pretty much everything else, and that's where you have the most power to adjust your spending.
Okay, so you might be thinking, this sounds like a lot of work. So why do I do it? What's the payoff? What's the destination on our map? Let's get into the rewards, because honestly, they can be life-changing.
First up, real, genuine financial security. This means having that cushion, that savings, to handle life's curveballs. The car breaks down, you unexpectedly lose your job, without having to rack up a bunch of debt. It's your financial safety net.
Next, and this one is huge, you get peace of mind. Just knowing that your bills are covered and you have something set aside for emergencies, that gets rid of a massive source of stress, both for you and in your relationships. And finally, you get the freedom to act. When your finances are in good shape, you can actually say yes to opportunities. Whether it's a great investment that pops up, that once-in-a-lifetime trip, or maybe even starting your own business.
Now, the really good news here is that you don't have to do all this with like a paper map and a compass. There are some incredible tools and professional guides out there to help you on your way.
Honestly, financial apps can be a total game changer, and there's an app for pretty much everything. You've got apps like Mint, which are awesome for super detailed budgeting. Then there's YNAB, which has this whole philosophy of giving every single dollar a job. You've even got apps like Honeydew, made just for couples, and Acorns, which is cool because it makes investing feel effortless by just rounding up your spare change.
But tech can only get you so far. For the really big decisions, the complex stuff, or serious long-term planning, you might want to bring in a professional for some expert advice.
So who do you even call?
Well, think of it like this. A financial advisor is like a general planner for your entire financial life. They'll help with retirement, insurance, the big picture. A money manager, on the other hand, is more of a specialist. Their main job is to focus specifically on managing and growing your investment portfolio.
So there you have it. We've laid out the map, we've packed the toolkit, and we've even taken a peek at the incredible view from the destination. The only thing left is for you to take that first step. Your journey starts now.
All right, let's talk trading, but not just about the flashy wins. Today, we're going to build something absolutely crucial, your personal risk management toolkit. Because let's be real, in this game, success isn't just about how much you win. It's about making sure you can survive the losses. Okay, so to kick things off, I've got a little puzzle for you. Picture this. On one side, you've got Trader A. This person is on fire, winning 3 out of every 4 trades. That's a 75% win rate. Then, over here, you've got Trader B, who, well, they're winning about half the time, a 50% win rate. So who's the more successful trader? I mean, it's got to be Trader A, right? More wins equals more money. Simple. But what if I told you the obvious answer is wrong? What if the real story here is way more interesting? And here's the kicker. It is totally possible for Trader B, the one who only wins half the time, to be way more profitable. How is that even possible? Well, think about it. If Trader A's losses are huge, just 1 or 2 bad trades could completely wipe out all those small wins. This is the big secret. Success isn't about your win rate, it's about controlling your losses. So how do you make sure you're that successful trader? You do it by building the right toolkit. Today, we're going to load you up. We'll start with the blueprint for planning your trade, then we'll add the governor to keep you safe, we'll install the eject button for getting out at the right time, and we'll finish up with a shield and some insurance for your whole portfolio. You ready? Let's get to it. All right, first up, and this is the absolute foundation of everything, we have the blueprint.
This is your master plan. It's the strategy you put together with a clear, calm head before you even think about hitting that buy or sell button. You've probably heard this one before, and for good reason. Plan the trade and trade the plan. Why is this so important? Because your emotions are the #1 enemy of a good trade. Your plan is your anchor, the thing you create when you're rational, and it's what guides you when things get chaotic. Once that plan is locked in, your only job is to stick to it, no exceptions. So, what does a real plan even look like? Well, it's definitely not just, I have a good feeling this stock will go up. No way. A real plan is super specific. It's, I'm going to buy stock X at $50 because it just broke a key resistance level. I'm taking my profits at 55 and I'm getting out if it drops to 48. See the difference? That's not trading on a hunch. That's executing a precise strategy. Anything less than that, you're pretty much just gambling. Okay, next tool in the box is the governor. And that's exactly what it does. It governs your risk. Think of it like a safety valve on your entire account. A super simple rule that makes it almost impossible for one bad trade to completely blow you up. And the rule itself? It's so simple. On any single trade, you never ever risk more than 1% of your total trading capital. That's it. That's the whole rule. But don't let the simplicity fool you. It's an incredibly powerful constraint that literally keeps you in the game for the long haul. Let's put some real numbers to this. Say you have a $10,000 account. The 1% rule means the absolute most you can lose on any single trade is $100. Right there, you've taken this big, scary, vague fear of loss and turned it into a specific, manageable number. It changes everything. And that's the whole point, right? This rule is what protects you from that one disaster trade that could wipe you out. Now, some people might stretch it to 2%, but seriously, the pros will tell you to never go above that. This kind of discipline is exactly what separates traders who last for years from the ones who burn out in a few months. Okay, tool number 3, the eject button. This is your escape hatch. It's your pre-programmed, totally emotion-free way to get out of a trade. And the key is, you decide when to push that button, both for taking profits and for cutting losses, before you even enter the trade. So, this eject button actually has 2 triggers. First, you've got your take profit order. This automatically cashes you out when you hit your target, and it's awesome because it stops greed from turning a great trade into a bad one. Then you've got the stop loss order. This is your safety net. It automatically gets you out if the trade turns against you, cutting your losses before they become a real problem. It's basically automated discipline. All right, we've covered protecting individual trades. Now let's zoom out and talk about protecting your entire portfolio. For this, we've got our last 2 tools, the shield and the insurance. These are all about big picture protection. First up is your shields, and that's diversification. We've all heard the saying, don't put all your eggs in one basket, and that's literally what this is. So if all your money is in tech stocks, maybe think about adding some healthcare or financial stocks. That way, if the tech world has a terrible week, your whole account doesn't sink along with it. It spreads out the risk. And last but not least, your insurance policy. This is called hedging. Now, this is a bit more of an advanced move, but the concept is simple. It's like buying insurance on your house. You're making a smaller, strategic move that's designed to pay off if your main investment takes a nosedive. It's not going to prevent the price from dropping, but it can seriously limit the financial damage. Okay, I need to clear something up here because this is a huge misconception. Hedging is not just making an identical opposite trade. So you can't just buy a stock and then immediately short that same stock. That does nothing. It just cancels itself out and you've wasted money on commissions. So what is a real hedge? It's a smart, strategic countermove. For example, let's say you own a stock and you love it for the long run, but you're worried about a potential dip in the next month. You could buy something called a put option. Now, if the stock does drop, the profit you make from that option can help cancel out the loss on your stock position. It's like a temporary shield to protect your main investment without having to sell it. And that's it. Just like that, you've built a powerful, professional-grade toolkit for managing risk. So let's do a quick recap of everything we just put in your new toolbox. So what have we got? You've got the blueprint, so you always trade with a plan. You've got the governor, your 1% rule to keep any single loss small. You've got the eject button, your stop losses and take profits to remove emotion. And finally, you have the shield of diversification and the insurance of hedging to protect your entire portfolio. This isn't just a collection of tips. This is a system for staying in the game. So I want to leave you with this one final thought. So many traders are obsessed with finding that next huge win, that one trade that will change everything. But the real key to success, it isn't finding the next big win. It's making absolutely sure the next loss doesn't end the game for you. And trust me, there will be losses. So the real question isn't how much can I make, it's how am I protecting what I have.
All right, let's talk about one of the biggest markets on the planet. We're going to dive into a roadmap laid out in the book Forex Trading for Beginners.
So why does everyone get so interested in this stuff? Well, the book lays the promise out right there on the cover. We're talking about earning a living, creating passive income, and doing it all from home. I mean, that's a pretty powerful idea, right? It's definitely what hooks most people in.
Okay, but how real is that promise really? The author makes a pretty bold claim in the book's conclusion, saying, the truth is that you can be making some serious cash flow within months if done correctly. Now listen closely to those last three words, if done correctly. That's the key to the whole thing, isn't it? So let's dig into what doing it correctly actually means according to this guide.
So, the book maps out a whole journey, and you know where it starts? Right at the beginning, with the absolute fundamentals. This first part is all about laying that crucial groundwork.
All right, so if you're a total beginner, where do you even start? Well, the book breaks it down into 3 really manageable first steps. Step 1, you've got to learn the pros and cons. You know, a big pro is that the market's open 24/5, but a major con, the high leverage, which can make you a lot of money, but it can also lose you a lot of money fast. Step 2, you open a brokerage account. That's your ticket into the market. And third, you got to learn the language. This is all about understanding things like currency pairs, you know, the euro versus the US dollar, and what a pip is, which is just the tiniest little price move a currency can make. These aren't suggestions, they're the absolute non-negotiable building blocks. And here's something the book hammers home, especially in the conclusion, you have got to master these basics before you even think about the fancy stuff. Seriously, trying to run before you can walk in this world, that's a classic rookie mistake, and it can be a very expensive one.
Okay, so once you've got that foundation poured and set, it's time to start building your toolkit. This next part is all about getting the core skills you need to actually look at the market and decide when to pull the trigger on a trade.
And when it comes to trading, there are basically 2 big schools of thought. On one hand, you've got fundamental analysis. Think of yourself as an economic detective here. You're digging into big picture stuff, like interest rate news or unemployment numbers. Then, on the other hand, you have technical analysis. This is all about the charts. You become a pattern seeker, looking at what the price has done in the past to guess what it might do next.
From there, the book just starts loading up your toolkit with all these essential strategies. We're talking technical indicators, different trading styles. For example, it gets into something called scalping. That's a strategy where traders try to grab tiny profits from a whole bunch of super fast trades all day long. The main point is, there's this whole arsenal of techniques out there you need to get familiar with.
But here's the thing, you can have all the best tools in the world, but if your head's not in the right place, none of it matters. And that brings us to the next super important section, mastering the trader's mindset. This is all about the psychology behind actually making a profit.
And this is a message the book really drives home again and again. Your mindset is every bit as important as your strategy. Heck, maybe even more important. It's really the thing that separates traders who stick around from the ones who just burn out.
So what does this winning mindset actually look like? Well, the guide breaks it down into 4 main pillars. First, you need a solid, consistent routine. Second, you've got to learn to manage your emotions. Fear and greed, they're your worst enemies when you're making decisions. Third, you have to master risk management. That basically means never, ever risking more than you can truly afford to lose. And finally, you wrap all of that up into a formal, written-down trading plan.
And you know what's just as important? Learning what not to do. A huge part of the right mindset is knowing the traps to avoid. The guide actually has a whole chapter on common mistakes, stuff like revenge trading when you're angry about a loss. It's all about helping you sidestep those classic and often very expensive beginner pitfalls.
All right, this all brings us to the book's final, and I'd say maybe its most important message. And it boils down to one thing: action over daydreaming.
And I want to share one more really powerful quote from the conclusion. It says, "We can't stress enough how calculated you have to be with your investments." See, that's the whole point. This isn't about rolling the dice or just hoping you get lucky. It's about making smart, deliberate, calculated moves.
So, when you boil it all down, here's what you're left with. You can read this book, you can listen to me explain it, you can absorb all the theory in the world. But the ultimate takeaway is simple. Knowledge without application is totally useless. You have to actually do something with what you've learned if you want to see any kind of result.
And that leaves us with one last question. It's really the question the entire book is asking you from start to finish. Are you ready to stop daydreaming and start calculating?
Have you ever wondered what really makes the global economy tick? Well, a massive part of it happens in a market that literally never sleeps. Today, we're going to pull back the curtain on the huge, super fast-paced world of Forex. So if you've ever been curious about how trillions of dollars are zipping around the planet every single day, you're in the right place. Let's dive in.
All right, to get us started, let me ask you a quick question just to set the scene. Forget the stock market for a second. What do you think is the single biggest financial market in the world?
You guessed it. It's Forex. And it's not just big, it's unbelievably huge. Just look at this. The amount of money that changes hands here every single day is so massive that it's more than all the world's stock and futures markets put together. It is, by far, the most liquid market on the planet.
So, what is it really? Well, at its core, the Forex market is just a giant global marketplace for all the world's currencies. It's where governments, huge corporations, and even individual investors can buy, sell, and speculate. And this isn't just some abstract thing for traders. It's the engine that powers global business. Every single time you buy something that was made in another country, this market had a hand in it.
Now here's where it gets really weird. For the biggest market in the world, there's no building. There's no Forex headquarters on Wall Street. So, how does any of it actually happen?
The secret is that everything is done over the counter, or OTC. So don't think of it like a single stock exchange. Instead, picture a huge, sprawling network of banks, financial institutions, and brokers, all linked together electronically. It's why the market can run 24 hours a day, 5 days a week. It just follows the sun around the globe.
So, here's our game plan. We're going to break down what this market really is, who the major players are, talk about the very real risks involved, cover your first steps if you're thinking about trading, and finally, wrap up with the key things every beginner absolutely needs to know.
Okay, so who's actually in this massive, decentralized playground? Who are the players calling the shots?
You've got a whole cast of characters here. You have the absolute giants. We're talking central banks and massive commercial banks that really set the market's tone. Then you have other big players like hedge funds, the retail brokers who act as the gatekeepers for us smaller folks, and of course, all the professional and individual investors.
Now, here's the crucial part. Prices are set by the big banks. They're the ones putting out the buy and sell offers based on simple supply and demand. And because the sheer volume of money sloshing around is so gigantic, it actually creates a lot of transparency. It's really hard to hide the true price when that many trades are happening every second. And this right here really puts the scale of it all into perspective. The market is so enormous that as an individual trader, you have zero power to move the price. You're like a tiny fish in an ocean. You're a price taker, not a price maker. Simple as that.
But you know, this whole decentralized, bank-run system brings us to a super important topic, especially if you're new to this, the risks. Is this whole thing just the Wild West of finance?
Which, of course, leads to the million-dollar question. If there's no single referee, no central stock exchange watching over everything, how safe is it for somebody who's just starting out? Well, the honest answer is that for a beginner, the Forex market is complicated and definitely risky. A lot of that risk comes from the fact that the rules are different everywhere you go. Some countries are really strict, but others are, well, not so much. And that means you could easily end up dealing with brokers who aren't regulated at all. And the danger isn't just theoretical. It's very, very real. Just look at this quote from our source material. In some cases, they will even trade against you and take advantage of you. Let that sink in. Your broker, the one you're trusting with your money, could literally be betting on you to fail.
So how in the world do you protect yourself? It all comes down to doing your homework. You absolutely have to investigate any broker you're thinking of using. You need to confirm that they're regulated, and just as important, where they're regulated. And finally, you have to know what happens if things go south. What protections do you have if they go broke?
Okay, so let's say you've done your safety checks and you're still interested. What are the first steps to actually trading? Well, a lot of it depends on your own financial situation.
The way you approach trading can really depend on how much money you're starting with. As you can see here, if you've got limited funds, you might be more comfortable with shorter-term stuff like day trading, getting in and out of trades on the same day, or swing trading over a few days.
But if you have more capital to work with, you can look at longer-term strategies.
But here's the thing. No matter what your strategy is, you need a very specific set of skills to succeed. You've got to understand the big picture economic stuff that moves currencies, like interest rates. And you definitely need to get good at technical analysis, which is just the art of looking at price charts to try and figure out where things might be headed next.
All right, we have covered a ton of ground, so let's boil it all down to the absolute most critical points that every single beginner needs to have burned into their brain.
So here's the cheat sheet. 1. Forex is the biggest, most liquid market in the world, period. 2. It has no central home. It's all over the counter. 3. For anyone new, it's complex and it is very, very risky. And 4. The rules are all over the place and unregulated brokers are a huge danger you have to watch out for.
If you take away only one single thing from this entire explainer, please let it be this. Your number one, most important, non-negotiable step is to do your research. Seriously, looking into your broker and understanding the rules that are supposed to protect you is absolutely crucial before you even think about risking a single penny.
And that leaves us with one last thing to think about. You've got the map now. You know the landscape. You know who the players are. And you know how it's built. But the real question you've got to ask yourself is this. Now that you know all that, are you truly prepared for the risks that come with it?
Have you ever wondered how people make or lose a fortune like in the blink of an eye? Well, today we're jumping into the wild world of Forex trading. It's a market that offers just incredible opportunities, but you guessed it, also comes with some huge risks. To get things started, let's just throw a number out there. $5 trillion. That is how much money is zipping through the foreign exchange or Forex market every single day. I mean, it absolutely dwarfs every other financial market on the entire planet. So what is it about this global behemoth that pulls so many people in? And maybe more importantly, what are the absolute must-know risks that you have to understand before you even think about diving in? All right, let's get into it. First things first, let's talk about the good stuff. We're going to look at the powerful features that make Forex trading so incredibly appealing to millions of people all over the world. Okay, so the single biggest draw, the one thing that really makes Forex stand out is a concept called leverage. You can think of it like a financial superpower. It takes the money you put in and just massively amplifies its power in the market. So here's what that actually looks like. With a 100-to-1 leverage, your $1,000 can control $100,000 worth of currency. That's huge. It means that even the tiniest little shifts in price can lead to really significant profits. But, and this is a big but we're going to come back to, this amplification is a double-edged sword. But hey, the appeal isn't just about leverage. The Forex market is also known for being incredibly accessible. You can get started with a pretty small amount of money, and because it runs 24/5 all across the globe, you get this amazing flexibility to trade whenever it works for you. Plus, the market is so massive, you can jump in and out of trades almost instantly. And here's another huge plus, simplicity. Especially when it comes to something called short selling, which is basically betting that a currency's value is going to drop. In the stock market, that can be a really complicated process. In Forex, it's super straightforward. You're just selling one currency to buy another. Easy. And because of that enormous size and all the money flowing through it, the market's daily patterns are actually more stable and predictable. So unlike the stock market, you don't usually get those crazy wild swings right when the market opens or closes, which, trust me, is a huge relief for a lot of traders. Now, this brings us to another really important point. The market is decentralized. It operates over the counter through this giant global network, not from one central location. And that structure actually helps reduce the risk of insiders trying to manipulate prices, which can be a major headache in the stock market. So with all these pros, you've got high leverage, it's easy to get into, it's flexible, it's transparent. It sounds almost too good to be true, right? Well, that, of course, brings us to the other, much riskier side of the coin. All right, let's flip this around and look at the other side of the equation. Because for every single powerful advantage in Forex, you can bet there's an equally powerful risk hiding just under the surface. The first kinda harsh reality check is just realizing who you're actually up against. This market is completely dominated by the big fish. We're talking giant banks, hedge funds, massive financial institutions. The little guy, the individual retail trader, yeah, that's just a tiny fraction of the market. And these big institutions, they have resources that give them a massive advantage. We're talking more money, way better technology, and access to information that regular traders just can't get. They can even influence price movements sometimes, which really makes this a professional's game. And beyond that power imbalance, you're facing other major risks. That same market volatility that can make you money can also trigger sudden, absolutely devastating losses. Trying to predict price moves is incredibly complicated. And that decentralized market we liked earlier, well, the downside is it means way less regulatory protection for you, the trader. A lot of a trader's success comes down to reading these things called technical indicators. They're basically complex calculations trying to predict what the market will do next. But here's the unavoidable truth. You get those predictions wrong, you lose money. Period. There's no safety net. And since there isn't one big, central regulator watching over everything, the burden falls completely on you. It's your job to do the homework, to investigate your broker and make sure they're reputable and fair. Because if something goes sideways, you might be on your own. So, when you put all this on a scale, these really powerful advantages on one side, and these very serious risks on the other, what's the final call? This is the core dilemma that every single potential Forex trader has to grapple with. I mean, you can see the conflict laid out right here. The exact same things that make Forex so tempting are also the source of its biggest dangers. That high leverage that can boost your profits, it can also magnify your losses. The easy accessibility that lets you in, it also pits you against giants. The transparency that reduces some risks, it also means less protection for you. So, can you actually succeed in Forex? The answer is, yeah, you can. But it is definitely not for the faint of heart. It requires a really deep understanding of this two-sided nature of the market and a disciplined approach that respects the risks just as much as you're chasing the rewards. And really, that leaves us with the single most important question, the one you have to answer for yourself before you ever place a single trade. Are you truly prepared for both sides of this coin? The incredible opportunity and the undeniable risk. So, you're thinking about diving into the world of Forex trading. Awesome. But before you do anything, there's one decision you have to make that's more important than any other. It's choosing your very first account. Seriously, get this wrong and you're making things way harder than they need to be. Let's make sure that doesn't happen. I mean, think about it. The foreign exchange market is just massive. We're talking trillions of dollars flying around every single day. And as an individual trader, you're going up against giant banks and huge hedge funds. It can feel pretty overwhelming. Which brings up the big question, right? Where on earth do you even begin? Well, the good news is it's not as complicated as it seems. It all boils down to one simple choice that's going to set the foundation for your entire trading journey. Okay, so you've basically got three main paths you can go down. And let's get one thing straight. We're not looking for the best one overall. We're looking for the path that is the absolute best fit for you. And here they are, your three core options: the mini account, the standard account, and the managed account. Let's break down exactly what each of these really means for you. See, the right choice isn't the same for everybody. It's super personal. It really just comes down to three key things. First, how much money are you starting with? Second, how comfortable are you with risk? And third, let's be honest, how much time do you actually have to sit and analyze the markets?
All right, let's put these three accounts under the microscope. We're going to do a little head-to-head comparison so you can see exactly how they stack up against each other.
First up, we've got the mini account. The best way to think about this is like learning to drive in a huge, empty parking lot. You're trading in these smaller mini lots, that's 10,000 currency units, which keeps the stakes really low. It's honestly the perfect place to start, and hey, even pro traders use these to test out new strategies without putting a ton of cash on the line. Okay, let's break this chart down. You can see a mini account can be started with as little as $100. The risk is low, and so is the potential reward. Then you have the standard account, which needs more capital, and as you can see, it ramps up both the risk and the potential reward. And finally, the managed account has an even higher barrier to entry, but you're handing over all the control to a pro. So just looking at this, which one of these columns feels most like you right now? Now, to make this idea of risk really, really clear, just look at this. A pip is the tiniest little price move a currency can make. In a mini account, one pip moving might mean you gain or lose $1. But in a standard account, that exact same price move means you gain or lose $10. That 10x difference, well, that's everything.
And that brings us to the standard account. So if the mini account was the parking lot, this is like merging onto the freeway. You're playing with the big standard lots of 100,000 currency units. The speed is higher, the potential rewards are way bigger, but yeah, the stakes are significantly higher too.
And here's what that risk looks like in the real world. A trade moves against you by just 100 pips, and trust me, that happens all the time. And that could mean a $1,000 loss on a single trade. You know, the biggest mistake new traders make is underestimating this and jumping into an account with way too much risk. And for a beginner, a loss like that can be absolutely devastating.
All right, third, we have the managed account. The best analogy for this one is hiring a professional chauffeur. You provide the car, that's your capital, and you tell them where you want to go, your risk and return goals, but a professional fund manager does all the driving for you.
The process is actually pretty simple. You put your money in, you talk with the manager about your goals, and then their expertise just takes over. You don't have to spend your evenings analyzing charts. They do the whole shebang on your behalf. But, of course, there are trade-offs. The pros are pretty obvious. You get professional expertise, and you save a ton of time. The cons, though, are pretty significant. You're looking at a high minimum investment, usually $2,000 or more, plus you have to pay the manager's fees, and this is a big one, you give up control. If you see a great opportunity yourself, sorry, you can't act on it. So, you've figured out what kind of account you need. The next logical question is, where do you open it? This is all about choosing the right broker to partner up with. And listen, this step is absolutely critical. Unlike the stock market, the Forex market isn't centralized. It's what they call over-the-counter, which basically just means trades happen directly between two parties instead of on some central exchange. Because of that, doing your homework and picking a reputable broker is probably the single most important decision you can make to keep your money safe. So here's a little checklist for you. You need to research their reputation and their history. How good is their actual trading platform? Do they give you any helpful tools or analysis? And most importantly, are their fees totally transparent? You have got to read the fine print to make sure there are no hidden costs that are just going to eat away at your profits. Okay, we're almost there. Now that you know the what and the where, let's quickly run through the how with a final little pre-flight checklist before you even think about trading. The process itself is usually as easy as opening an online bank account, really. You'll just go to the broker's website, confirm which account you want, give them some ID to prove you are who you say you are, and then answer some pretty standard questions about your finances and your experience. And to make that whole process go super smoothly, just have this info ready to go. It's all the standard stuff, your name and address, your tax ID, and then some basic info about your job, your income, and what you're hoping to achieve with trading. Before we wrap this up, this right here is the golden rule. If you take away one thing, make it this. Pretty much every single broker offers a free demo account where you can practice with fake money. Use it. Please use it. Test your strategies, get comfortable with the platform, and do not risk a single real dollar until you are 100% confident that you're ready. So there you have it, from the low-stakes practice field of a mini account to the totally hands-off approach of a managed one, the path you choose is completely up to you. Your trading journey is going to be unique. The only question left is, what's your first step going to be? All right, today we are going to pull back the curtain on the foreign exchange market, Forex. Our goal here is super simple. We're going to translate that confusing language of currency trading so you can finally figure out what all those numbers and symbols actually mean. Have you ever stared at a currency chart and just seen a blinking, chaotic wall of numbers? Yeah, it feels like you're trying to crack some kind of secret code, right? But what if I told you that behind all that noise, the core idea is actually surprisingly simple? Okay, see this? This is the puzzle we're going to solve together. Right now, I know, it might look a little intimidating, but you just stick with me for the next few minutes because I promise you are going to be able to read this chart like an absolute pro. For real. So here's our game plan. We're going to tackle this in 5 simple steps. We'll start with why currencies always trade in pairs. Then we'll meet the big dogs of the market and learn how to measure those tiny little price moves. After that, we'll put it all together to read a quote, and then we'll take a quick peek at what comes next. Ready? Let's do this. First things first. The single most fundamental concept in all of Forex is that currencies are always traded in pairs. Seriously, once you get this one thing, everything else just starts to click into place. So what is a currency pair exactly? Well, think of it like this. It's just a way of expressing the value of one currency in terms of another. So when you trade, you're never just buying, say, euros. No, you're also at the exact same time selling another currency, like the US dollar, to pay for them. It's like a constant financial tug of war. And these pairs, they have a really clear structure. The first currency you see listed, in this case the euro, is called the base currency. The second one, the US dollar, that's the secondary or quote currency. And this order, it's totally standardized. You're always going to see it written as EUR/USD, never the other way around. You know, this setup actually simplifies your trading decision down to just one single bet. If you buy the Euro-USD pair, you're basically betting that the euro is going to get stronger. If you sell the pair, you're betting the dollar is going to come out on top. It's really as simple as that. Okay, so we know currencies trade in pairs, but, you know, with hundreds of currencies out there, which ones should you actually pay attention to? Let's go meet the heavy hitters of the Forex world. These are what we call the majors. They all involve the world's biggest economies, and you'll probably notice, hey, nearly all of them are paired up against the US dollar. Get this, these 7 pairs alone make up the vast majority of all the trading that happens in the Forex market. So why does that matter to you? Well, it comes down to one word: liquidity. It's just a fancy way of saying how easily you can buy or sell something without the price going haywire. With the majors, there are millions of traders online at any given time, so there's always someone to take the other side of your trade. For a beginner, that's absolutely crucial for getting in and out of your positions smoothly. And just for fun, traders have given these currencies some pretty cool nicknames over the years. The British pound is called the cable. That's a nod to the old undersea telegraph cables that used to send prices between London and New York. The Canadian dollar is the loonie because of the bird on their $1 coin. Knowing these will make you sound like you've been in the game for years. So, we know which pairs to watch, but currency values move in these teeny tiny little increments. So how do traders even measure those little moves? Well, this is where a super important unit of measurement called the pip comes into play. A pip, and it stands for percentage in point, is basically the standard unit we use to measure a change in value between two currencies. So forget about dollars and cents. In the Forex world, everything is measured in pips. It's how you'll calculate every profit or every loss. So where is this thing? In most currency pairs, you're going to be looking for the fourth number after the decimal point. So in this example, 1.14671, that 7 right there, that's the pip. It's that tiny little digit where all the action happens. So if that 7 just ticks up to an 8, the price is moved by exactly 1 pip. That's it. That's the whole game. Traders live and breathe by these tiny changes. Now, just when you thought you had it all figured out, there's always an exception to the rule, right? And in this case, it's the Japanese yen. You see, because the yen has a very different value scale compared to other major currencies, its pip is in a different spot. For any pair that has JPY in it, the pip is simply the second number after the decimal. So in this example, the 7 is our pip. It's the only exception you need to remember, but trust me, it's an important one. Okay, this is it. This is the moment we've been building towards. We've learned about pairs, we've met the majors, we know what a pip is. Now let's put it all together and finally solve that mystery from the beginning. Remember this chart? It probably looks a little less intimidating now, huh? We can spot the major pairs, and those super long decimal numbers are starting to actually make some sense. So let's zoom in on the most traded pair of them all, the euro versus the US dollar. You'll notice you always see two prices. The lower one is called the bid. That's the price the broker will buy the currency from you, so it's your sell price. The higher number is the ask. That's the price the broker will sell it to you, which makes it your buy price. And that tiny little difference between those two prices, that, my friends, is called the spread. You can just think of it as the broker's fee for making the trade happen. You always buy just a little bit higher and sell just a little bit lower, and that small gap is how they make their money. So let's do the quick math. If we subtract the sell price from the buy price, we get a difference of 0.00005. Now, since a full pip is that fourth decimal place, this difference is actually half a pip. And that's it. You've just successfully read and understood a real Forex quote. See? Not so bad. So there you have it. You now have the fundamental building blocks to understand the language of Forex. But of course, the journey doesn't stop here. So what comes next? Here are a couple of key terms you're definitely going to run into. you will very quickly hear about margin. It's basically like a loan from your broker that lets you control a much larger position. Now, it can amplify your profits, but, and this is a big but, it also amplifies your losses, so it's a critical concept to understand. You'll also see the term swap, which is just the interest you either pay or earn for holding a trade open overnight. So we've covered a lot today, from pairs to pips to spreads. The world of currency is like a constant, ongoing conversation, with prices moving up and down every single second. The good news is you now understand the basic vocabulary of that conversation. The only question left is, what stories will those prices start to tell you?
Welcome to The Explainer. Today we're going to tackle a huge topic. The two big competing ways people try to make sense of the financial markets. We're talking fundamental versus technical analysis.
You know, it all really boils down to this one giant question. You look at a market chart, right? And it's just this chaotic mess of ups and downs. How in the world do you even start to predict where prices are going next? Well, to try and answer that, two totally different philosophies popped up. Think of it like this. On one side, you've got the detective, the person who's digging deep, looking for clues to figure out what something is really worth. And then on the other side, you have the chart artist, who's convinced all the secrets are right there in the visual patterns on the charts.
All right, let's start with our first contender. We're stepping into the detective's office to talk about fundamental analysis.
So, what's the detective's main goal? It's all about figuring out an asset's intrinsic value. What it should be worth based on, real-world stuff. It's like they're trying to ignore the market's noisy chatter and find the actual solid value underneath. So how do they actually do this? Well, the detective is basically on a mission to answer one thing. Is this asset overpriced, underpriced, or just right? The core belief here is that the market can be, well, a little crazy in the short term, but eventually it'll come to its senses and the price will correct to its true value. So if a country's economy is absolutely crushing it, the detective is going to bet that its currency will get stronger in the long run, no matter what weird swings happen day to day. And these are the kinds of clues pinned up on their investigation board. We're talking about the big economic indicators. These aren't just numbers, they're pieces of a story. Think about it. High interest rates, that could pull in foreign money and pump up a currency. A killer GDP report, that signals a strong economy, making its assets look way more appealing. Every single one of these is a vital clue. Now, when it's time to zoom in on a specific company, the detective breaks out a special toolkit. And inside, you've got all these financial ratios that are kind of like a forensic analyst's magnifying glass. They'll use something like the PE ratio, that's price to earnings, to see if a stock's price actually makes sense compared to how much money it's making. Each tool gives them a different angle to try and find those hidden gems the rest of the market might be missing. So what's the biggest upside to thinking like a detective? Well, it's all grounded in cold, hard facts, actual financial data you can check. It's not about feelings or squiggly lines on a chart. This gives you a really solid, systematic way to make decisions, which is perfect if you're in it for the long haul. But let's be real. Being a detective is tough work. It takes a ton of time. You're digging through these super dense financial reports for hours. And here's the kicker. Even with all that research, you're still making educated guesses about the future. And as we all know, one unexpected political bombshell can completely wreck even the best laid plans. Okay, so that's the detective. Now let's switch gears completely and head over to the artist studio to explore the world of technical analysis. The chart artist's view of the world is, well, it's the total opposite. Their philosophy is simple. All that stuff the detective worries about, the economy, politics, all of it is already reflected or priced in to the asset's current price. So why bother studying it? For them, the only thing you need to look at is the price itself. Yep. For the artist, the price chart is their canvas. The core idea is that human emotions, fear, greed, you name it, don't really change over time. So the patterns created by those emotions will repeat themselves visually right on the chart. Their tools aren't financial reports. They're things like moving averages, which basically smooth out all the noise so you can see the real trend underneath.
And a huge tool for the artist is something called volume. That's just how much of something is being bought and sold. They call it the ultimate lie detector. Why? Because if the price makes a big move and tons of people are trading, that's a strong, confident signal. But if the price moves and hardly anyone is trading, that could be a fake out, a trap.
And this really gets to the heart of why people love this approach. It's super practical. The patterns on the chart can give you these really clear visual signals for when to jump into a trade and, maybe even more important, when to get the heck out.
It's perfect for traders who need to make decisions fast. Okay, so we've met our two fighters. In one corner, we have the number-crunching detective. In the other, the pattern-finding artist. Let's put them side by side and see how they really stack up.
And this chart just lays it all out, plain and simple. Look at the data source. The detective is reading economic reports while the artist is staring at price charts. Their goals are different too. The detective is thinking long-term, like years. The artist? They're often thinking in days, weeks, or months. It's two completely different games they're playing.
So, the big question, which one is better? Should you be the detective, buried in data, or the artist, reading the market's mood?
Well, here's the thing. The smartest people in the game don't actually pick a side. It's not a rivalry. For them, it's a partnership.
And here's why that partnership is just so powerful. Think of it like this. Fundamental analysis, the detective's work, tells you what to trade. It helps you find a genuinely good, maybe undervalued asset. But technical analysis, the artist's work, tells you when to trade. It helps you nail the timing. When the what and the when both line up, bam, that's a super strong signal.
So that leaves us with one final question for you. You've met the detective and you've met the artist. Now you have to decide, how are you going to read the story of the market?
All right, let's talk about technical trading. For a lot of people, it seems like pure guesswork, right? Kind of like gambling. But today, we're going to look at it a different way. Less like rolling the dice and more like being a skilled craftsman. And every good craftsman needs one thing before they can even start.
I mean, have you ever really looked at a stock chart? It's just a crazy mess of jagged lines going up, down, and all over the place. It's pure chaos. So how in the world do successful traders see anything but noise? How do they decide when to buy or sell instead of just, panicking?
Well, here's the secret. They don't just jump in and hope for the best. They start by building a toolbox. Seriously, this isn't about some crystal ball or a lucky guess. It's about having the right set of professional tools to see what's happening, analyze it, and then act on it.
Okay, so let's pop open this toolbox and see what's inside. We're going to start with the absolute basics, the foundation. This is the gear you need just to get connected to the market. Think of it as your digital workbench.
And I'm not kidding here. Trying to trade without these essentials is like trying to build a house with your bare hands. It's just not going to work. These tools are what give you the vision and the speed you need to even have a chance. A good setup is a massive advantage.
So what's actually in this thing? Well, first up, your broker. That's your direct pipeline to the market, and speed is everything. Then you've got scanners, which are like your heat-seeking missiles for finding stocks that are making big moves. Of course, you need charting software to actually see what's going on. A news feed tells you the story behind the move. And finally, market profilers give you a peek under the hood at the real buying and selling pressure. Every single one has a job to do.
Let's just double-click on one of these for a second. The stock scanner. Imagine having a superpower where you could see the entire stock market at once and instantly spot the one or two stocks that are going wild. That's basically what a scanner does for you. It helps you find the action before everyone else piles in.
Okay, your workbench is set up, you're connected to the market. Now what? Well, now it's time to add some gauges to your dashboard. This is where technical indicators come into play. These are the instruments that measure the health of a stock.
Now, technical indicators sound super complicated, but it's really not. All it is a little bit of math that takes all that messy price and volume data and turns it into a clean, simple signal. Its whole purpose is to give you a hint about what might happen next.
And these aren't just squiggly lines on a chart. They're designed to answer the really important questions, Like, which way is this thing headed? Is it a strong move, or is it about to run out of gas? Is anyone else even trading this thing? They're basically the vital signs for a stock.
But okay, here is a huge piece of advice. When you first discover indicators, you're going to want to put like 15 of them on your chart. Don't do it. It's a classic rookie mistake that just leads to confusion and total paralysis. The real pros know. Keep it simple.
So if you can't use a million different indicators, how do you get a reliable signal? Well, the trick is to get a couple of different types to work together, like a team. Let's see how that's done. The key here isn't to find two indicators that tell you the exact same thing. I mean, that's just pointless. The smart play is to pair up indicators that give you different perspectives on the market. That's how you get a more complete picture of what's really happening. And these indicators basically fall into two camps. First, you've got your leading indicators.
Think of these as the scouts. They're out front trying to spot what might happen next. They can give you an early warning. Then you have your lagging indicators. These are the veterans. They show up a little later, after a move has started, to confirm that, yep, this trend is the real deal.
So here's the 1-2 punch. Your leading indicator taps you on the shoulder and says, hey, something might be about to change here, but you don't jump the gun. You wait. You wait for your lagging indicator to come along and say, yep, it's happening. The trend is real. This little system of checks and balances can save you from a ton of false alarms.
All right, so we've got our digital tools, we've got our dashboard gauges. There's one last crucial piece to this puzzle. It's the human element. It's the skill of actually reading the chart. And that is all about recognizing patterns.
So what is a pattern? Well, think of it as a story being told by the chart. It's a visual record of the epic tug of war between the buyers and the sellers. And because human emotions don't really change, these same stories, these same patterns, tend to repeat themselves over and over again.
To make this feel a little less abstract, let's look at a real-world example. We're going to talk about a classic, powerful pattern called the hammer. It often shows up right when a stock might be about to bottom out.
So check out the story of the hammer. At the start of the day, it's a bloodbath. The sellers are in total control, just hammering the price down, down, down. But then, something happens. At the very bottom, the buyers say, no way, and they rush in like the cavalry. They fight back with everything they've got and push the price all the way back up. That long tail at the bottom, that's the battlefield, and it tells you the buyers made a stand and won.
Now, just seeing something that looks like a hammer isn't quite enough. A smart trader plays detective. You look for clues. Is that bottom tail really, really long? Was there a huge spike in trading volume that day? And this is a big one. What happened the next day? If you can check off a few of these boxes, then you've got a much, much stronger signal on your hands.
And that, right there, is the whole toolbox in a nutshell. You've got your equipment to get in the game, you've got your gauges to measure what's happening, and you have the skill to actually read the signs and understand the stories the market is telling you. Equipment, gauges, and skills. That's the foundation.
So, we've laid out the blueprint. The tools are all right there. Your toolbox is sitting in front of you, ready to go. The only real question left is, what are you going to build with it?
All right, today we're diving into a world of trading, where success isn't measured in years or even months, but in seconds. It's called scalping, and it's all about making tons of tiny, super fast trades to stack up your profits. So let's get right into it. Yeah, you can pretty much forget everything you know about long-term buy and hold investing. A scalper's world looks like this. Dozens, sometimes even hundreds of trades in just one day. Now, each one might only make a few pennies per share, but when you do that over and over and over again with huge volume, well, those little bits can really add up to some serious gains. So what is scalping, really? Think of it this way. It's a super fast-paced strategy that's all about grabbing profits from teeny tiny price jumps and dips. You're basically making a whole bunch of trades to cash in on these little market wiggles that most other traders don't even notice.
Okay, so let's dig a little deeper into how this all actually works. What really makes scalping so different from your typical way of trading?
And this really gets to the heart of the difference in philosophy. You've got your long-term trader, right? They might buy a stock and just sit on it for 6 months, hoping for one big payday. But a scalper, they're trying to get to that same exact profit goal, but their way is totally different. They're doing it by stacking up hundreds of teeny tiny wins, all within a single day. The destination might be the same, but the journey is a world apart. So what's a typical day for a scalper even look like? Well, for most, it's a full-time job. We're talking glued to your screen during the busiest market hours. You're juggling dozens of trades at the same time, and these trades last anywhere from a few seconds to maybe a couple minutes. And you're not looking at weekly or monthly charts, no way. Your entire world is the 1 minute, maybe the 5-minute chart, trying to catch those immediate price moves. Now, as you can probably guess, this kind of intensity is, well, it's not for everyone, not by a long shot. So that brings up a really important question. Do you have the right kind of mindset for this? Let's just cut to the chase here. The real question is this. Can you actually handle the pressure? Not just for an hour, but day in, day out. Because at the end of the day, that's what this all boils down to. So, scalping might actually be for you if you're the kind of person who really thrives in a high-stress environment. If you can stay cool as a cucumber when everything's going wild. If you're someone who gets a kick out of staring at minute-by-minute charts and couldn't care less about what the market might do next year, then yeah, this might just be your thing. And this quote right here, it nails a super important point. The second you get stressed, your emotions can just take the wheel. And in trading, especially scalping, that is an absolute recipe for disaster. I mean, we're playing a game of seconds here. One bad emotional decision can wipe out the profits from 10 good trades. So emotional control, it's not just a nice to have, it's everything.
All right, let's step back a bit and look at the whole picture. It's time to weigh the good against the bad, the pros and cons of this super demanding strategy. So, on the plus side, it can be an absolute thrill. I mean, you got tons of trading opportunities popping up all day long. And since you're jumping in and out so fast, you're not really exposed to a lot of risk on any single trade. It's all about technicals, just reading the charts, not worrying about a company's 5-year plan. But the cons are pretty serious too. You're definitely going to miss out on those big long-term profit runs. And if some unexpected news hits, man, it can knock you flat before you even have a chance to react. And like we've been saying, it takes constant attention and, yep, it can be extremely stressful. Okay, so let's say after hearing all of that, you're still thinking, this sounds kind of interesting. The big question is, how do you even start to explore this world safely without, getting totally burned? Let's walk through some first steps. It really comes down to 4 crucial things for anyone just starting out. First, stick to just one strategy. Second, use simulation trading. Third, get really comfortable with the whole process. And fourth, limit your distractions.
First up, master one strategy. Just one. In an environment this fast, you don't have time to think. You have to react. It needs to be like muscle memory. If you're trying to juggle a bunch of different approaches, you're just going to hesitate. And hesitation costs money. Consistency is absolutely key.
Next, and honestly, this one's a total non-negotiable for beginners, you have to use simulation trading. It's basically like a flight simulator for the stock market. You get the real speed, the real feel, the real volatility, but you get to make all your beginner mistakes without losing any actual money. It's the perfect training ground. And this piece of advice here is golden. It's so easy to get a little cocky after a few good runs in a simulation. But trust me, the real market doesn't care about your practice rounds. It is unforgiving. So you have to start slow, get truly comfortable with what you're doing, and really, really understand the risks before you even think about putting your own money on the line.
And last but not least, you have to limit your distractions. This is a huge one, especially since a lot of people do this from home. I'm talking put the phone on silent, turn off the TV. When you're scalping, a split-second distraction can mean missing your exit. And just like that, a winning trade turns into a losing one. Your focus has to be 100% on the market, period.
So there you have it. That's scalping in a nutshell. It's a high-stakes game that's all about speed, sharp focus, and keeping your emotions in check. We've gone over the risks, and we've talked about the rewards. So, after all that, the only question left is the high-speed world of scalping calling your name?
Welcome to The Explainer. Today, we are diving deep into the world of Forex trading. Choosing the right way to trade can feel like a huge challenge. So we're going to break down the 4 main trading archetypes to help you find your perfect match.
Okay, so let's get right into it. You've decided you want to start trading. You pull up a chart for the very first time and boom, it's just this wall of blinking lights, lines, numbers, and colors. It can be so overwhelming, and honestly, it's a huge stumbling block for a lot of people just starting out. And that feeling of complexity, it's completely normal. But here's the real secret. Success in trading isn't about finding some magical, super complicated indicator. Nope, it's all about choosing a trading style that actually clicks with your personality, your daily schedule, and what you're trying to achieve. So how in the world do you find your style? Well, the trick is to stop searching for the one single best way to trade, because it just doesn't exist. Instead, we're going to explore 4 really distinct trading archetypes, and you can see which one feels right for you. So listen, the most important point is this. The most profitable strategy in the world is absolutely useless if it doesn't fit you, right? Are you someone who needs constant action, or are you super patient? Do you have all day to stare at a screen, or just an hour here and there? Let's figure it out by meeting our first archetype. All right, first up, we've got the one you've probably heard the most about, the day trader.
I want you to think of this trader as the sprinter of the market, all about quick, focused bursts of energy.
The golden rule for a day trader is really simple. You are in and you are out, all within the same day. You never ever hold a position overnight. That means when you shut down your computer for the night, you're done. Your goal is to capitalize on all those little price movements that happen within a single session. So does this sound like your kind of thing? If you love a fast-paced environment, if you can make decisions on the fly without overthinking everything, and if you can actually dedicate focused blocks of time to the charts, well, day trading just might be your style. So how does a day trader actually do it? A really popular strategy is all about identifying these key price zones on a chart, just like this one. See how the price seems to bounce off these invisible floors and ceilings? We call those support and resistance levels, and they show us where the market has turned around before. Now, what's so cool about this slide is you can see how these simple horizontal lines basically act as a roadmap. They aren't random at all. They're marking historical battlegrounds between buyers and sellers, which gives you major clues about where the price might react in the future. And right here, this is the strategy in action. You can see it plain as day in those circled areas. The price comes down, it tests a previous support level, it hangs out for a bit, and then it bounces. A day trader is waiting for exactly that moment, and they'll trade the reaction, often getting in and out within just a couple of hours. Okay, if that all sounded a little too fast and furious, let's meet an archetype with a totally different vibe. The swing trader. This person is playing a slightly longer game. You see, swing traders aren't really concerned with all the tiny little wiggles in the market. Their whole goal is to capture one solid swing in price, say from a low point to a high point or the other way around. And this means holding a trade for several days, maybe even a week, to really let that move play out. This style is pretty much perfect for anyone who has a full-time job or other things going on. You're usually looking at longer time frames like 4-hour charts, and since a new price bar only shows up every 4 hours, you only need to check in every now and then instead of being glued to your screen. Patience, that's the real key here. Okay, before we check out a classic swing trading strategy, we have to do a super quick lesson on the most fundamental tool you'll see on any price chart, the candlestick. Each one of these little candles tells a complete story. The thick part, that's called the body, and it shows you where the price opened and where it closed for that time period. And those skinny lines sticking out, the wicks, they show you the absolute highest and lowest points the price hit. So, how do we use this? Well, the strategy is to first figure out the main trend, and here it's pretty obvious the market is heading down. Then you just wait for a candlestick that confirms what you're already thinking. Now look at that circled candle. That really long wick on top is telling you a story. Buyers tried to push the price up, but sellers just overwhelmed them and slammed it right back down. For a swing trader, that powerful rejection is a classic signal to go short, which means betting on the price to keep falling. Our third archetype takes an even longer-term view. This is the trend trader, who you can think of as the marathon runner of the market, focused on the long, steady journey. The philosophy here is incredibly simple. Markets tend to move in trends, and those trends can last for a really long time. So the trend trader's job isn't to predict tops or bottoms. It's just to identify which way the market is going and hop on for the ride. A really popular tool for trend traders are these things called moving averages. They're the smooth lines you see on the chart. They help filter out all the market noise. A common strategy is called the crossover. You've got a fast-moving line, in red, and a slow-moving one, in blue. When the fast line crosses above the slow line, like you see in that top circle, it can signal an uptrend. And when it crosses below, like in the bottom circle, it might be a downtrend. The trader just follows those signals. And finally, we have our fourth archetype, the intraday specialist. You can think of this trader as a more focused, more specialized version of a day trader, someone who becomes a master of the market's most active periods. Now, the Forex market is open 24 hours a day, but it has these distinct sessions, the Asian, the London, and the New York sessions. The intraday specialist focuses all their energy on trading only during these specific times, or even better, during the overlaps when two markets are open at once and the trading volume is just off the charts. Because this style requires such quick reactions, traders often use an indicator that's just as fast. This chart shows something called the parabolic SAR, which stands for stop and reverse. See that series of dots? When the dots are below the price, it suggests an uptrend, But the moment a dot flips and appears above the price, it signals a potential reversal to a downtrend, giving the trader a clear entry point. It's designed for exactly these fast-paced conditions.
So as we bring it all together, what's the big takeaway? It's this. There is no single best style. The day trader wants action right now. The swing trader has patience for days. The trend trader is playing the long game. And the intraday specialist is a master of timing. The only real question is, which one sounds like you?
But no matter which of these archetypes you decide to explore, whether you're the sprinter, the strategist, the marathon runner, or the session master, I want you to remember this one critical thing. Your long-term success isn't going to come from a perfect strategy. It's going to come from how well you manage your risk on every single trade you take.
All right, let's talk about cryptocurrency. It's chaotic, it's exciting, and yeah, it can be pretty terrifying. Today, we're going to cut through all that noise. We're going to break down one investor's personal playbook into a simple, clear framework that you can actually use.
If you've spent any time at all looking into crypto, you know this feeling. On one side, you hear all the hype. The next big thing, we're going to the moon, stories about people making absolutely serious money. But then there's the other side, right? The dark side. Pump and dumps, manipulation, and just straight up fraud. So how in the world do you tell the difference? Look, this market is pretty much the Wild West. There aren't a lot of rules, which means there are huge risks everywhere. And honestly, a lot of people get burned. But it doesn't have to be a total shot in the dark. If you have a method, a system for the madness, you can start to actually make sense of it all. Okay, and before we go any further, I have to make something super clear. What we're doing here is exploring one person's framework. This is a case study. It is absolutely not financial advice. Think of it as a set of tools to help you build your own way of thinking about this stuff. So, where do you even start? Not with charts, not with Twitter hype, nope. The very first step, the most important one, has nothing to do with crypto itself. It's all about looking inward. You have to understand your own personal tolerance for risk before you even think about buying a single coin.
To make this really clear, let's just borrow an idea from traditional investing. You've got your lower risk investor, right? They're happy with a steady, maybe 3 to 4% return. Their main goal is just not to lose money. Then you have your higher risk investor. They're shooting for bigger gains, say 7 to 12%, and they're okay with the fact that they might lose everything to get there. There's no right answer here. You just have to be honest about which one you are.
And this right here, this quote really gets to the heart of the whole strategy. Chasing after those crazy high returns without knowing what you can handle is just a recipe for disaster. The best choice isn't the coin with the most hype. It's the one that actually fits your financial situation.
And check this out. This is what that philosophy looks like in practice. The person who created this strategy puts 90% of their crypto money into the big guys, the top 5 most established coins, the safer bets. Only a tiny 10% slice is for playing around with those riskier, smaller projects that might have that moonshot potential. That 90-10 split? That's their risk profile in action.
All right, on to the next step. So you've done the hard work, you've looked inward, and you've carved out that small 10% play money part of your portfolio. The question is, where do you even go to find these new projects?
According to this investor, there are 3 main hunting grounds. First, you've got the super old-school bitcointalk.org forum, specifically the announcements section. It's where a lot of projects still make their debut. Second, the massive community over on Reddit in the /r/cryptocurrencies subreddit. And third, just keeping an eye on the newly added sections of the big coin tracking websites. This is where you can spot things before they go totally mainstream.
And once you find something that catches your eye, you're going to need some tools to start digging. A few of the go-tos are sites like CoinCheckup and CoinMarketCap in the Blockfolio app. They're all great for tracking the basic data, price, trading volume, that kind of stuff.
Okay, listen up, because this is probably the most crucial part of this entire process. You found a few potential projects. Now, you need a really, really strict filter to just immediately toss out all the junk, the scams, and the projects that are just doomed from the start.
These are the 7 deadly sins. If a project has even one of these, it's an immediate no. 1. You can't even figure out what industry they're in. 2. The team is a ghost on social media. 3. You can't find any legal proof the company is real. 4. The team is anonymous or their LinkedIn profiles look super fake. 5. All their marketing is just aggressive spam. 6. They don't have a white paper. That's the detailed doc that explains how the tech actually works.
And 7, they're offering a massive discount before the public launch, which just encourages people to dump the coin later. Any one of these, and you just walk away.
But here's the thing. Passing that red flag test just gets a project through the front door. It just means it's probably not an obvious scam. It definitely doesn't mean it's a good investment. Now, the real homework starts, and it starts by asking yourself some really tough questions.
First question, and it's the most important one. Forget about the price, forget the hype for a second. Ask yourself, does this thing actually do something useful? Would I, as a normal person, ever have a reason to use this product or service? If the answer is no, you gotta wonder why anyone else would.
And right on the heels of that comes this question. It forces you to connect the crazy speculative price with some kind of real-world value. I mean, if the coin costs $50, but all it does is something that should cost 5 cents, there's a huge disconnect. Would a real customer ever pay the market price for what it does? Okay, so you've thought about the product. Now let's talk about the people. A great idea is completely worthless if you can't execute. So what's the team's track record? Have these people built and run successful companies before, or is this their first rodeo? What they've done in the past is a huge clue about what they might do in the future.
And finally, here's the ultimate reality check. It's easy to make big promises on a website, but does this team actually have the chops to build it? Do they have the engineers, the developers, the technical skill to turn that fancy idea into a real working product?
So let's zoom back out and pull all of this together into one cohesive idea. We've just walked through a complete, step-by-step framework you can use to size up any new crypto project that flies across your screen. It all boils down to these 3 simple steps. Step 1, look inward. Figure out your own risk profile. Your goal here is to protect your money. Step 2, look outward. Go to those specific places to find potential new projects. Your goal is to find opportunity. And step 3, look closer. Apply that super strict filter and ask those hard questions. Your goal there is just to avoid the scams.
And, if you only remember one thing from all of this, let it be this. This whole system, it isn't really designed to help you find the next 100x winner. The main goal is actually defensive. It's about building a process to systematically weed out the thousands of projects that are guaranteed to fail. If you can just avoid the losers, you give the winners a chance to actually shine.
So, there it is, a method for the madness. A way to go from this huge, chaotic market down to just a handful of projects that you've actually vetted. So the only question left is, which projects are going to pass your test?
Ever feel like your trading is just one big roller coaster? Like it's more of a gamble than an actual strategy? Well, if that's you, you're going to want to stick around. Today, we are going to break down how you can transform that whole approach from a shot in the dark into a disciplined, profitable routine. So let's get right into it. Okay, so first things first, we have got to get rid of that Hollywood image of a trader, right? The constant screaming on the trading floor, the frantic clicking, those huge heart-pounding bets. Look, it makes for a great movie, but it's pretty much a fantasy. The reality? Oh, it's something else entirely. And yeah, this slide just lays it out perfectly. The myth is all about adrenaline, gambling, excitement. But the reality, where the real money is made, it's about patience, having a solid process, and just quiet, consistent discipline. Getting this mindset shift right it's the foundation for literally everything else we're going to talk about. All right, so here's our roadmap for today. First up, we're going to cut right through the hype. Then we'll talk about finding your true north, your real why. After that, we get into the nuts and bolts, the 2 golden rules. Then we'll cover how to manage your single biggest asset. And hint, it's not the cash in your account. And finally, we'll wrap it all up with why you absolutely can never, ever stop learning. Okay, section 1, beyond the hype. Look, I'm just going to say it. Successful trading is, it's often kind of boring. A huge part of the job is just watching and waiting for your specific setup to appear on the chart. See, it's not about being in the action all the time. It's about taking precise action at the right time. So if most of trading is just waiting around, what's going to keep you in the game during those slow, boring parts? That's the real question, right? And that brings us right to section 2. Find your true north. Because I promise you, just wanting money isn't enough. You need something way deeper to anchor you. So let me ask you, really think about it. What is your real reason for trading? Because just making money, honestly, that's a pretty weak motivator. The second you get a little bit comfortable, that drive just vanishes. You've got to connect that money to a real purpose, a deep why that's going to keep you sharp when things get tough or, just plain boring. And here's a really simple way to figure it out. Start with a money goal, something concrete like, I want to pay off my mortgage. Okay, great. Now ask yourself, why? Why do I want that? Maybe the answer is something like, well, to provide security for my family. Bingo! That feeling, that sense of security, that's your true purpose. That's the fuel that's actually going to last. This is so important. This slide completely reframes how you should think about goals. Look at the left side. Making X amount of money, hitting a certain win rate. You have almost zero control over that. The market's going to do what the market's going to do. But the right side, following your risk plan, logging your trades, waiting for your signals. You have 100% control over that stuff. So focus on the process, on what you can actually control, and you'll find the results start to take care of themselves. And all of this leads to the single most important mindset shift you can make. It's all about thinking like the casino, not the gambler. See, the gambler's just hoping to get lucky on one big hand. But the casino couldn't care less about any single hand. Why? Because it knows that its process, its statistical edge, over thousands and thousands of hands, will absolutely guarantee a profit. Your job is to be the casino.
So, you want to be the casino? Perfect. But how do you actually do it? What are the mechanics? Well, it really just comes down to two simple, absolutely non-negotiable rules. So let's get into Section 3, the 2 golden rules. These are the things that will put the odds in your favor, not just on one trade, but over the long haul. Okay, rule number 1 sounds so simple, but it's where most people fail. You have to cut your losses short, period. If you messed up the entry, just get out. If a good trade goes bad and hits your stop loss, that price you decided on before you even got in, you get out. No questions asked. You never, and I mean ever, move your stop loss further away to give a trade room to breathe. That's not trading, that's just hoping. And it's how accounts get blown to pieces. And then there's the other half of the equation. Rule number 2, let your profits run. And honestly, this is usually the harder one for people to master. It takes a real plan for how you're going to take profits, and you have to test that plan. But most of all, it takes discipline to not just snatch a small profit early because you're getting nervous. That's fear talking, not your strategy. And this is exactly how you avoid becoming what's called an involuntary investor. We've all seen this happen. It's when a trade goes against you, and instead of taking that small, planned loss, you just hold on. You're hoping, maybe even praying, it'll come back. At that point, you've totally abandoned your strategy. You're not a trader anymore. You're just a gambler hoping for a miracle. Okay, so we've covered the mindset, we've covered the rules, but what's the one thing that can make all of that fall apart? That's what we're talking about in Section 4, managing your biggest asset. And listen close, because it's not your trading account, it's you. The biggest risks in trading aren't always in the market. A lot of the time, they're sitting right there in your chair. I mean, let's be real, trading is mentally draining. If you're running on fumes, ignoring your health, trying to muscle through on willpower instead of following your process, you are setting yourself up for failure. Think about it. Your brain is the most important tool you have. If it's not healthy and sharp, how can you possibly expect to execute your strategy? And this quote just hits the nail on the head. If your trading feels like a constant battle, a stressful, draining fight every single day, you're probably doing something wrong. When your process is solid and you're in a good headspace, executing your plan should feel calm, almost effortless. It's about getting into a state of flow, not trying to force things. Which leads us perfectly into our last, and maybe most important piece of the puzzle. So you've got the mindset, you've got the rules, you're taking care of yourself, but you are not done. You're never, ever done. Welcome to Section 5. Never stop learning. Because the markets are always changing, and if you stop learning, you're going to get left behind. And this slide tells a story we see all the time. It's the life cycle of the lazy trader. Stage 1, they find a system that works. Great. Stage 2, they get comfortable. They get complacent. They stop learning. Then Stage 3 happens, the market changes, as it always does, and boom, Stage 4, their system just stops working. All those profits, gone. And suddenly, they're right back at square one. You do not want to be that trader. So there you have it. We've talked about mindset, motivation, the golden rules, and taking care of yourself. A winning routine isn't some secret formula you can just buy. It's a commitment to a professional process, day in and day out. And that work, it begins right now.
So the only question left is, what's the first step you're going to take? All right, welcome back. Today, we're going to dive into what is, without a doubt, the most crucial element of successful trading. And here's a hint. It's got nothing to do with charts, algorithms, or the latest economic news. Note, it's all about mastering the market that exists inside your own head. So let me just kick things off with a question for you. What do you think is the single biggest threat to your trading account? I mean, really think about it. Is it a sudden market crash? A bad tip you got from a buddy? Some crazy financial instrument you don't really get? The real answer, well, it's a lot closer to home than you might think.
Yep, that's it. Your own emotions. Our natural, subconscious, knee-jerk reactions are, by far, our biggest liability when we're trading. You know, that ability to just recognize and manage these feelings, that's often the one thing that separates consistent success from, well, failure. It's kind of crazy how many decisions we all make based on pure feeling without even realizing it.
So let's get specific. Let's put a name to the two emotions that are constantly trying to sabotage your success. We're talking about fear and greed. Honestly, you can just picture them as these two little devils on your shoulder, each one whispering the absolute worst advice into your ear at exactly the wrong moment.
So on one hand, you've got fear. This usually creeps in when you've risked way too much money or you're just trading without any real plan. It causes that sense of panic, right? And it makes you close out a trade way too early, often right before it was about to turn in your favor. And on the other side, you've got greed. This monster shows up after a nice winning streak or just when you're feeling impatient. It pushes you to take on super high-risk trades, totally ignore your strategy for a quick profit, and, well, it almost always leads to bad decisions and losses you could have avoided.
So how in the world do you fight these things? It all starts with self-awareness. You just have to be able to recognize what you're feeling in the heat of the moment and figure out what's triggering it. This is the bedrock of emotional intelligence, and frankly, it's what separates the pros from the amateurs.
Okay, so we've identified the problem. Now let's talk about the solution. It's all about consciously building what we're going to call a winning mindset. This is the antidote to emotional trading. It's a mental framework where a logical plan always wins out over a gut impulse. And you can really see the difference here. Just look at the left side. A trader with a losing mindset is pretty much just gambling. There's no plan, they're driven by greed, and they're always over-leveraging, just hoping to hit that one big score. Now, compare that to the winning mindset over on the right. It's all about discipline. It means you follow a plan, you manage your risk carefully, and you make decisions based on logic, not on emotional highs or lows. So how do we actually build this winning mindset? Let's get practical and break it down into an actionable blueprint. We've got 5 clear rules that can be your guide. These 5 rules, think of them as the pillars of your mental fortress. They're your defense against emotional trading. So let's just walk through each one. First up, and this is a big one, you have got to abandon the get-rich-quick mentality. That fantasy almost always leads to taking on way too much risk and, you guessed it, blowing up your account. Profitable trading is a marathon of making smart, consistent decisions, not a sprint to cashing in a lottery ticket. Okay, this one is huge. Your trading money has to be disposable income. Why? Because if you're trading with money you need for rent, for groceries, you are going to be under an insane amount of emotional pressure. And that pressure forces bad, fear-based decisions every single time. It's just impossible to be objective when your basic needs are on the line. Successful traders get this. Patience isn't just about sitting around and waiting. It's an active skill. It's the discipline to stick to your plan and wait for the really good opportunities to show up, instead of just jumping on every little market wiggle out of boredom or greed. Real patience, that's a strategic advantage. Oh man, this is a classic trap that gets everyone. It doesn't matter if you just had a huge win or a really frustrating loss, the outcome of your last trade cannot have any influence on your next one. You have to ask yourself, am I making this next trade because my plan says so? Or am I just trying to win back the money I just lost? That's called revenge trading. And on the flip side, a big win can make you way too confident. Every decision has to stand on its own, based on your strategy.
And that brings us to what might be the most important rule of all. You've heard the saying, right? Failing to plan is planning to fail. It's so true here. Your trading plan is your business plan. It has to lay out your goals, your entry and exit strategy, your rules for sizing your positions, and exactly how you're going to manage risk on every single trade. This is the document that saves you from yourself when things get crazy. So, you have these 5 rules. How do you actually put them into practice and stay disciplined day in and day out? Well, there's one simple but incredibly powerful tool that brings it all together: the trading journal. Now, just to be clear, this is not a diary for your feelings. A trading journal is a professional tool. Think of it like a flight recorder for your trading. It's a system for recording all your trades, past, present, and even the ones you're planning, so you can actually look back and review your own performance objectively. So the journal's power really comes down to 3 key functions. First, it's a planning tool. It forces you to think through a trade before you click the button. Second, it's a historical record. This is so crucial for seeing your own emotional patterns over time. You know, when do you get greedy? When do you panic? And finally, it's a tool for methodology verification. It gives you the cold, hard data to prove which of your strategies are actually making you money and which ones are just bleeding you dry. So I'll leave you with this one final thought. Take a really honest look at your own trading. Are you operating with a clear, logical plan, something you can actually measure and improve? Or are you just running on gut feelings, reacting to the emotional roller coaster of the market? The answer to that question could be the key to unlocking your real potential as a trader.
Let's talk about something that sounds, well, completely backwards. In trading, what if the real secret to winning was actually getting really good at losing? It's a wild idea, but we're about to walk through a risk management strategy that can actually make you profitable even when you're wrong most of the time.
So let's just jump right in with a question that seems to break all the rules. Can you actually lose 70% of your trades? I mean, be flat out wrong 7 out of every 10 times and still come out ahead? It sounds impossible, right? But the answer is a huge, definite yes, and we're going to show you exactly how.
You know, this quote from our source material just hits the nail on the head. It tells us that being an excellent trader isn't really about predicting the future or finding some magic entry point. Nope, it's about being a master of risk management first. That's the bedrock. Everything else is built on top of that.
So to put that idea into practice, we first have to completely redefine what a trader's real job is. And spoiler alert, it's probably not what you think.
Okay, check this out, because it's a super common trap. You could have a strategy that wins 90% of the time. You feel like a genius, right? But if you don't have your risk under control, that one single loss can be so massive that it wipes out all 9 of your wins, and then some. All of a sudden, that amazing win rate means absolutely nothing.
And this leads us to a massive shift in how you need to look at things. Your number one job as a trader isn't to be a fortune teller, it's to be a world-class risk manager. Your first, last, and only priority on every single trade is protecting your capital.
So if your job is to manage risk, how do you actually do that? Well, let's look at a really practical 3-part strategy from the source material that gives you a solid framework for every trade.
The idea here is pretty slick. Instead of going all in with one big order, you split your position into 3. The first 2 are set up to automatically take some profit off the table at predictable spots. That's huge for your psychology, right? It locks in gains and calms that fear of a winner turning into a loser. Then, that third order, that's your home run hitter. You let that one run, aiming for a much bigger move. It's the perfect balance of being safe and aiming high.
And here is the absolute game changer. This is the step that makes the whole thing click. The second your first order hits its profit target, you immediately move the stop loss on your other 2 orders right to where you got in. Just like that, the rest of your trade becomes totally risk-free. The absolute worst that can happen is you break even, but your upside is still wide open.
Okay, let's get into the numbers. How do you figure out how big your position should be? And don't worry, the concept is incredibly simple.
To make this super clear, let's use an example from the source. Have a look at this chart. You can see the entry point for the trade, and down below it, the stop loss. That distance between the two, that's our risk on this particular setup.
The very first thing you do is decide on a fixed dollar amount you are willing to lose. For this example, let's say it's $100. This is such a critical mental shift. It means you know with 100% certainty your absolute maximum loss before you even think about hitting the buy button. The second number we need comes straight from the chart. We just measure that distance between our entry and our stop loss. In this example, it's 90 pips. And a pip is just a standard unit we use to measure price movement. This number is our technical risk. It's how much room the trade needs to breathe.
Now for the easy part. We just connect those two numbers. You take your maximum dollar risk, our 100 bucks, and you divide it by your technical risk from the chart, our 90 pips. And boom, that simple calculation tells you your exact position size. This makes sure that if you get stopped out, you lose exactly $100. Not a penny more, not a penny less. All right, let's get to the final piece of this whole puzzle. This is the engine that makes the system profitable, even when you feel like you can't pick a winner. Let's talk about the power of your risk-to-reward ratio.
The rule is simple, but it is everything. For every trade you take, you always aim to make at least 3 times what you are risking. So if you're risking that $100 we talked about, your goal is to make $300. This imbalance is the whole secret. Your wins are specifically designed to be way bigger than your losses.
Now let's run the math. Let's say you're on a hot streak, a 70% win rate. Your 7 wins bring in $2,100. Your 3 losses only cost you $300, so you walk away with a net profit of $1,800. Pretty good, right? But what happens if you're just average, a 50% win rate, basically a coin flip? Well, your 5 wins get you $1,500. Your 5 losses only cost you $500. You're still left with $1,000 in profit. Your big wins are just overpowering your small losses.
And now we're back to that crazy question from the beginning. What if you have a terrible 30% win rate? You're losing 7 out of 10 times. Let's do the math. Your 3 wins, they get you $900. Your 7 losses, they cost you $700. And you are still left with a profit of $200. That, right there, is the magic of a positive risk-to-reward ratio.
So what's the big takeaway from all this? It means trading successfully requires a complete overhaul in how you think about winning and losing.
And that brings us to the ultimate mindset shift. Professional trading is not some mystical art. It's a statistical job. It's a numbers game. Your goal is to find a system with a positive edge, just like the one we outlined, and then just execute it over and over again. You're basically acting like the casino. You know you'll have losses, but you also know the long-term odds are stacked in your favor.
And so that really leaves us with one final question for you to think about. In your own trading, are you the one in control, systematically managing your risk on every trade, or are you letting the random chaos of the market manage you? Because the answer to that question makes all the difference in the world.
So, you're curious about Forex trading. I get it. You hear the stories, right? Fast fortunes, financial freedom, the whole dream. But you know, behind all that hype, it's a really challenging world. And a lot of beginners, well, they stumble. So today, we're going to cut through all that noise. We're giving you a real honest guide on how to get started. And this is the important part, how to sidestep the traps that catch so many people. All right, let's get into it.
Okay, first things first. Let's just have a quick reality check. Over on the left, that's the dream that pulls everybody in. Get rich, like tomorrow. But the reality, that's what you see on the right. Successful Forex trading, it isn't a lottery ticket. It's more like a game of chess. It's a strategic game that really demands careful, painstaking planning before you even think about making a move.
And here's where it gets a little tricky. The Forex market is incredibly easy to get into. I mean, all you really need is an internet connection and a few bucks. But, and this is a big but, you can't mistake that accessibility for an easy path to getting rich. It actually creates what you could call a road full of bumps, because that super low barrier to entry is exactly why so many people jump in totally unprepared.
So, that brings us right to the heart of the issue, the common pitfalls. Now, I want you to think of these less as reasons you can't succeed and more as totally avoidable traps. Once you know what they are, you can learn to navigate right around them. And this, right here, this is the big one. The single biggest trap is this fantasy of instant success. You know, the idea that you're going to be a millionaire by next Tuesday. It's that fantasy that absolutely cripples the confidence of most beginners. Because when it doesn't happen, they get discouraged, they start making really bad decisions, and a lot of them just quit, thinking the whole thing is a scam.
And that fantasy, it creates a really powerful enemy, impatience. You want the results now, so you start taking bigger risks, or you'll just abandon a perfectly good strategy because it isn't giving you those crazy gains in the first week. In Forex, patience isn't just some nice-to-have virtue. It is an absolute requirement if you want to make a profit.
You know, this quote really just says it all, doesn't it? True success is never a lightning strike. It is built piece by piece through consistent planning and disciplined work. There are no shortcuts here, and frankly, anyone who tells you there are is probably trying to sell you something.
So here's the crucial point. When people jump in without a solid foundation, no real plan, no structure, no understanding of the basics, they're not actually trading. They're just gambling. And of course, when they lose, it's so much easier to blame the game than it is to blame their own lack of preparation. This is why building that foundation is, well, it's everything.
All right, enough about the problems. Let's talk solutions. Before we even get into charts or strategies, we have to talk about the single most important tool you have, your own mind. Winning that inner game is always the first step to winning in the market.
Just look at this comparison. When you trade based on your emotions, fear, greed, excitement, you expose yourself to completely pointless risks. You'll chase a losing trade, hoping it turns around, or you'll jump on some hot trend without doing any analysis. But rational trading? That's all about making calm, wise choices based on your strategy, not on how you're feeling at the moment.
And part of being rational is just accepting that risk is baked right into the system. I'm telling you now, you will have losing trades. It's totally unavoidable. The goal is not to never lose. The goal is to manage your losses so they don't wipe you out. If you're going in expecting some sweet ride with no bumps, you are definitely setting yourself up for a big disappointment.
And this is a question you should probably ask yourself before every single trading session. Are you stressed? Because stress leads to irrational decisions. If you had a terrible day at work or you got into a fight with a friend, that emotional baggage is going to cost you money if you bring it with you to the trading screen.
The good news is you can manage it. Here's a pretty practical list to think about, and you should see this as part of your trading prep. Exercising, getting enough sleep, even just taking a break. These aren't distractions from trading. They are essential practices for successful trading.
Okay, so we've got the mindset covered. Now let's start building out your practical toolkit. These are the concrete steps and habits you absolutely need to develop before you even think about putting real money on the line.
So here it is, a clear 4-step plan to get you started. Think of it like your pre-flight checklist. Step 1, pick your broker cleverly. That's your co-pilot. Step 2, develop your strategy. Keep it simple, maybe just focus on one currency pair to start. Step 3, understand the charts. That's learning to read your instruments. And step 4, incorporate stop losses. That is your essential safety gear. Let's break down a couple of the most critical ones for any beginner.
First up, your broker. And look, this step is so critical. There are a ton of fake brokers out there just waiting to prey on beginners with these mouth-watering deals. You have to ignore the flashy ads. Do your homework. Look for a properly authorized broker with a long, proven track record. Seriously, this one step can save you from losing everything before you even get started.
The other absolute non-negotiable for a beginner is step 4, the stop loss. This is your safety net. It's basically an automatic order you place that says, hey, if the price moves against me by this much, get me out of the trade. It takes all the emotion out of cutting your losses, and it protects your money from a catastrophic hit.
I really like this metaphor. Think of your trading skill like a knife. It gets dull when it's just left sitting there. You don't just learn about Forex one time and then you're an expert. The market is always changing. So your skills, your knowledge, your strategies, all of it needs to be sharpened continuously through learning and practice.
And here's what that sharpening routine actually looks like. First, learn slowly. Start small. Don't rush it. Next, practice consistently. Use a demo account, they're free, to perfect your skills without risking a single penny. And finally, always be upgrading your knowledge, analyzing trends, reading the news. Just stay curious. So let's bring all this together. The journey we've been talking about, it isn't just about learning a new skill. What this really is, it's about a fundamental transformation in how you approach the market.
And this right here is the key takeaway. If you remember one single thing from our time together, let it be this. Forex trading is not sports betting. It's not about hunches or getting lucky. It is a strategic game. And just like any good strategist, you have to do your planning. You have to evaluate your moves, and you have to manage your risks before you ever take action.
So, I'll leave you with this question. Just about every major broker offers a free demo account where you can practice with zero risk. So the barrier to learning isn't money, right? It's just your time and your willingness to learn.
So the question is, what are you going to do with that opportunity? What's your first move going to be?
All right, let's talk trading. What's the real difference between the pros and everyone else? Well, we've dug into the final chapter of a pretty serious trading guide to pull out the absolute essentials. We're going to break down the core principles that can totally change your game. So let's just jump right in with a big question. What do you think is the one single metric that almost every new trader gets completely wrong? I'm talking about something that gives them a totally skewed idea of how they're actually doing. The answer, it turns out, is something the author calls the real success formula. And it's all about moving away from that one simple number that, makes you feel good, but can be super misleading. It's about getting a much clearer picture of what's really happening with your performance. Okay, so here it is. The big trap is focusing only on your win rate. I mean, it sounds amazing to say, I win 80% of my trades, right? But that number by itself is pretty much useless. The true formula, the one that actually matters for your bank account, is your win rate plus your average win. Just think about it for a second. You could win 9 trades and make $10 each. That's $90. But then you have one single loss of $100 and poof, you're in the red. See, you have to look at both pieces of the puzzle. And that idea leads us straight into the next major principle. And this one is absolutely non-negotiable: protecting your capital. Because look, before you can even think about making money, you got to make sure you don't lose it all. The number one rule is to stay in the game. So here's the bottom line. Your goal for what's called risk of ruin, which is just a fancy way of saying the chance you'll completely blow up your account, that goal has to be 0. Not 1%, not even 0.5%. 0. That's it. This is the bedrock. Everything else is built on top of this.
Okay, so how on earth do you get to 0% risk of ruin? It's actually pretty simple. You always fix your risk on any single trade a few notches below whatever your absolute max is. Why? Because this gives you a buffer. It's a safety net for all the dumb mistakes we all make. Like a fat finger trade where you accidentally add a 0, or making a trade when you're angry. That little bit of extra room, it's there to protect you from yourself.
All right, so we've got our risk under control. Now what? How do we actually put a new strategy into action? Well, the guide lays out this really straightforward but super powerful 3-step framework. And honestly, you should think of this as mandatory. It's a really logical progression. First up, simulation. This is where you just grind. You ramp up your screen time, you see as many setups as possible, and you build those skills fast. Step 2, you move to a demo account. Now you're using fake money, but you're in the real live market, testing to see if your strategy actually works. And only then, only after you've proven you can be profitable in demo, do you even think about moving to a live account with your real hard-earned cash. You just don't skip these steps, period. And just to give you some context here, it's really important to know where this advice is coming from. These aren't just some random tips somebody threw together. This is the final chapter, the big conclusion of a guide that covers the whole shebang, from the history of options all the way to advanced trading psychology. So what you're getting here is the distilled wisdom from all of that. Okay, so we've got the success formula and the 3-step framework down. So what's next? Let's talk about the tools and the daily habits that are going to support all of this and really drive your improvement over the long haul. So, what are the real keys to getting better consistently? Well, according to the author, it all starts with the one tool that struggling traders almost always ignore: a trading journal. But just having one isn't enough. You have to be disciplined. That means logging every single trade, tracking all your important numbers, and this is huge, being proactive. You need to be the one refining your system, not just reacting to whatever the market throws at you. And this next quote, I really want you to let this one sink in. Remember, the things you track are the things you can improve. It's so simple, but so profound. If you're not tracking it, why you got in, why you got out, how you were feeling, there is literally no way for you to improve systematically. You're just guessing. Which brings us to our last big idea, and honestly, this might be the most important one of all, because you can have the best system, the best tools on the planet, but none of it matters without the right mindset. Trading is a skill, and it demands some serious psychological discipline. So think of these as your personal rules for mental toughness. First, you have to schedule regular breaks. You need to step away to avoid burning out. Second, if you're stressed or mad or just not mentally there because of stuff in your personal life, you don't trade, full stop. And finally, you have to get it through your head that you are not a slave to the market. Your time away from the charts is just as crucial as your time staring at them. I know so many traders feel that pressure, that FOMO, that fear of missing out. You think, man, if I take a day off, the market's going to make a huge move without me. But the author says this is a huge mistake, a fundamental error in thinking. Guess what? The market will be here tomorrow and the next day. Use that time off to your advantage. Go work on your strategy, review your journal. That's how you get better. And let's wrap this up with the author's final piece of advice, which is pretty powerful. Trading is not a lottery ticket. It's not a get-rich-quick thing. It's a craft. It's a profession. And if you give it the respect it deserves, if you bring that discipline every single day, well, the rewards can be beyond anything you've ever dreamed of. So, I'll leave you with this one last question to really think about. Take a hard look at what you're doing every day. Are you building a professional, repeatable process that's built to last? Or are you just chasing the dopamine hit of the next winning trade? The answer to that question is going to define your entire trading journey.
You ever look at the stock market and just feel kind of locked out? Like you need a mountain of cash just to even play the game? Well, today we're going to pull back the curtain on something that can completely flip that script. Options. We're going to break down what they are, why they are absolutely not just for the pros on Wall Street, and how they can give you a totally new way to look at the market.
So let's just start right there with that big looming question. Do you really need to be rich to invest in stocks? I mean, it's a fair question, right? Especially when you see these giant companies, the ones that literally shape our lives, and their stock prices are in the hundreds or even thousands of dollars per share.
And that feeling of being priced out, that's just one piece of a much bigger puzzle. A dilemma, really. The classic buy low, sell high strategy has its own set of frustrations, and we've got to understand those first before we can talk about the solution.
Okay, let's get into it. First off, just buying a decent amount of stock in a great company costs a lot of money. A lot. And when you do that, you're putting all that cash at the mercy of the market's every little whim and wiggle. And that up and down churn, it can be a total emotional roller coaster. Basically, when you just buy stock, you're making a single bet that the price is going to go up. That's it. And trying to stomach the dips can be seriously stressful.
But what if there was another way? A way to get in the game with way more flexibility? A way that gives you more choices, more control, and yeah, a much, much lower price of admission. This is exactly where options trading comes into the picture.
So, what in the world is an option? Let's keep it simple. An option is basically a contract. It gives you the right but, and this is the key part, not the obligation to buy or sell a stock at a set price for a certain amount of time. You know what it's like? It's like insurance. You pay a little bit of money, a premium, for an insurance policy to protect your house or your car. Options are kind of the same thing. You can pay a premium for a contract that can help protect your investments if the market takes a dive or set you up for a potential gain. It's all about managing risk and opening up new possibilities.
And that unique setup gives options some seriously cool advantages. I like to think of them as their 3 superpowers, and these superpowers directly tackle the biggest headaches of regular old stock investing. They open up a whole new playbook.
Okay, superpower number 1. And this is a total game changer. You are not just betting on the market going up. Nope. With options, you can use strategies that let you profit whether a stock is going up, down, or even if it's just going sideways, doing nothing. Second, as you're about to see, they are incredibly efficient with your money, which means you can get started with way less cash. And third, all the new trading platforms have made trading options easier and more user-friendly than they have ever been.
Let's just double down on that money point for a second. You really don't need a fortune to get in the game. You can open many brokerage accounts that let you trade options with $1,000, sometimes even less. This just shatters that huge barrier to entry that keeps so many people sitting on the sidelines.
All right, now for the main event. Let's get to the single most powerful idea in options, the thing that makes them so incredibly different from stocks. This is the concept that when you first get it, it creates a genuine wow moment. I'm talking about leverage, and let's see exactly what it looks like. Okay, just look at this. This is a real-world example using Amazon. If you wanted to buy 100 shares of Amazon stock, you'd have to shell out over $200,000. But what if you didn't want to own it, you just wanted to have a shot at profiting if its price goes up over the next month? Well, instead of buying the stock, you could buy one option contract that lets you control those exact same 100 shares. And that contract would cost you about $2,775. Just let that sink in.
That's a 98.6% reduction in the cash you need to put on the table. Think about that. You're controlling the exact same amount of stock. You're in a position to profit from its movement, but you're doing it with a tiny fraction of the money. That is the magic of leverage. You get to participate in the upside of an asset without the crushing cost of actually owning it. And that frees up your money for other things.
And hey, this isn't some one-off trick that only works for gigantic stocks like Amazon. Look at Cigna here. To buy 100 shares, you're looking at almost 18 grand. But an option to control those same shares, 341 bucks. This principle, this idea of leverage, it works across the board. It's a powerful tool no matter how big or small your account is.
So this quote here, it just nails it. Options give you another way. They give you relief. They're a strategic tool to help you deal with the crazy swings in the market and the huge cash requirements of just buying stocks. It's all about having more tools in your financial toolbox.
Now you might be thinking, okay, all this power and flexibility, there's got to be a catch, right? And yeah, there is. It's a big one. You have to be willing to learn. Options definitely have more moving parts than stocks, but the path to understanding them isn't some impossible mountain to climb. It's a journey you can absolutely take, one step at a time.
So here's what that path looks like. First, you just learn the language. The basic terms are your foundation. Simple enough. Second, you start to understand the mechanics, how these contracts actually work, how they move. And third, and this is without a doubt the most important part, you have to master risk management. This isn't just a friendly tip, it's the absolute line in the sand between people who have long-term success and those who don't.
So, let's just wrap it up. We've seen that you don't need to be a millionaire to get started in the market. We've seen how options give you this incredible power of leverage, letting you control big-name stocks for a fraction of the cost. And we've seen there's a clear, manageable path to learning how to do all this the right way. The question isn't whether options are powerful. We know they are. The real question is this. You've seen the power. Are you ready to learn the playbook?
Welcome to The Explainer. Today, we're going to dig into the wild 2,000-year-old story of a single financial idea that has built massive fortunes, absolutely crashed economies, and continues to shape our world today.
So what's the connection? Well, it's something called an option. And believe me, it's a powerful financial concept that has been at the center of genius, greed, and our endless quest to control the future for millennia. All right, so before we dive into the crazy history, let's get this straight in our heads. An option isn't about owning the thing itself. It's about owning the opportunity, the choice to buy or sell it later. You have the right, but you're not forced to. That little distinction, it's the key to this entire story. Now, you might think our story starts on Wall Street, right? Nope, we're going way, way back to ancient Greece with a philosopher who used his knowledge of the stars to make a killing on, of all things, olives. Yeah, you heard that right. The very first options trader we know of wasn't some slick financier, but an astronomer and mathematician named Thales of Miletus. And by looking at weather patterns, he spotted what he thought was a once-in-a-lifetime opportunity. Okay, so here's the genius of what he did. Thales realized he didn't actually need to own all the olive presses, which would have been incredibly expensive. He just needed to own the right to use them. So he paid these small deposits to lock them all up for the future. And when his prediction came true and that massive harvest hit, everyone needed a press. And who controlled them all? He did. He then sold his rights for a huge profit. And that, right there, is financial leverage, in a nutshell. Using a little bit of money to control a much, much bigger asset. So after Thales, this whole idea kind of goes quiet for a long, long time. Centuries, in fact. But then it comes roaring back to life in 17th century Holland, and this time the whole story centers around a beautiful but dangerously desirable flower. Believe it or not, tulips became the ultimate status symbol, like a supercar is today. It all started out pretty sensibly, actually. Dutch dealers started selling options on tulip bulbs so that growers could lock in a price for their future harvest. It was just a practical business tool. But you know how these things go. It didn't stay a practical business tool for long. Oh no, it turned into an absolute speculative frenzy. We're talking about people from every walk of life mortgaging their actual homes just to buy options, betting that the price of these flowers would go up forever. And then, pop, the bubble burst. Prices didn't just fall, they crashed. In the panic, fortunes were wiped out in an instant. People lost everything, and the entire Dutch economy was devastated. This single event completely cemented the reputation of options as being nothing more than a dangerous speculative gamble. The crash from the tulip mania wasn't just a little blip.
It was catastrophic, and it left a deep, deep scar, a fear of options that would hang around for well over 100 years. People were so spooked by what happened in Holland that authorities in London decided to take this really drastic step. In 1733, they just outlawed options trading completely, banned it. And that ban, all driven by the fear of another bubble, stayed in place for over a century. But you can't keep a powerful idea down forever, right? Eventually, it hopped the pond and landed in America, and boy, did it find a home in the completely unregulated Wild West of early American finance. And this is where a guy named Russell Sage enters the picture. He sees an opportunity, buys a seat on the New York Stock Exchange, and starts offering the first American-style options: calls, which are basically bets a stock will go up, and puts, which are bets it will go down. He created this huge, booming market, but it was all over the counter, meaning there were no exchanges, no guarantees, just deals made between two parties. But let me tell you, these early options were a total mess, a real free-for-all. Every single contract was unique, which made them almost impossible to sell to someone else. And with zero regulation, it was just an incredibly risky game for anyone who dared to play. And despite all that risk, Sage made an absolute fortune. He died with around $70 million. But here's the kicker, a real twist in the story. He himself actually quit trading options after he got crushed in the market crash of 1884. So even the guy who basically created the market got burned by it. So we've had this century of just unchecked, chaotic trading. It was clear that something had to change. The system was crying out for some structure, some rules, some kind of safety net. And that brings us to 1973. This year was a total game changer for options. Two major players stepped onto the scene to finally bring some order to the chaos and create the modern market that we recognize today. So how did they do it? Well, it was a brilliant two-part solution. First, the Chicago Board Options Exchange, or CBOE, came in and standardized everything. Every contract now had the same terms. Second, the Options Clearing Corporation, the OCC, stepped in to act as a middleman, a referee, for every single trade, guaranteeing that if you won, you would get paid. All of a sudden, the market was safer and way more accessible for everyone. And this new framework, it literally changed everything. Suddenly, with these rules in place, with standard terms, public exchanges, and guaranteed trades, options went from being this wild speculative gamble to being a legitimate strategic tool that investors, both big and small, could use. So when you look back at this incredible 2,000-year journey, from a philosopher's simple bet on olives to a massive global market, you see this constant battle between financial innovation and just plain old human nature. The story has been a long road from chaos to order, but it leaves us with one really big question. Have we finally figured out how to tame risk, or is another tulip mania always just around the corner?
All right, let's talk about options trading. I know, it can sound super complicated, right? But stick with me, because we're going to break it all down into a few simple building blocks. By the end of this, you'll have a really solid foundation for how this whole world works.
So let me ask you this. What's really the difference between just taking a wild guess and having a real strategy? Well, it all comes down to one thing: knowledge. And that's our whole goal here today, to give you that core knowledge so you can see that options aren't just some financial shot in the dark. They're a seriously powerful tool when you know how to use them.
Think of it like any game. The market has its own rule book. So we're going to start with the absolute basics, learning how each piece on the board moves. Because once you get those core concepts down, the rest of the game just clicks. It starts to make a whole lot more sense.
Okay, first things first, let's dissect an option contract. What are its core components? It's kind of like learning the parts of a car engine, right? You gotta know what the spark plugs and pistons are before you can understand how the whole thing actually runs.
All right, component number one, the strike price. This is super straightforward. It's the fixed, agreed-upon price to buy or sell the stock. Just think of it like an anchor. It's set, it's locked in, and it doesn't change, no matter how much the stock's actual market price is bouncing around.
Next up, we have the premium. And this is just the price of the ticket. It's what you pay to buy the options contract itself. Now, this is crucial. It's the cost of buying the right to make a trade, but, and this is a big but, not the obligation. You're basically paying for flexibility, for the choice to act later on. That's what the premium gets you. And the last core component, the expiry date. Every single option has a shelf life. They are totally time sensitive. Once this date passes, poof, the option is worthless. It just becomes void. This ticking clock is an absolutely critical piece of the puzzle when you're trying to figure out an option's value.
Okay, so we've got the basic parts down, right? Strike price, premium, expiry date. Now let's get into the fun stuff, the different flavors of options. Because they're definitely not a one-size-fits-all kind of thing. They get categorized based on things like when and how you can actually use them.
So the first big way they're split up is by style. And really, it just boils down to flexibility. With American-style options, you can exercise your right pretty much any time you want before it expires. But European-style, they're much more rigid. You can only exercise them on the exact expiry date. And believe me, that's a huge difference when you're building a strategy.
And you know, it's not all about individual stocks like Apple or Google. Oh no, you can trade options on huge market indexes like the S&P 500. You can trade them on currency pairs, like the euro versus the dollar. You can even get into futures and commodities. It really shows you just how incredibly versatile these things are.
The timeline is another big differentiator. You've got your short-term stuff, like weekly options, which are really for the more active traders. And then way on the other end of the spectrum, you have something called LEAPS. That's a fun acronym, right? It stands for Long-Term Equity Anticipation Securities. These bad boys can last for years, and they're typically for investors who are playing a much, much longer game.
Okay, this next part is where things get really interesting and, well, dynamic. See, an option's value isn't just fixed. Its state is constantly changing. It all depends on where the stock's market price is relative to your option's strike price. So let's take a look at what that actually means. Now, I know this table looks a little intimidating at first glance, but trust me, this is the key to everything. This tells you if your option is winning or not. Let's just walk through a quick example. Let's say you have a call option, which gives you the right to buy a stock. If your option is in the money, that just means the stock's current market price is higher than your strike price. So if you have the right to buy a stock at $100 and it's currently trading at 110, boom, you're in the money. Make sense, right? Now, if that same stock was trading down at $90, your option would be out of the money. And if it's sitting right at $100, well, that's called at the money. Knowing this state is how you figure out if your option has any real built-in value at that moment.
So, we've talked a lot about the contracts themselves, right? But who actually makes all this happen? There's this whole ecosystem of players working behind the scenes to make sure the market runs smoothly. So let's pull back the curtain and meet them. First, you've got the broker. This is your personal gateway to the market. They're the ones who give you the platform, the tools, the charts, all the stuff you need to actually place a trade. For pretty much all of us, the broker is our main point of contact with the options world.
Then you have the market makers. And honestly, these guys are kind of the unsung heroes of the whole operation. Their entire job is to provide liquidity. What does that mean? It means they are always standing there ready to both buy and sell. This is so important because it ensures that when you want to make a trade, there's almost always somebody on the other side to trade with. Without them, the whole market would just grind to a halt.
And finally, the entity holding this whole thing together, the Options Clearing Corporation, or the OCC. You can think of them as the ultimate guarantor, or the referee. They stand in the middle of every single trade and make sure that all the contract obligations are met. They provide the trust and stability that the entire system needs to function. To put it simply, they're the ones who make sure the winners actually get paid.
And this kind of brings us full circle, right back to where we started. Remember, knowledge is power. There are organizations out there like the Options Industry Council, the OIC, whose entire mission is to provide educational resources. It just goes to show how important it is for everyone to understand the risks and the potential rewards before jumping in.
So there you have it. We've laid out the basic building blocks, right? We've looked at the anatomy of an option, the different types, and all the key players who make it work. You've basically got a foundational map to the world of options now. So the only real question left is, where are you going to explore first? Thanks so much for joining me.
Okay, so when you get into investing, there are really two main paths you can go down. One is that well-worn road, the one everybody's familiar with. But the other? That's a totally different beast. A winding path packed with complex strategies and, yeah, some pretty incredible opportunities. We're talking about stocks versus options. And if you've ever found yourself wondering which path is right for you, you're in the right place. We're about to break it all down.
You know, at the end of the day, choosing between stocks and options says a lot about your personality as an investor. Are you someone who wants to bet on a company's long-term vision? Or are you more of a strategist, someone who gets excited by the day-to-day movements of the market? By the time we're done here, you're going to have a much clearer idea of where you fit in.
Look, it doesn't matter if you've been doing this for years or you're just getting your feet wet. The goal is always the same, right? Grow your wealth, make a profit. But how you get there, well, that's where things get interesting. Think of stocks and options as two completely different vehicles, each designed to get you to that destination, but each with its own rulebook and, for sure, its own set of risks. So let's start with the one most people know, stock trading. For a lot of folks, this is investing. But even if it feels familiar, it's worth taking a quick look under the hood to see how it really works. Basically, stock trading is all about ownership. Simple as that. You're buying a tiny piece of a company, hoping that the whole thing becomes more valuable over time. When you decide to sell, your profit is just the difference between what you paid and what you sold it for. It's really direct, it's intuitive, and it's easy to understand. And the flip side? The risk is just as direct as the reward. If that company starts to struggle, the value of your shares goes right down with it. And in a worst-case scenario, and it does happen, the stock price could literally drop to zero. If that happens, your entire investment is gone. Poof. All right, now let's pivot and step into the world of options. If stocks are all about ownership, then options are all about control. See, an option is a contract. It gives you the right, but, and this is key, not the obligation, to buy or sell a stock at a set price before a set date. This one little difference completely blows the doors open to a whole universe of new strategies. And here's where it gets really different. When you buy a stock, you're making one bet. You think it's going up. With options, you have to be a bit of a forecaster. You have to predict not just if a stock will move, but also how far it's going to move, and by when. It's like a three-dimensional chess game that demands a much, much deeper analysis. So to handle all this complexity, you need a special set of tools. They're called the Greeks, and they're basically a handful of variables that help you measure and manage risk in ways that are just impossible with stocks. Seriously, think of them like the dashboard in your car, giving you all this real-time data on your position. Stock traders just don't have anything like this. Okay, first up, we've got theta. This one measures how time is impacting your option's value. Every single option has a ticking clock, an expiration date. And as you get closer to that date, the option's value starts to melt away, kind of like an ice cube on a hot day. Theta tells you exactly how much value you're losing every single day. It's a constant reminder that time is not your friend when you're buying options. Next is delta. Think of this like your options speedometer. It tells you how sensitive your options price is to a $1 move in the actual stock. So a high delta means your option is going to react really strongly to price swings, while a low delta means it'll be a little more chill, a more muted reaction. And if delta is the speedometer, then gamma is the accelerator pedal. It measures how fast your delta changes as the stock price moves. And this is a huge deal. It means your exposure to the stock isn't this straight, predictable line. It can speed up or slow down depending on what the market's doing. This kind of dynamic risk is something you just don't get with stocks. Our last Greek for today is vega, and this one measures how sensitive your option is to volatility. This is a really unique part of options trading. It means you can make a trade not just on where you think a stock is going, but on how much you think the market expects it to move. With vega, you can literally trade on uncertainty itself. How wild is that? So, you can already see that with tools like the Greeks, options are just playing a different game. Now that we've got the basics down, let's really put stocks and options side by side in a head-to-head showdown. Comparing their risk and reward profiles should give you a way better feel for which one clicks with your style. All right, let's talk risk, because this is where things get really different. With stocks, it's straightforward. Your risk is tied directly to what your shares are worth. With options, it's more complicated. If you just buy a simple option, your risk is defined. You can only lose what you paid for it. But with more advanced strategies, you can get into some amplified, sometimes even unlimited risk. The big takeaway here is that with options, you choose your own risk level based on your strategy. And it's not just about risk, right? There are other practical things to think about. Investing in stocks can be a totally passive, set it and forget it kind of thing. Options trading, though, by its very nature, you have to be hands-on. You've also got different costs to think about, and the tax man comes into play differently too, which can definitely affect your bottom line. But this is where options really flex their muscles, strategic power. You can combine different options to create things called spreads, which let you precisely dial in your risk and reward. Or you can use options as insurance, a way to protect your stock portfolio if you think the market's about to take a dive. These are incredibly powerful tools that a pure stock investor just doesn't have in their toolkit. So, we've gone over the mechanics, the risks, the rewards, but you know what the most important piece of this puzzle is? It's you. Let's talk about what kind of investor profile is a natural fit for stocks, and who's built for the world of options. So which one sounds more like you? Are you the steady tortoise, preferring a simple, direct, long-term approach, just patiently waiting for your investments to grow? Or are you more like the nimble hare, someone who actually enjoys the strategic puzzle, who likes watching the market and wants to jump on those shorter-term opportunities? There's no wrong answer, but they are very different mindsets. As you can probably tell by now, there's no secret formula here, no single better choice between stocks and options. It all comes down to a personal decision. It depends on your financial goals, how much risk you're comfortable with, and frankly, how much you actually want to be involved with the market. You know, there's a fantastic line from the source material that just nails the whole spirit of options trading. It says that for the person who knows what they're doing, the fact that options are so different is something to be thankful for. That complexity, it's not a bug, it's a feature. For the trader who's willing to learn, that very complexity is what opens up a world of new possibilities. So there you have it. We've looked at two very different ways to build your wealth: the direct road of ownership with stocks and the strategic frontier of control with options. You've got the tools now. You know the differences. The real question is, how are you going to build your portfolio? Are you content to just own a piece of the future, or do you want to be the one actively shaping your financial destiny? The choice, as they say, is yours.
All right, let's dive right in. Today, we're going to tackle a question that every single options trader has to ask themselves. What do you actually do after you've placed your trade? Because getting in is just the start. The real art is in managing that position.
So you did it. You did all the homework, you picked your strike, you pulled the trigger, and you're in the trade. But now what, right? That moment after you enter a position, well, that's where the real game is played. It's often the difference between a fantastic win and, a painful lesson.
And this is the absolute key. See, true success isn't just about making the right call. It's all about how you manage it from there. It's about having a game plan before things get chaotic. This is how you protect your profits from vanishing, and, just as important, how you stop a small loss from turning into a big one.
Okay, so let's get practical. Let's talk about the first big tool we can put in our toolkit. It's a tactic called rolling. And I want you to think of this as your number one defensive and sometimes offensive move.
So what exactly is rolling? Well, at its core, it's pretty straightforward. You're basically closing out the options position you have right now, and at the exact same time, you're opening up a brand new one. You do this when your main idea about the stock hasn't really changed, but you need to adjust your position a little, maybe to lock in some profit, or just to give yourself more time or breathing room.
So what does this look like in the real world? Let's say you bought a call option and boom, the stock takes off just like you hoped. You could roll up. That means you sell your now profitable option and buy a new one with a higher strike price. See what that does? It lets you pocket some of your winnings while still staying in the game. Now on the flip side, what if a stock is moving against you? Maybe you sold a call and the stock is dropping. You might roll down to a lower strike to adjust to the new reality. But here's the thing. Knowing how to roll is one thing. Knowing when to roll, that's the real skill, isn't it? And for that, you've got to learn how to read the signals the market is giving you. Which brings us perfectly to our next topic, decoding candlestick charts. Think about it like this. How do you actually read what the market is trying to tell you? Well, one of the best ways is by looking at these things called candlesticks. I want you to think of each candle as a little chapter in a story for a specific amount of time, a minute, an hour, a whole day. It's basically a picture of the epic battle between the buyers, the bulls, and the sellers, the bears. So let's break one down real quick. You see that thick part? That's the body. It shows you where the price opened and where it closed for that period. Then you have those thin lines sticking out the top and bottom. Those are the wicks, or sometimes people call them shadows. They show you the absolute highest and lowest prices the stock hit. So in one single glance, you get the entire story.
Let's stick with that battle analogy for a sec. The body? That's the main battlefield. The wicks? That's how far each side pushed into enemy territory.
And the color? Well, the color tells you who won that specific battle. If it's green, it means the price closed higher than where it started. The bulls won that round. If it's red, the price closed lower, a victory for the bears. Simple as that.
Okay, so now that we know the individual words, which are the candlesticks themselves, we can start to see how they form sentences and phrases. I'm talking about patterns, and spotting these patterns can give you some seriously powerful clues about where the market might be heading next.
Learning to spot these repeating shapes is honestly a fundamental skill. Now, I gotta be crystal clear. No pattern is a 100% guarantee. That's just not how trading works. It is all about playing the probabilities. And recognizing these patterns just helps you make a much more educated guess about what might happen.
Let's look at a classic. This one's called the bullish engulfing pattern. So, picture this. The price has been going down, and then you see a small red candle, followed by a big, powerful green candle whose body completely swallows up or engulfs the red one before it. What's that tell you? It's a huge sign that the sellers are running out of gas and the buyers are stepping in with some serious force. This could be the start of a whole new uptrend.
And for a powerful bearish signal, you'll want to look for the 3 black crows. This pattern is just what it sounds like. 3 long red candles, all in a row, with each one closing lower than the last. It's a pretty strong warning sign of a potential downturn. And get this, the source material suggests this pattern can predict lower prices with up to 78% accuracy. Now that is a statistic worth paying attention to.
Okay, so you can read the candles and you're starting to spot the patterns. But now what? How do we make this stuff actually actionable? Well, it's time to build a concrete trading strategy around it.
The most important word here, and I really want you to burn this into your brain, is confirmation. You can't just jump the gun the second you think you see a pattern forming. You have to wait. You have to let the market prove your idea right. That little bit of discipline is what separates impulse from strategy.
So here's a simple 5-step framework you can use. First, you spot a potential reversal pattern. Second, you identify a key price level, what traders often call the neckline. Third, and this is super important, you wait for the price to actually break through that neckline. Fourth, you're still waiting. You wait for the next candle to confirm the new trend. And then, and only then, do you move to step 5. You place your order with a clear target already in mind.
You know, after all these tactics and patterns, it's so easy to start searching for that one perfect trick, that magic bullet that always works. But the truth is, it doesn't exist. This quote really nails it. Rolling, reading charts, they're just tools in your toolbox. Your success in the long run really comes down to your mindset.
Ultimately, it's about building those foundational habits. It starts with education. And hey, you're doing that right now. It takes consistent practice, ideally in a demo account where you're not risking real cash. It demands the discipline to actually follow your own rules and the open-mindedness to see possibilities. These habits are what make all the other tools actually work.
So, there you have it. We've covered rolling positions to help you manage your trades and reading candlesticks to help you time your actions. These are your first big tools for becoming a more proactive, more strategic trader. So the only question left is, which one are you going to focus on and master first? Thanks for joining me.
All right, let's jump right into the wild, high-stakes world of binary options. You know, it's a way of trading that on the surface feels almost too simple, like a straight-up yes or no bet. But as we're about to find out, that simplicity, it's hiding a whole world of strategy and risk. Let's break it all down.
No, really, think about that for a second. What if you could forget all the super complex charts, the endless market analysis for just a moment? What if every single trade you made came down to a simple yes or no? Well, believe it or not, that's pretty much the promise of the world we're about to dive into.
Okay, so let's get right to the heart of it. This first part is all about that yes or no idea, because the entire concept of binary options is built right on top of this powerful, simple foundation.
So here's the official breakdown. A binary option is a financial product where the outcome is one of 2 things, and only 2 things. You either get a fixed, preset amount of cash, or you lose the money you put in. That's it. All or nothing. It's not about how much a stock or a commodity moves, it's just about if it crosses a specific line by a specific time.
And one of the things that really draws people in is how easy it is to get started. You know, traditional day trading, that can require a ton of cash just to open an account. But with binary options, a lot of those rules don't apply. The barrier to entry is just way lower. You can often get in the game with a deposit as small as $100.
All right, so theory is one thing, but let's make this feel real. Honestly, the best way to wrap your head around a binary option is to just walk through an actual trade, step by step.
Okay, so picture this. The big question, the proposition is, will the price of gold be higher than $1,250 by 1:30 this afternoon? You look at the market, you've got a good feeling, and you think, yeah, it will. So you buy the S option, and the price for that contract is $44.50. And now? Now you just wait for the clock to hit 1:30.
And this is where that whole binary thing really clicks. If you are right and gold is above that price when the time is up, your option is now worth $100. Your profit is $55.50. Boom. But if you are wrong, even by a single penny, that option is worth $0. You lose your $44.50. It is a completely clear-cut win or lose situation.
So you're probably asking, okay, where did that $44.50 price come from? Well, it's not random. The price is actually set by other traders. The easiest way to think about it is that the price, which is always somewhere between $0 and $100, is basically the market's real-time prediction. A price near $50 means it's about a 50-50 shot. A price of, say, 90 suggests it's a near certainty. And a price of 10, that's a real long shot.
Okay, so we've got the how. Now let's talk about the where and the what. If you're going to get into this, you need to know where to go and what kind of things you can actually trade.
In the United States, there are really two main regulated places to do this. First, there's Nadex. It's a platform built specifically for this. You can access it from your web browser, and the fees are really straightforward. Then you've got the CBOE, the Chicago Board Options Exchange. They offer binary options too, but you'll have to go through a more traditional broker, and the fees can vary depending on who you use.
And the cool part is the sheer variety of stuff you can trade. We are talking everything from big stock indexes like the S&P 500 to foreign currency pairs to commodities like gold and crude oil. You can even trade on specific news events, like making a bet on whether the Federal Reserve is going to raise interest rates or not.
Now let's get to what is probably the most important part of this whole discussion, the money. Let's really dig into the unique way risk and reward works with binary options.
So the potential for a big return is obviously a huge draw. I mean, check this out. Let's say you buy an option for just $20. If you're right, it settles at $100. That's an $80 profit on a $20 risk. That's a 4-to-1 reward to risk ratio. You'd be hard-pressed to find that kind of ratio trading a stock directly.
But, and this is a really big but, here's the trade-off. It's a double-edged sword. On one hand, your risk is capped. That's fantastic. You know, from the second you place the trade, the absolute maximum amount of money you can possibly lose. No surprises. But on the other hand, your reward is also capped. In that gold trade, it doesn't matter if gold goes up by $1 or $100. Your payout is fixed.
So does this all just come down to flipping a coin? Well, not exactly. Smart traders use all kinds of strategies to try and get an edge. Let's take a quick look at a few of the more popular ones. First up, we've got something called the Pinocchio strategy. It sounds funny, but it's a real technical approach. Basically, traders look for a chart with a long wick. That's the thin line sticking out from the main price bar. The idea is that this long wick, like Pinocchio's nose, is lying about the trend. It suggests the price has moved too far, too fast, and is about to reverse. So you bet in the opposite direction. Then there's the martingale strategy. Now be warned, this one is extremely high risk. The basic idea is simple. If you lose a trade, you double your investment on the very next one. The theory is that you'll eventually win, and that one win will cover all your previous losses. But man, you need deep pockets and nerves of steel for this, because a bad losing streak can wipe out your entire account fast. And finally, a really common approach is to simply trade the news. This is all about using big economic announcements, think jobs reports, inflation numbers, things like that, to predict short-term price jumps. The moments right after big news hits can be super volatile, and that creates opportunities to make a quick yes or no bet on where things are headed.
So at the end of the day, here's the question we're left with. Are binary options just a simplified, more accessible way to play the markets? Or are they something else? Maybe a high-stakes gamble dressed up like a serious investment. The setup is simple for sure, but the risks, the rewards, and the strategies behind it all are anything but. The real answer? It's probably somewhere in the middle.
All right, let's jump right in. You know, the world of trading, it just keeps getting faster and faster. We're seeing timelines get crushed, going from months or even years all the way down to weeks, days, or, believe it or not, minutes.
So today, we're going to break down exactly how traders are making moves on these super short-term market swings. And really, it all comes down to this one question, doesn't it? If you've got a strong feeling about where a stock is headed right now, why would you pay for time you just don't need? This whole shift in mindset has blown the doors wide open to a new universe of high-speed strategies.
So here's the game plan for today. We're going to kick things off with the weekly options game and then dig into the different tactics for buying versus selling. After that, we'll zoom in even tighter to trading inside a single day, cover some really key intraday strategies, and then we'll wrap it all up by connecting the dots between speed, risk, and reward.
Okay, first up, the weekly options game. This has totally changed the landscape for short-term traders. We're talking about shrinking that traditional monthly cycle down to just a handful of days.
So, what are these things exactly? Well, at their core, weekly options are pretty much what they sound like. Options contracts with a one-week lifespan. They usually get listed on a Thursday, and then poof, they expire the very next Friday. It's a really focused, tight window of opportunity.
And what's wild is just how much they've exploded in popularity. I mean, for decades, these were super niche products, really only for the big institutional players trading cash indices. But then 2011 happened. The CBOE opened them up to retail traders and bam! Today, you can trade weeklies on almost 1,000 different stocks. The game has totally changed.
But of course, all that speed, it's a classic double-edged sword, right? On the plus side, you get this amazing precision. You can pinpoint specific events like an earnings report, you can sell premium way more often, and you can hedge your bets for cheap. On the flip side, though, there is absolutely zero room for error. A bad trade, it has no time at all to recover. And these complex risk factors like gamma, you know how fast your options price changes when the stock moves, they're way more sensitive. It means you can't just set it and forget it, you have to be watching your position like a hawk.
So that naturally leads us to the two big approaches you can take here. You can be a buyer or you can be a seller of these weekly options. And believe me, they are two completely different mindsets.
Okay, so if you're a buyer, your timing has to be just surgically precise. You have to nail the direction, the strike price, and the timing, or that option could easily expire worthless. Strategies like debit spreads are your friend here, because they help you define your risk. Now, if you're a seller, you're playing a whole different ballgame. You're trying to collect that premium, right? You can generate some really steady income this way, but you got to define your profit target, and super important, know that you're potentially on the hook for some big losses if the trade moves hard against you.
And here's a really sharp tactical tip for sellers. The source material points out that, as a general rule, selling puts in the short term tends to bring in higher returns than selling calls. So why is that? Well, it probably comes down to basic market psychology. The fear of a big market crash is usually stronger than the greed for a huge rally, and that fear tends to pump up the price of puts. It's a subtle edge, but a powerful one.
Okay, so weekly options are fast. But you know what? We can go even faster. Let's really crank up the speed now and compress that trading window from a week all the way down to a single day. Welcome to the world of intraday options trading.
Now, trading options inside of a single day, it throws a couple of unique curveballs at you. First, you've got time decay, what traders call theta, and it is on absolute hyperdrive. The value of your option is literally melting away like an ice cube on a hot sidewalk with every single minute that ticks by. And second, there's often less liquidity, which means the gap between the bid and ask price can get wider, and that can just eat away at your profits on every trade.
So how in the world do you fight back against those challenges? Well, the advice is to zero in on a very specific kind of option, near-month, in-the-money options. Now, why those? It's because their value comes more from their real, intrinsic value, the actual difference between the stock price and the strike price, and less from that time value that's decaying so fast. And of course, sticking with high liquidity stocks helps you squeeze those bid-ask spreads down, making your trades way more efficient.
So keeping those challenges in mind, let's get practical. Let's look at some of the actual strategies traders use to make these high-speed intraday moves really happen. First up, we've got a classic risk management play that's been adapted for speed, the protective put. The easiest way to think about this is like buying insurance on a stock you own, but just for the next few hours instead of months.
This strategy is just perfect for those super volatile stocks where you really want to put a hard cap on your downside. It's also fantastic for a technique called bottom fishing, when you're trying to buy a stock that's been falling like a rock. If you buy a protective put at the same time you buy the shares, you can jump into that trade with way more confidence, knowing that your maximal loss is completely locked in if you're wrong.
All right, our next strategy is all about being dead right on the direction of a super short-term move. Here, traders are using technical analysis to spot these high-probability entry and exit points within minutes.
And what's really fascinating here are the specific tools these day traders are using. We're talking Fibonacci retracements on charts that are less than 10 minutes old to find those key support and resistance levels. They're backing that up with candlestick patterns, and they're using indicators like Bollinger Bands to see when a stock is coiling up like a spring, getting ready for a huge, explosive breakout.
Now, our last strategy is a bit more advanced. This is something you see the pros use a lot. It's not about trading the direction of the stock, but about trading the volatility of the stock itself.
You see this play a lot around big news events like an earnings report when implied volatility is through the roof. The idea is to sell that super expensive volatility, often with a strategy called an iron condor. Basically, that's where you sell both a call spread and a put spread at the same time, making a bet that the stock will stay inside a certain price range. It's a way of playing the probabilities, almost like you're the casino instead of the gambler.
Okay, wow, we have covered a ton of ground, from week-long trades all the way down to minute-by-minute tactics. So let's pull it all together now and really look at that core relationship between speed, risk, and reward.
This little summary chart is a great way to see it all at a glance. You've got weekly options on a one-week timeline where your biggest risk is just having no time to recover from a bad call. They're awesome for swing trades. Then you have intraday options, all happening in a single day, where your number one enemy is that rapid time decay, and those are really best for highly liquid stocks.
So if you take only one thing away from all of this, let it be this. The shorter your trading time frame gets, the more precision, discipline, and absolutely flawless risk management you need. It's a game of speed, and there is just no margin for error.
And that really leaves us with one final question to think about. Every winning strategy has to be perfectly matched to its timeline. So take a hard look at your own approach. Is it truly built for this kind of speed?
Welcome to The Explainer. We all tend to think of investing as picking winners, right? Betting on success. But what if you could actually profit when things go wrong? Today, we're going to demystify a financial tool built on that exact idea. So let's start with a question that I'm sure many of you have faced. You're looking at the market, you see a stock that you think is just way overvalued, and you're pretty sure its price is about to drop. What do you do? You know, most people see investing as a one-way street. You buy low, you hope it goes up. But it turns out there's a specific tool designed for the exact opposite scenario. And once you understand it, it can open up a whole new way of looking at the market. And that tool is called a put option. Now, at its heart, it's just a contract. But it's a contract that gives you a very specific power when you believe a stock is headed for a downturn. Okay, let's break this down because it's super important. A put option gives you the right, but, and this is the crucial part, not the obligation to sell a stock at a predetermined price. Think of it like this. You've got a reservation to sell at a great price, and that reservation becomes incredibly valuable if the market price suddenly drops way below it. And this brings up the two sides of the deal. On one side, you have the buyer. They pay a little fee, that's called a premium, to get that right to sell. And on the other side, you have the seller. They collect that premium, but in exchange, they accept the obligation to buy the stock if the buyer decides to use their right. And here's a fantastic way to think about it, coming straight from our source material. Buying a put can act like a form of insurance. If you already own a stock and you're worried it might drop, a put option can protect your investment by basically setting a floor on how much you could possibly lose. So the theory is one thing, but seeing this in action with actual numbers is where it all really starts to click. Let's walk through a clear, step-by-step example to see how a put option really works. All right, so picture this. There's a fictional company, Company A, and its stock is currently trading at $50 a share. But you've done your homework, and you have a strong feeling that it's overvalued and it's due for a fall. So you decide to act on that hunch. You buy a put option contract that gives you the right to sell Company A's stock at a locked-in strike price of $35 per share. Of course, this powerful right isn't free. To get it, you have to pay a fee, which is called the premium. And in our example, that premium costs you $2 for every single share in the contract. So here's the most crucial point. For you to actually make a profit, the stock doesn't just need to fall below your $35 strike price. It has to fall below your break-even price, which is that strike price minus the premium you already paid. So in this case, that's $33. Now, just look at the incredible asymmetry here.
If you're wrong and the stock soars, or even if it just doesn't fall enough, your option expires worthless. You're out the $200 you paid for the premium, and that's it. Your loss is strictly capped. But what if you're right? If the stock plummets to $25, you get to sell at your locked-in price of $35, turning an $800 profit on just a $200 bet. That is the power of leverage. Your potential upside is massive, while your risk was defined from the start.
And this example perfectly sets up the conversation about the balance of risk versus reward. Because, well, what looks good for the buyer can look very, very different for the seller. For you, the buyer, the risk is totally limited to that premium. You know your maximum loss from day one. But for the seller, they have an obligation to buy the stock from you at $35, even if it's trading at $5, or even if it goes bankrupt. Their potential loss is significant, while their maximum gain is only that small premium they collected from you. Okay, so now that we've seen the mechanics, let's zoom back out and connect this to the most important question. Why would an investor actually use these? What's the real strategy? Well, as the source material highlights, it really boils down to two main strategies. First, protection, using puts like insurance to shield your existing investments from a drop. And second, pure speculation. This is where you make an offensive bet that a stock is going to fall. It's an alternative to shorting a stock, which is a much more complex and often riskier process. Of course, what we've covered here is just one piece of a much, much larger puzzle. Options trading involves a whole universe of strategies designed for different market conditions and risk appetites. But understanding the humble put option is absolutely the fundamental first step. So we'll leave you with this thought. Knowing that financial tools exist not just to bet on success, but also to profit from or protect against a decline, how does that change your view of the market? It really adds a whole new dimension to how we can think about market movements, strategy, and risk. Let's talk about a problem that, honestly, is a pretty great problem to have. What do you do when you're sitting on a winning stock? How do you protect those gains without selling and potentially missing out on even more profit? Well, today we're diving into a powerful strategy designed to do just that. Okay, so picture this. You did your homework, you made a great call, and now you're sitting on some really nice, substantial gains. It feels amazing, right? But it also brings up a pretty big question. What's the next move? Because here's the thing that keeps investors up at night. You know that a sudden market correction or a piece of bad news could wipe out all those paper profits in a flash. And that is the classic dilemma. How do you lock in what you've made without getting out of the game too early? All right, so how do we tackle this? How do we go about protecting those hard-earned wins? This is where that little bit of anxiety starts to creep in, isn't it? You could sell now and take your profits, but then you're hit with that fear of missing out if the stock keeps running. Or you could hold on and risk watching it all just evaporate. And that's the exact high-stakes spot where this strategy we're talking about today, the collar, really shines. Okay, so what is this thing? What exactly is a collar? Let's break it down. So at its most basic, a collar is an options play that literally puts a protective fence, or a collar, around your stock. It sets a floor on how much you can possibly lose, which is fantastic. But, and this is key, in exchange for that safety, it also puts a ceiling on how much more you can possibly gain. You know, the easiest way to wrap your head around this is to think of it like buying insurance for your stock. Seriously. You buy a policy that protects you from a big price drop, but here's the really clever part. You get someone else to pay the insurance premium for you. How? By agreeing to sell them your stock if the price shoots up to a certain level. So how does it actually work? Well, a collar is made up of 3 distinct parts, or legs, as traders often call them. Okay, leg number 1 is simple. It's the stock you already own. Easy enough. Leg number 2, this is your insurance policy. You buy a put option. This gives you the right to sell your stock at a predetermined price. And leg number 3 is how you pay for it. You sell a call option. This gives another trader the right to buy your stock from you at a higher price. And the cash they pay you for that right covers the cost of your insurance. Let's dig a little deeper into that second piece, the protective put. This is your safety net. By buying this put, you're locking in a specific sale price. That's the strike price. So no matter what happens, no matter how far the stock might tumble, you know with absolute certainty the lowest price you'll get for your shares. Your risk is defined. But there's always a trade-off, right? This is where that third leg comes in, selling the covered call. It's fantastic because it generates immediate cash for you, which you use to pay for that put option. But the catch is, by selling that call, you're now on the hook. You are obligated to sell your shares if the stock price rises and hits that higher strike price. And that's exactly what puts the cap on your potential profits.
All right, that's enough of the theory. Let's make this real. We're going to walk through an actual example using Google stock, ticker GOOG, to see how all these pieces fit together. Okay, so let's look at the actual trade. Imagine we own shares of Google that we bought at $1,229. To put on the collar, first we buy our insurance. That's the put option with a strike price of $1,200. This costs us $25.20 per share. Then, to pay for that, we sell the call option with a strike price of $1,270. For that, we get paid, or we receive a premium of $16.90. So let's do the math. What's the absolute worst-case scenario here? Well, if Google stock crashes, our put guarantees we can sell it for $1,200. Since we bought it at $1,229, that's a $29 loss. Now remember the options, we paid out $25.20, but only took in $16, so the net cost of our insurance was $9.20. You add that to the stock loss, and boom, our maximum possible loss is locked in at $38.20 a share. That's it. Totally capped. Okay, now let's flip it. What's the best case scenario? If the stock soars past $12.70, our call option gets exercised and we have to sell. That's a $41 profit on the stock itself. But again, we have to account for the cost of the options. So we take that $41 gain and subtract the $9.20 net cost of setting this up. That leaves us with a maximum potential profit of $31.80 per share. It's a limited gain, yes, but it's a very, very protected one. Right, so like with any strategy, you have to weigh the good against the bad. Let's talk about the pros and cons of using a collar. The biggest pro is, well, it's huge. You get to sleep at night knowing your downside is completely capped, and you often do it for very little or even zero net cost. The con, of course, is the flip side of that same coin. You give up the chance for those massive home run gains if the stock goes on a tear. It's the ultimate trade-off, security in exchange for unlimited potential. So let's wrap this up by talking about why this strategy isn't just a one-off trick, but something that many traders consider a real cornerstone of their approach. In fact, one of our sources put it perfectly, saying the collar should be the cornerstone of your options trading strategy. Now that's a pretty bold statement. So why is it considered so foundational? Well, think about it. To pull off a collar effectively, you can't just be good at one thing. You gotta be good at the whole game. You need the technical analysis skills to know when to put the trade on. You need the finesse to pick the perfect strike prices for both the put and the call. And you have to know when to adjust the trade if things change. It forces you to become a more complete, more disciplined trader. So at the end of the day, the collar is a choice. It's a conscious decision to trade that lottery ticket upside for some real concrete protection from the downside. So, I'll leave you with a question to think about. As you look at your own portfolio, which one of your winners might be ready for a collar? Let's dive into one of the most crucial skills any trader can have, learning how to read the market's story. You know, it's all about understanding the environment you're actually trading in, so you can pick the right strategy for the right moment, and honestly, avoid some really, really costly mistakes. Okay, so picture this. You've found a great trading strategy, you've even backtested it, run it against old data, and the results look amazing. You're feeling confident. But then you go live and it just fails, over and over again. It's gotta be one of the most frustrating things in trading, right? And that's where so many people just throw in the towel, thinking their strategy is broken. But what if the strategy was never the problem in the first place? And there it is. This quote it absolutely nails it. The single biggest risk you face isn't having a bad strategy. It's using a perfectly good strategy at completely the wrong time. This is the whole puzzle we're going to put together today, how to finally match what you're doing with what the market is doing. So first things first, let's really frame this core problem, because once you truly understand this one mistake, it's the first huge step toward making sure you never make it again. Underneath all the headlines, all the noise, and the chaos, the market really only ever exists in one of two basic states. And here's the kicker. Your entire success, everything, really hinges on your ability to look at a chart and just correctly identify which of those two states we're in right now. So, what are these two states? Well, it all boils down to a really simple but powerful idea. Trend versus range.
Seriously, think of it like reading the battlefield before you decide how you're going to fight. Okay, so on one hand, you have a trend. A trend is all about momentum. It's a one-sided fight where either the buyers or the sellers are clearly in charge, and the price is just marching in one direction. Then you have a range. And a range is a total stalemate. It's gridlock. Buyers and sellers are pretty evenly matched, and the price just gets stuck, chopping back and forth between a floor and a ceiling. Now, here's the real secret. It's not just about being able to spot if you're in a trend or a range. The real advantage, the massive leg up, comes from spotting the transition. That moment when a strong trend is running out of steam and about to turn into a sideways grind, or when a boring range is about to explode into a brand new trend. That's where the magic happens. So this brings us to a much better question. It's not enough to just look at a chart and say, yep, that's enough trend. We have to ask, how healthy is this trend? Is it strong and just getting started, or is it secretly about to run out of gas? And the way we figure that out is with a concept called counter-trend participation. Just imagine, the main trend is an army marching forward, while counter-trend participation is the enemy fighting back. How strong is that pushback? How much of a fight are they putting up? The answer to that question tells you pretty much everything you need to know about the real strength of that trend. So how do we actually measure this? Well, we can ask 3 simple questions just by looking at the chart. First, what's the quality of the candles moving against the trend? Are those pullbacks made of big, strong candles, or are they kind of weak and flimsy? Second, how many of them are there? Do you see more and more of them showing up over time? And third, how deep are the pushbacks? Are they getting bigger and lasting longer? It's really that simple. The more resistance, the more pushback you see, the weaker that main trend is becoming. So if you start to see strong, frequent, and deep pullbacks, you can bet that trend is losing steam and the market might be getting ready to change its mind. All right, next up, let's talk about the line in the sand. Every battle has that one critical defensive line, and in the market, we call this a turning point. So what is a turning point? It's that one major price level where the dominant army, the buyers in an uptrend or the sellers in a downtrend, has set up its biggest fortress. It's their last line of defense, and they are going to protect it at all costs to keep their trend alive. So when the price gets near a turning point, you expect a big fight. But, and this is the really important part, if that defense crumbles, if that level breaks decisively, that's a huge signal. It often means control of the whole market is about to flip. That old floor of support can instantly become a new ceiling of resistance. The entire game just changed. Okay, so we've covered all the key pieces of the puzzle. Now, let's put it all together. Let's build a simple, repeatable framework that you can use every single time you open a chart.
Here it is, just 4 simple steps. Step 1, identify the environment. Are we in a trend or a range? Step 2, gauge the trend's strength. How much pushback is there? Step 3, find the turning point. Where's that critical line in the sand? And step 4, the most important one, form your bias based on all that and then stick to it until that turning point actually breaks. This is a total game changer because it forces you to be guided by what the market is telling you, not by your own hopes or fears.
So there you have it. This is a framework not just for trading, but for really understanding the story the market is telling you moment by moment. You're no longer just guessing at what might happen next. You're actually reading the battlefield and reacting to what's happening in real time. So, the only question left is, with this knowledge, what move will you make?
All right, let's talk about a pretty brutal truth in the trading world. Most people who try it, well, they lose money. But then you've got this small elite group that consistently comes out on top. So what's their secret? Is it some magic formula? Nope. It's actually a set of foundational rules. Rules that control not just their strategy, but their own psychology. So over the next few minutes, we're going to break down those exact rules so you can learn how to join that winning side.
So let's just start with a cold, hard number. Get this, over 75% of all traders fail. I mean, they completely wash out, lose their starting money, and just quit. And brokerages aren't exactly shouting this from the rooftops, so you can bet the real number is probably a lot higher. This isn't just some random statistic, you guys. It's a huge warning sign.
So the real question we need to ask isn't just, how do you survive, right? It's, how do you actually thrive? How do you get into that professional minority, that small group that consistently pulls profits out of the market? Well, the answers might not be what you think. And that's exactly what we're going to dig into right now.
All right, first section. Where does this whole journey to becoming a profitable trader actually begin? You might think it's with some fancy new indicator or a top secret strategy, but it's not. It starts right here, between your ears. See, before you can even think about mastering the market, you have to master yourself. This is what we call the inner game, and honestly, it's where most traders lose the battle before they even place a single trade.
Just take a look at this. It's like a perfect picture of the civil war that's going on inside every single trader's head. On one side, you've got the emotional brain. This is the part that runs on adrenaline rushes, hope, and that really, really dangerous urge to get even after a loss. But on the other side, you've got the disciplined brain. It's calm, it's objective, and it just follows the plan. The entire game of trading, when you boil it all down, is making sure that the disciplined brain is the one in the driver's seat, always.
So how do you actually empower that disciplined brain? Well, it starts with a few foundational rules for your mindset. First up, you have to make peace with losing, seriously. Losses are just the cost of doing business in this world. You can't avoid them. Trying to get even, that's just a recipe for digging yourself into a much deeper hole. And hey, look at that third point. Arrange your personal life. This is huge. The source material we're looking at is crystal clear about this. If your personal life is a mess, your trading is going to be a mess too. You need a stable foundation to have a stable mind.
And all of this really boils down to the single most important rule of the inner game. And it's this: don't break your rules. I know, it sounds almost ridiculously simple, but trust me, it's the hardest part of trading. You create these rules for one reason: to act as a shield, to protect you from your own emotional brain when things get stressful and chaotic.
This quote from our source material just says it all perfectly. You make trading principles to get you out of trouble. If you don't enable them to carry out their responsibility, you have lost your discipline. I mean, think about that. Your rules are your lifeline. They exist specifically to pull you out of trouble. So if you ignore them, you haven't just lost some money on a trade. You've lost the one thing that separates amateurs from professionals: discipline.
Okay, section 2. So we've talked about fortifying your mind, right? You've built up your psychological armor. Now it's time to talk about the outer game. It's time to build your weapon. This is your actual trading strategy. And here's a little spoiler for you. It's not about finding some magic bullet. It's about building a tough, reliable system that can actually handle the chaos of the live market.
This is the classic trap that snares so many new traders. They go on this desperate quest for the holy grail of trading, some mythical secret formula that's going to promise them instant, easy profits. They'll burn through thousands of dollars on fancy software, on so-called gurus, all while they're just chasing a ghost.
So let me just be as clear as I possibly can be. It does not exist. There are no secrets in this game. The real path to success is paved with something a lot less glamorous, but way more effective.
So what's the antidote to this whole Holy Grail myth? It's a real, honest-to-goodness trading plan. Look, it's not sexy, it's definitely not a secret. But you know what? It actually works. The best way to think about it is like a constitution for your trading business. It's this living document that lays out all the rules, guides every single decision you make, and keeps you from flying off the rails when the market gets crazy. This, right here, is the real key.
Okay, so what does this real path actually look like in practice? It really just boils down to 3 core ideas. Number 1, don't cut corners. The pros are putting in the hours, doing the research, and you have to be willing to do that too. Number 2, grasp simplicity. Focus on just the price action. All those fancy, complicated indicators, they're just the supporting cast. Price is the star of the show. And number 3, and this is a big one, lock in your profits. That money isn't really yours until you've closed the trade. Until then, it's just numbers on a screen.
All right, let's get to our third and final piece of the puzzle. This is all about escaping the herd mentality. Because in the markets, if you're just following the crowd, well, you're probably being led right off a cliff. Learning to think for yourself is absolutely critical.
This quote really gets to the heart of it. Profit infrequently pursues the greater part. When you see an ideal exchange arrangement, almost certainly every other person sees it too. Basically, the real money is made where the crowd isn't. You know when a trade setup looks just perfect? Almost too good to be true? Well, the problem is, everyone else sees that same perfect setup. And a lot of the time, that means it's a trap, set up specifically to lure in the herd.
So how do you actually break away from that herd? The source gives us some really clear, practical rules. First,
Be suspicious of those perfect, obvious trade setups. Second, get away from the stock message boards in the chat rooms. They're just echo chambers, usually filled with people pushing their own agenda. Third, stop listening to the so-called market gurus on TV. A lot of times, they're just trying to pump up their own book. And finally, and this is so important, don't become a fan of a company. You're a trader, not a cheerleader. Your job is to profit, not to root for a team.
Okay, so we're bringing it all together now. The inner game, the outer game, and escaping the herd. What does it all mean? It means you have a choice, a really clear one. See, joining that professional minority, the winners, it isn't about getting lucky or finding some secret. It's about making a conscious, deliberate choice to act completely differently than the crowd.
And this table just lays out that choice perfectly. It's the tale of two traders, really. On one side, you've got the failing majority. They're seeking adrenaline, they're chasing after that holy grail, and they're following the herd right off a cliff. But then, on the other side, you have the professional minority. They accept risk, they stay disciplined, they follow a written plan, and they think for themselves. They're playing in the exact same market, but they're playing a totally different and much more profitable game.
So, in the end, it all comes down to one simple question. The rules we've talked about, they aren't complicated. They're not advanced calculus. They're actually pretty simple. The real challenge, the thing that will decide if you end up in that 75% who fail or in the small group who succeed, is whether or not you have the discipline to stick to them. Day in and day out, when it's easy and when it's hard. That's the real test. The choice is yours.
All right, let's talk about getting into options trading. We're going to build a real, practical playbook for anyone just starting out. Now, this isn't some get-rich-quick fantasy, okay? It's all about building a solid, disciplined strategy right from the very beginning. So let's dive in.
So, you hear about options trading, and you gotta wonder, right? Is it this brilliant path to profit, or is it just a high-stakes gamble? Well, here's the thing. It can actually be both. The chance to make money is absolutely there, but believe me, so are the risks. The big difference maker? It almost always boils down to preparation. And that's the journey we're gonna map out for you today.
So here's how we're going to break it all down. First, we'll build your foundation. Then we've got to know the rules. After that, we'll put together your smart trading playbook. And we'll wrap up with what might be the most important part, getting into that successful trader's mindset. A pretty clear path to get you going, right?
Okay, let's kick things off with part 1, building your foundation. Seriously, think of this as your boot camp. A lot of people think success starts with that first big trade. But nope, it actually starts way before that, with all the prep work you do before a single dollar is ever at risk.
Here's something you've got to get into your head right away. The options market is always changing and never sit still. That means your education can't be a one-and-done thing. The best traders, they're always learning. I'm talking about devouring books, watching video tutorials, hanging out in forums to see what other people are doing. You have to stay on top of your game, always.
So, when you're just starting, it really comes down to 2 simple steps. Step 1, learn everything you can. And step 2, practice, but practice safely. This is where demo accounts or paper trading are just fantastic. They let you use fake money to try out your strategies, get used to the platform, and make all those rookie mistakes without it costing you a dime. It's basically your own personal trading simulator. You get all the experience with zero risk. All right, so you've started building that foundation. Now it's time to map out the terrain. See, every market has its own set of rules. And trust me, in finance, these rules aren't just suggestions. Knowing them isn't just a good idea, it's absolutely essential if you want to survive and thrive.
And this is a big one, so listen up. The rules are not the same everywhere. What's true for a trader in the US could be totally different for someone in Europe or Asia. You absolutely have to do your homework on the specific regulations for your market. For example, here in the US, the big one to know about is FINRA.
And speaking of rules, let's talk about this number, $25,000. Why does that matter? Well, in the US, if you're labeled a pattern day trader, which basically means you're making a bunch of trades in a short period, FINRA says you have to keep at least $25,000 in your account. That is a huge piece of information you need to know before you even think about starting.
Oh, and let's not forget everyone's favorite subject, taxes. Yep, any profit you make from trading can be taxable. It is so important to figure out your local tax situation right from the get-go, because the last thing you want is a nasty surprise from the tax man that just gobbles up all your hard-earned profits. You got to plan for it.
Okay, you've been studying, you've practiced in a safe space, and you know the rules of the game. Now it's time for the fun part, building your actual trading playbook. This is all about execution. How are you going to manage your money
and your trades with a real, concrete strategy.
You know, the absolute foundation of any solid playbook is managing your risk. And probably the most important rule for any beginner to learn is the 1% rule. It's a super simple idea, but it's designed to do one thing, and one thing only. Protect your money so that you live to trade another day.
So what is this 1% rule? It's simple. You never ever risk more than 1% of your total capital on a single trade. Let's make that real. If you've got a $20,000 account, the absolute most you can risk on one trade is $200. That's it. This is the discipline that stops one bad decision from completely blowing up your account.
Now, your playbook can also include how you're going to execute these trades. You've got options. You can go manual, where you're in the driver's seat for every single decision, or you could look into automated trading software. These things use algorithms to make trades for you, like super fast. But you got to remember, the software is only as smart as the strategy you program into it. It's a powerful tool, for sure, but it's not a magic button.
And that brings us to our last section. And honestly, this might be the most important one of all. You can have the world's greatest strategy, you can know every single rule, but if you don't have the right mindset, none of it's going to matter. This is the mental game, the part that separates the real traders from the gamblers.
I really love this quote. It says, in investing, what is comfortable is rarely profitable. And it just perfectly captures the idea of risk, doesn't it? Trading means taking calculated risks. It's about pushing past what's comfortable, but doing it with a solid plan. It's not about being a daredevil. It's about knowing that to get profits, you have to manage some level of risk.
So, when you boil it all down, a successful trader's mindset really stands on 3 pillars. First, discipline. You got to stick to your plan, even when your gut is screaming to do something else. Second, good money management. That's our 1% rule in action. And finally, you have to make decisions with your head, not your heart. Decisions have to be logical, not driven by fear or greed.
So there you have it. We've gone through the whole journey, right? We've talked about building your foundation through learning and practice, understanding the rules, crafting your own playbook, and finally getting into the right mindset. The roadmap is right there in front of you. You have the playbook. So the real question is, are you ready to trade smart?
Have you ever looked into the world of trading and just felt, completely overwhelmed? Well, you're not alone. So over the next few minutes, we're going to cut through all that noise. We're going to give you a clear, simple path to get you started. No confusing jargon, I promise. Just a straightforward guide. Let's dive right in. This quote right here, it gets to the heart of a huge misconception. We tend to think of trading as this super stressful, difficult grind. But what if we've been looking at it all wrong? The whole idea is that trading can actually be engaging, even exciting. It's a way for you to get involved with the economy in a really direct way. And do you think you need a massive fortune to even think about trading? Think again. The barrier to entry is probably a lot lower than you imagine. You can actually get started with as little as $100. And what's really amazing is thinking about the potential for that small start to grow into something much, much bigger. All right, so here's our game plan. First, we're going to challenge some of those old, stuffy ideas about what trading is. Then we'll talk about a super common trap for new traders and exactly how you can avoid it. After that, we'll lay out a clear roadmap to success. We're also going to dive deep into the psychology of trading. Seriously, it's a game changer. And finally, we'll show you how to find opportunities no matter what the market is doing. Okay, let's jump right into our first section. We're going to start by totally busting that myth we just talked about, the idea that trading has to be this tedious, difficult chore. It's really time for a fresh perspective on this. So what's the opposite of tedious? How about fun and exciting? Seriously, imagine you're not just watching numbers on a screen. You're actively getting involved with some of the best companies in the world. You're learning to ride the wave of the stock market. And look, with the right approach and discipline, this can be way more than a hobby. It could be a real path to financial growth. Okay, so we've got the right mindset, right? Now, let's get practical. It's time to talk about what comes next, that crucial second step. See, a ton of beginners get stuck in the exact same spot, and the real key to making progress is pushing past that initial comfort zone. So let me ask you a direct question. Have you learned about call options? Betting that a stock's price is going to go up, and now that's pretty much the only move you make. It's a really common starting point, right? It's that one tool that feels kind of safe and familiar. Hi,
If that sounds like you, do not sweat it. This is a super common spot for new traders to be in. It's totally understandable. The world of trading strategies can feel gigantic, so of course it's natural to stick with the one thing you know. But here's the thing. If you only stick to that one tool, you are leaving so much on the table. The world of options is packed with all these different strategies, techniques that open doors to profits not just when a stock goes up, but also when it goes down or even when it just moves sideways. Learning these is how you unlock the real power of trading. So how in the world do you navigate all these new strategies without feeling completely and totally lost? Well, you need a map. And that is exactly what we're going to look at next, a clear, step-by-step guide to take you from beginner to a confident swing trader. This roadmap just lays it all out, nice and simple. You start with the fundamentals, the absolute basics. Then you find your little corner of the market, the part that really clicks with your personality. After that, it's about getting the right tools for the job and learning how to actually analyze what the market is telling you. And then comes the most important part of all, the inner game. Mastering your own psychology and how you manage risk, that is what separates the pros from the amateurs. You know, that last step on the roadmap, it's so unbelievably crucial that we're giving it its very own section. Because here's a little secret about trading. Success isn't just about what you know about the market. It's about what you know about yourself. This is the inner game, and frankly, it's where most traders either win or lose. Think of it like a scale that has to be perfectly balanced. On one side, you've got your psychology, your discipline, your mindset, your ability to stay calm when things get chaotic. And on the other side, you've got your money management, the practical strategy for handling your cash, your risk, your whole account. They are two sides of the very same coin, and you absolutely need both to succeed. And this quote just sums it up perfectly. It's not about being some kind of genius or a reckless gambler. The two key words here are smart and disciplined. It's about combining that market knowledge with self-control, that whole inner game we're talking about. And when you do that, the results can be absolutely life-changing. So, when you bring together that market know-how and that inner discipline, well, you pretty much unlock a kind of trading superpower. You start to see opportunities everywhere, not just when the market is soaring, but in any condition, even a downturn. When the market takes a nosedive, what's the first word that pops into your head? Yeah, for most people, it's panic. The gut reaction is to sell everything, cut your losses, and just get out before it gets any worse. And look, that is a totally normal human reaction. But a skilled trader, they have a completely different instinct. And this might just be the most powerful piece of advice we talk about today. When the market enters a downturn, don't stop trading. A downturn isn't the end of the game. It's just a different level, one with a whole new set of rules and opportunities. So how is that even possible? Well, it's because with options, you have incredible flexibility. You can use specific strategies that are literally designed to make you money when a stock's price is falling. So while everyone else is in full-on panic mode, you can be calm, cool, and collected, earning profits where others only see loss. So here's the bottom line, the key takeaway from all this. Trading isn't a one-way street that only goes up. It's more like an all-terrain vehicle. It's a flexible, adaptable skill that lets you navigate any market condition, whether it's a smooth uphill climb or a bumpy downhill ride. It's a continuous journey. So it all really comes down to this. The market is like a giant wave, and it is always in motion. The question isn't whether you can stop the wave. You can't. The real question is whether you can learn to ride it. The whole journey of a trader is just learning to master that ride. So I guess my final question to you is, are you ready to grab your board?
Hey everyone, welcome. Today we're going to dive into something called swing trading. It's a super popular strategy all over the world, and we're going to break down exactly what it is, how it works, and maybe help you figure out if it's the right fit for you. So, when you think of a stock trader, what's the first image that pops into your head? Is it someone with like 6 monitors, totally glued to their screen, watching every single little tick of the market? Yeah, that's a common picture, but believe me, it is far from the whole story.
I mean, what if you don't want to be chained to a desk all day? For anyone who wants to get involved in the markets but, still have a life, there's another way. A really powerful alternative, actually.
And that's exactly where swing trading comes into the picture. It's a style that feels like it was designed for people who have jobs or other commitments, basically for anyone whose life exists outside of a market chart.
Okay, so what is swing trading really? Well, at its core, it's all about trying to capture profits from these short-term swings in the market.
We're not talking about moves that last just a few minutes, and we're definitely not talking about holding for years. Nope, we're in this kind of sweet spot right in the middle, trying to capitalize on price moves that happen over a few days or maybe a couple of weeks.
And just to put a finer point on it, a typical swing trade usually lasts anywhere from a couple of days to about 2 weeks. Now that window is just long enough for a predictable price move to play out, but it's short enough that you're not tying up your capital for months and months. You basically get into a position and then you hold it, waiting for that swing you're expecting.
And this right here, this is the key to why it's so popular. You can do your research, you can place your trades, set your profit goals and your safety nets, and then you can just go about your day. You don't need to be constantly watching the screen, which makes it pretty much a perfect strategy for part-time traders.
All right, but hold on. If you're not staring at the screen all day, how in the world do you decide when to buy or sell? That's a great question, and that's where the Swing Traders Playbook comes in.
Now, take a look at this quote. It's pretty wild, right? Whether a company is doing well or performing poorly is really none of their business. That sounds kind of crazy at first. I mean, don't you want to invest in good companies? Well, for a swing trader, the long-term health of the company, it's just not the main thing they're looking at.
And here's the crucial part. Swing traders rely almost entirely on something called technical analysis. They're not digging through company earnings reports or analyzing the CEO's latest interview. Nope. They're studying the chart itself, looking for patterns in how a stock's price has moved in the past. So, for instance, they might look for a support level, a price where the stock has historically stopped falling and bounced back up, to try and predict where it might go next.
So the basic process is actually pretty straightforward. First, you've got to find the right kind of stock. You want one that moves around a bit so it's volatile and has a lot of people trading it, so you can get in and out easily. Then you analyze its chart for those predictable patterns we just talked about. Once you see your setup appear, bam, you enter the trade. And finally, you have a solid plan to get out and take your profits when the swing is over.
This whole idea of holding trades for a few days often gets mixed up with its more, let's say, intense cousin, day trading. So let's put them side by side. It'll make the key differences really clear.
Okay, so the most obvious difference right off the bat is just how long you hold a trade. Day trading is all about speed. It's contained to a single day. You're opening and closing positions in minutes, maybe a few hours at most. But swing trading, that crosses the overnight line. You're holding trades for days, sometimes even a few weeks.
And that difference in holding time, it has a huge impact on your time commitment. Swing trading requires way less active screen time. But, and this is a big but, it introduces a unique kind of risk, overnight and weekend events. Some major news could break when the market is closed, causing a stock's price to gap way up or way down at the next opening bell. Day traders don't have to worry about that at all, because they close everything out before the market closes for the day.
All right, so we've covered the nuts and bolts of it. But look, understanding the strategy, that's only half the battle. Success in trading has just as much, if not more, to do with your mindset. Okay, so there are a few huge keys to a winning strategy. First, you absolutely have to develop a strategy that fits your style, your personality. Next, and this one is massive, you have to accept that losing is just part of the game. No trader wins every single time. It's impossible. The goal isn't to never lose, it's to make sure your wins are bigger than your losses. And maybe most importantly, you have to remember there is no easy way out. There are no shortcuts.
That fantasy of getting rich quick is what pulls a lot of people into trading in the first place. But that dream, it tends to disappear pretty fast when reality hits. Success here, just like in any other serious profession, requires a ton of patience, hard work, and real dedication.
So there you have it. We've broken down the what, the how, and the why of swing trading. The mechanics, as you can see, are pretty straightforward. But the real question isn't just about whether you can understand the charts, it's about understanding yourself. Do you have the discipline and the patience to actually stick to a plan, even when things get a little rocky? Because that's the real key to success.
Hey everyone, and welcome. Today we're going to dive into a trading strategy that's become super popular, especially in the kind of crazy markets we see these days. Yep, we're talking about swing trading. So let me just start with a quick question. Do you like the idea of actively trading stocks, but, you don't want to be chained to your desk staring at charts all day long? If that sounds like you, then swing trading might be exactly what you've been looking for. It really hits that sweet spot between active trading and, well, having a life. So first things first, what is swing trading, really? Well, at its core, it's all about mastering the art of the medium-term move. It's about capturing a stock's momentum. To put it plainly, swing trading is where you try to make money off the swings in a stock's price, both up and down. We're not talking about holding for minutes, and we're definitely not talking about holding for years. The goal here is to hold a position for just a few days, maybe a few weeks, to catch one single, solid price move. Now, this approach takes a whole different mindset compared to long-term investing. It's not about trying to hit a home run with every single trade. It's more about hitting consistent singles and doubles. It's all about the philosophy of compounding your wins, and it's incredibly powerful. See, the profit targets are different. A long-term investor might be hoping for a 20 or 25% gain over a year, but a swing trader, they're looking for a much smaller, more achievable 5 to 10% profit on a single trade. The real power comes from making these smaller trades more often. This quote just nails the swing trader's mindset perfectly. You see a profit, you take it. Sure, you might get out a little early sometimes and then watch the stock keep climbing, and yeah, that can be a little frustrating. But you've locked in your win, you've managed your risk, and hey, you can always jump back in if a new opportunity shows up. And this is where the real magic happens. The whole point is to let those small wins compound into something really big. By stringing together a bunch of these successful 5% or 10% trades, you can actually generate some seriously impressive returns over time. It adds up way faster than you might think. Okay, so right about now, you're probably thinking, wait a minute, this sounds an awful lot like day trading. And yeah, they're in the same family, but they are very, very different animals. So let's break down the differences, because it's all about finding the rhythm that works for you. Just look at this table. It makes it super clear. The holding time is the big one. Swing trading is days to weeks. Day trading is minutes to hours. That right there creates a massive difference in the time commitment. A swing trader can just check in on their positions, periodically. A day trader has to be watching the screen constantly. And psychologically, swing trading is all about patience and planning ahead. Day trading, it's a high-stress world of split-second decisions. All right, so the big question is, how do swing traders even find these opportunities to begin with? Let's get into the nitty-gritty and open up the toolkit they use to actually read the market swings. Now, there are a ton of complex technical strategies out there, things like Fibonacci retracement and T-line trading, but we're going to focus on one of the most fundamental concepts of all, price action analysis. This is basically the art of learning to read a chart, candlestick by candlestick, to understand the constant battle going on between buyers and sellers. The first rule of price action is to stop thinking about exact lines and start thinking in terms of zones. So when you hear people talk about support or resistance, they don't mean one specific price. It's more like an area on the chart where the price has struggled to break through in the past. And those zones are where you'll often see a potential reversal, a swing in the other direction. Next up, you've got to learn to spot rejection. You see those long wicks sticking out of the candles? Those are sometimes called shadows, and man, do they tell a story. A long shadow at the bottom of a candle means sellers tried to push the price way down, but the buyers fought back hard and pushed it right back up. That rejection is a huge clue that the momentum might be shifting. And finally, here's a cool one. Learn to listen to the silence. You know how they say it's the calm before the storm? Well, on a chart, that calm looks like a bunch of small, tight, narrow candles all clustered together. It means the market is kind of holding its breath. And that quiet period, it often happens right before a massive, explosive move one way or the other. Okay, so all these techniques are incredibly powerful, but they're pretty much useless without the single most important tool any trader can have. Let's talk about the absolute blueprint for success. So let me ask you this. What's the real difference between what a professional trader does and what an amateur does when they just throw money at the market? What separates trading from just gambling? The answer is just one word: a plan. Seriously, that's it. Without a trading plan, you're not really trading. You're just hoping. A plan is what turns this whole thing from a game of chance into a strategic business. I love this analogy for it. A trading plan is basically a GPS for your trades. You punch in your destination, a profitable trade, and it gives you the step-by-step directions to get there safely. It tells you exactly when to get in, when to take your profits, and maybe most important of all, when to get out and cut your losses if you make a wrong turn. And the benefits are just huge. A plan completely takes your emotions, like fear and greed, out of the driver's seat. It forces you to manage your risk and know your exit points before you even enter the trade. It keeps you disciplined and accountable, and honestly, it gives you a massive edge over all the other traders out there who are just winging it.
So as we wrap up, I just want to leave you with this one last question to think about. When you look at the market, are you building a strategy, like an architect with a clear blueprint, or are you just making a bet? The answer to that question will probably determine your entire future as a trader. Thanks so much for tuning in.
You know that feeling, right? You're staring at the charts, all those lines and indicators, and you're just trying to figure out what's the secret sauce. But here's the thought. What if the key to being consistently successful has nothing to do with what's on the screen? What if it's all about what's in our heads and in our habits? Well, that's exactly what we're going to dive into today, the personal traits that the best traders master before they even think about placing a trade.
Man, this quote really hits home, doesn't it? It just completely shatters that whole fantasy of easy money. Let's be real, trading success isn't about winning a lottery. It's earned. It's built on pure grit, those late nights, and just the will to keep going when things get tough. And that's the part you don't usually see on social media, right? That's the reality.
Okay, so if we agree it's a journey of hard work, where do you even start? Well, it all begins with a choice. Right at the very core of trading, there are basically two completely different mindsets you can have. And trust me, one almost always leads to frustration, while the other, that's where you find the path to potential success. So let's break that down.
So, think of it like this. On one side, you've got the get-rich-quick mindset. It's kind of like playing a slot machine, hoping for a jackpot. It's that person who sees someone else's success and thinks, hey, that looks easy, but completely misses all the hard work that went into it. That path, it almost always leads straight to burnout. But then, on the other side, you've got the determined and hard-working mindset. This is more like being a gardener. You plant the seeds, you water them every day, and you understand that real growth, it takes time. And believe me, this isn't just some small difference in attitude. It's everything.
All right, so if we're going to be gardeners, where do we start digging? Well, the very first piece of ground you have to work on is your own mind. Seriously, long before you ever think about a strategy or a chart, the real battle is won or lost right between your ears. It's all about mastering that inner game.
And check out how these 4 traits are laid out. This isn't just some random checklist. They actually build on each other, like a foundation. It all starts with self-discipline. That's what allows you to have emotional control. And when you have that control, you can develop patience. And all of that together leads to humility. These aren't just nice-to-have skills, They're the absolute bedrock. If you take even one of these away, the whole thing gets shaky, especially when the market starts throwing punches.
So let's really dig into self-discipline for a minute, because it's so much more than just, sticking to your plan. The source material points out something brilliant here. Real self-discipline isn't some switch you can just flip on when the market opens. It has to be a part of your entire life. It's about calmly knowing when to make a move, and, this is huge, knowing when to do absolutely nothing. It's about being the CEO of your own actions.
And that discipline, well, it leads us right to the biggest challenge every single trader has to face: getting your emotions under control. I mean, the market is an absolute expert at pushing your buttons. Fear, greed, impatience, you name it. A successful trader, they learn how to build a kind of wall around their decisions. It's not about not having feelings. We're all human. It's about not letting those feelings drive the car. Keeping your emotions out of the driver's seat isn't just a good idea, it's literally the only way to think straight.
All right, now let's talk about patience. And this quote, it just says it all, but it feels completely backwards when you're starting out. A successful trader is always slow in making profits and quick in taking losses. See, most new traders do the exact opposite. They get scared, so they grab a tiny profit way too early. But then they'll let a losing trade just run and run, hoping it'll magically turn around. The pro, they flip that script. They're patient with their winners to let them grow, but they're absolutely ruthless about cutting their losses short.
Okay, so let's say you're working on that strong inner foundation. The big question is, how do you actually use it? How do you take that inner discipline and turn it into real, consistent actions in the market? Well, that brings us to our next pillar, building your actual trading framework.
This is really where the rubber meets the road, where your mindset becomes your method. It's all about creating a system of professional habits. And if you look at this list, notice what they all have in common? They're all about turning trading from a gamble into a serious business. You've got habits for learning, for making decisions, for planning, for keeping records. I mean, this is the kind of structure that truly separates the professionals from the amateurs.
So, this brings up a really tough question, and I want you to think about this honestly. When you have a losing trade, does it feel like you just hit a wall, or does it feel like you just paid for a lesson? Because a professional trader sees every single loss as tuition. It's the price you pay for valuable data on what not to do next time. Making that mental switch, wow, it is an absolute game changer.
And that commitment to learning from your losses, it has to be relentless. Why? Because the market itself is constantly changing. It's a moving target. A strategy that works great today might be completely useless tomorrow. The pros get this. They are always on the hunt for new information, always adapting their strategies, always staying curious. They know that in this game, the second you think you know it all, that's the second you start to fail.
Okay, so we've covered the inner mindset and the outer framework, but there's one last really crucial piece that kind of holds it all together. It's about making sure that your system isn't just something you can follow, but something that is actually sustainable for you in the long run. And that's all about trading as yourself.
And the core idea here is so simple it almost sounds too easy. Be yourself. That's it. Your trading style has to match your personality. I mean, if you're a naturally patient, long-term thinker, and you try to copy some hyperactive day trader, it's just not going to work. You're setting yourself up to fail. The goal is not to become someone else. It's to find a style that fits you like a glove.
So, what exactly is a personal trading style? Well, it's basically a unique way of trading that just feels right. It feels comfortable and natural to you. But here's the catch. You don't find it by playing it safe. You discover it by taking some calculated risks, by stepping outside your comfort zone a bit, and really figuring out what clicks with your personality. Trying to trade against your own nature, it just won't work in the long run. It's not sustainable.
Okay, and now for our final section. This covers a trait that is so often overlooked, but honestly, it might just be the secret ingredient to long-term success. And it's all about what you do when you're not even trading. It's about your life beyond the screen.
I really can't overstate how important this is. The best traders in the world are not the ones who are glued to a screen 24/7. Not at all. They're the ones who know when to shut the laptop and just live. Hobbies, family, exercise, these things aren't distractions from trading. They are absolutely essential. They're how you prevent burnout and recharge the mental energy you need to stay sharp and objective.
So to wrap it all up, it really comes down to this. Real, sustainable success is built on three pillars that all support each other. First, you've got the inner game. That's your mindset and discipline. Then there is the trading framework. That's how you put that mindset into action. And finally, the personal element, which is all about making sure your trading is authentic to you and balanced with your life. You need all three.
Look, this shows that progress isn't about trying to master everything all at once. It's about taking one deliberate step forward. So the final question I have for you is simple. As you look at these three pillars, the mindset, the framework, and that personal balance, where's your biggest opportunity for improvement right now? Which one of these traits are you going to focus on first? Because making that decision, that could be the most important trade you make all day.
Hey, welcome. So when you hear the words stock trading, what pops into your head? Is it someone frantically clicking away, making high-stakes moves every second? Or is it more of a slow, 50-year waiting game? Well, today, we're going to talk about a really powerful middle ground, a strategy called swing trading. I mean, really think about it. The image we have of a stock trader is usually one of two things, right? Either it's that super high-stress day trader glued to a dozen monitors, making split-second decisions, or it's the ultra-patient, buy and hold forever type of investor. It often feels like you've got to pick one of those extremes. But what if there was another way, a more balanced approach that kind of takes the best of both worlds? Well, there is, and that's exactly what we're going to dig into today, the art of swing trading. So let's get into it. What exactly is this trading sweet spot, and how does it actually work? So you've got these two extremes, right? On one side, day traders are in and out of stocks within minutes or hours. On the total opposite end, you've got long-term investors who might hold on to a stock for years, sometimes even decades, just riding out all the big market ups and downs. Swing trading carves out its own awesome little niche right there in between them. So what's the core idea here? Well, to put it simply, swing trading is all about finding a stock that looks like it's ready to make a short-term move, holding on to it for maybe a few days or a couple of weeks, and then cashing in on that swing in price. And here's the key thing to remember.
Stocks almost never move in a perfect straight line. They zigzag up, they zigzag down. And those zigzags, those are the swings. A swing trader is trying to make money off of these smaller, much more frequent moves instead of waiting around for years for one giant trend to play out. Okay, so you get the what. Now let's talk about the how. We're going to walk through a simple 4-step game plan to get you started. All right, let's break this down. First up, keep it simple. Seriously, there are tons of super complex strategies out there, but jumping in too deep, too fast is a guaranteed way to get overwhelmed. Second, you want to swim with the current, not against it. If the whole market is moving up, you should be looking for trades that are also going up. It just increases your odds. Third, and this one's huge, be patient. You are going to have losses. Everybody does. The real trick is to not let it get to you and to just stick to your plan. And finally, before you even think about putting real money on the line, practice. Get a demo account and just get comfortable with the whole process without any of the risk. So, what does it actually take to get in the game? You might be surprised. On a lot of platforms, you can get started with around $5,000. All of a sudden, it feels a lot more doable, doesn't it? And this quote right here, this absolutely nails the single most important part of trading. It's not about being some kind of genius. It's about discipline. It's about having a plan and having the strength to stick to it no matter what. That's the real secret sauce. All right, time to gear up. Like any profession, trading has its own jargon, its own lingo. So in this next section, we're going to crack the code on some of the essential tools and terms that you absolutely have to know.
Whoa, okay, that's a lot of new words. But don't worry, you do not need to memorize all of this right now. To get started, you really just need to get the hang of a few key ideas. So let's just zoom in on the 3 most important ones: uptrends, downtrends, and candlesticks.
First up, an uptrend. It's pretty much exactly what it sounds like. The price of a stock is generally heading upwards. It keeps making higher highs and higher lows. That staircase analogy is perfect. Each step up is just a little bit higher than the last. This is the trend you want to be trading with. And of course, on the flip side, you've got a downtrend. This is when a stock's price is consistently making lower lows and lower highs. It's that falling staircase. And spotting a downtrend is just as important because it tells you when to stay away or maybe when it's time to get out of a trade. Finally, we have the candlestick. This is going to be your main tool. Each one of these little candles tells a story. It shows you the opening price, the closing price, the high, and the low for a specific time period. Once you learn to read the patterns these candles make, you can start to spot those perfect swing moments to get in and out of a trade. And hey, you don't have to do all this on your own. Trading software can basically be your co-pilot, scanning the market and flagging potential opportunities for you. It's a total game changer, especially if you're doing this part-time and you can't be glued to the charts all day. So we've got the concept, we've got the game plan, and we've got the lingo. But what does a day in the life of a swing trader actually look like? Well, this last section is all about putting those pieces together into a consistent daily routine. A swing trader's day really breaks down into 3 distinct phases. There's the work you do before the market opens, what you do while it's open, and how you wrap everything up after it closes. Let's take a look at each one. The pre-market period. Honestly, this might be the most important part of the day. This is where all the planning happens. This is your homework time. You're catching up on financial news, you're scanning for potential trades, you're building out a watch list of stocks that look interesting, and you're checking in on any trades you already have open. This is pure strategy. And this right here is a crucial rule. When that opening bell rings, the time for thinking is over. Your plan is already set. Market hours are for one thing and one thing only: execution. You're just putting the plan you already made into action. Now, once the market closes, the work isn't quite done yet. The after-hours phase is all about review. You look back at the trades you made, you figure out what worked and what didn't, and you log everything. This process of constantly reviewing and learning is how you get better over time. So, what's the bottom line here? Well, swing trading is a powerful middle path in the world of investing. And for a beginner, the formula for success is actually pretty simple. Have a clear plan, have the discipline to follow it, and stick to a consistent daily cycle. Plan your trade, execute your trade, and then review your results. So, I'll leave you with a question to think about. Now that you've seen the framework, a clear strategy, a manageable time frame, and a disciplined daily process, could swing trading be your way into the market? Thanks for joining me for this explainer. So you're thinking about jumping into swing trading. Awesome. In this explainer, we're going to break down the very first steps you need to take, and I'll show you why treating it like a real business right from the get-go is absolutely crucial for starting off on the right foot. All right, so you're ready to go, but where do you even start? It's a huge question, probably the biggest one for anyone new to this. So let's take that big, kind of overwhelming feeling and turn it into a clear step-by-step plan to get you into the trading world. Okay, first things first, you've got to choose your playground. I mean, which market are you actually going to trade in? And listen, this isn't just a random pick. It really boils down to two things: what you're interested in, and maybe most importantly, how much money you have to start with. You know, there are a ton of different things you can swing trade. The ones you hear about most are individual stocks, right? But you've also got ETFs. Those are exchange-traded funds, and they're cool because they track a whole bunch of stocks at once. And then, of course, there's currencies, crypto, and even some more advanced stuff like options. But, you know, maybe save those for later after you've got the hang of the basics. And this right here brings up a really important choice you have to make. See, if you're trading just one company's stock, you're exposed to what's called single event risk. Basically, one piece of bad news hits and boom, the price can just plummet. But with ETFs, you're spreading that risk out over a whole sector. So it's kind of like having a built-in cushion if one company takes a nosedive. All right, let's get to the big one, money. How much cash do you actually need to get started? This is, without a doubt, the question I hear most from beginners. And the truth is, the answer really depends on that playground you chose back in step one. But before we even throw out a single number, we need to get one thing straight. This is probably the most important rule in all of trading. Only, and I mean only, trade with money you are fully prepared to lose. Risk is just part of the game. It's not a maybe. It's a guarantee. So you've got to be okay with the idea that you might lose what you put in. So what's a realistic number to start with? Well, if you've got about $1,000, your best bet, and probably the safest option to get your feet wet, is the currency market. You probably know it as Forex. Now, what if you've really got your heart set on stocks? Okay, with $2,000, it's technically doable, but, and you really need to hear this, it's going to feel pretty restrictive. You'll be really limited in what stocks you can actually trade, which probably means those bigger, more stable companies are off the table for now. So if you want to trade stocks with more freedom, without those tight restrictions, you'll hear most experts say you really need a starting capital of at least $8,000. That just opens up the playing field and gives you a lot more flexibility and access to way more opportunities. No matter how much money you start with, you have to live and breathe the 1% rule. This is your survival guide. It's so simple. Never, ever risk more than 1% of your entire account on a single trade. Think about it. With a $1,000 account, that's just $10 on the line per trade. This rule is what's going to stop you from blowing up your account on a bad day. Okay, if you're really serious about this, you've got to start thinking like an entrepreneur. This is your new business. And just like any startup, you absolutely need the right tools to get the job done. And your number one tool? That's your broker. They're the ones who actually make the trades for you. So how do you pick a good one? Well, first, look for licensed brokers in your country. Check the reviews. Then, dig into their fees and the different accounts they offer. But here's the most important part. Test drive their platform. Use their simulator and make sure you actually like using it before you even think about putting real money in. Now, when you're setting up that account, you've got a really big decision to make. You can get a cash account, which is super simple. You just trade with the money you put in. Easy. Or you can get a margin account. This is where the broker lets you borrow money. It sounds great, right? It gives you way more trading power, but it also cranks up your risk to a whole new level. Seriously, this is not a decision to make on a whim.
All right, so you've picked your market, you've got your starting capital, you've even found a broker. You're ready to start making trades, right? Hold on. Not so fast. Before you put even one real dollar on the line, you have to practice. This is your training ground. It's where you build your skills, figure out what you're doing wrong, and the best part is, the mistakes are free. So how do you practice? Well, you've got two main options. The old school way is paper trading. Yeah, you literally write down your trades on paper. It's actually great for building a strategy, but it can feel a little slow. The other way is to use a broker's demo account or simulator. It feels more real, it's more engaging, but let me give you a heads up. A lot of those simulators are built to make trading seem way too easy. So if you're suddenly a trading genius in the demo, be a little suspicious. And this is basically what paper trading looks like.
It's pretty straightforward, right? You're just building a pretend portfolio. You jot down what you bought, what price you paid, and the total cost. Then you just watch it over time exactly like you would with a real account, and you get to see how your calls would have actually played out.
Now, if there's one thing you take away from all this practice, let it be this. Stop looking at the dollar price of a stock. It doesn't matter as much as you think. What matters is the percentage move. A 10% gain on a $12 stock is exactly the same as a 10% gain on a $60 stock. Getting that in your head, that's how you start thinking like a pro.
And while you're doing all this practice, remember, you're not just messing around with strategies. You are actively building a foundation of skills that every single successful trader needs to have. So think of this as your personal skill-building checklist. You're figuring out your niche, you're getting the hang of how to actually enter and exit trades, you're learning how to read those crazy charts, you're analyzing past data, and you're getting good at understanding what all the financial news actually means. Every single one of these is a must-have skill. But at the end of the day, all the practice in the world can only teach you so much. Simulators are great, but they can't prepare you for the one thing that drives the real market, human emotion. We're talking about greed, fear, and hope. And learning how to manage those in yourself, well, that's the final boss. It's the hardest skill of all. And that leaves us with one last really important question. You can become a master of the simulator. You can know all the strategies. You can read the charts like a book. But that's only half the battle. The real test, the real game, begins when it's your own money on the line, when your own emotions kick in. So the question is, are you really ready for that?
Have you ever thought of a successful swing trader not just as an investor, but as a master craftsman? You should, because like any expert, they need a well-stocked toolkit to really succeed. So today, we're going to pry open that toolbox and see exactly what's inside.
So, you're ready to trade, right? But hold on a second. Before you place that first trade, it's worth asking yourself, what's actually in your toolkit? And I'm not just talking about a computer and a Wi-Fi signal. We're talking about the complete setup, everything from the physical gear to your mental framework.
Okay, so here's how we're going to break it all down. Success really boils down to 3 key things. First up, we'll look at the tangible stuff, the gear. Then, we're going to move on to the intellectual strategy, your mental blueprint. And finally, we'll tackle what might be the most challenging part, building your emotional shield.
All right, let's dive right into part 1, building your workbench. These are the absolute essential physical and digital tools you've got to have in place before you even think about making a single trade.
First things first, let's talk about the machine you're trading on. Now, a laptop is super convenient, I get it, but believe it or not, the psychology here is so important. A desktop computer helps you create a dedicated, sacred workspace. It physically separates your trading life from your personal life, and that is absolutely crucial for staying focused and avoiding those silly, costly mistakes that happen when those lines get blurred.
Okay, next up, you need the raw materials, right? The actual stuff you're going to trade. We're talking about financial instruments. You've got your individual stocks, ETFs, crypto, currencies, the list goes on. So what's the common advice for someone just starting out? Well, a lot of pros will tell you to begin with individual stocks. They're a fantastic way to learn the fundamentals before you jump into anything more complex.
Now here's the good news. You don't have to go it alone. Think of your broker and your partner in trading. They're the ones who set up your account and actually execute your trades. The most crucial part here is doing your homework. Research their fees, check out their reputation, and make sure they're a good fit for swing traders. Seriously, don't skimp on this step. It's one of the most important partnerships you'll form.
And that broker, they're going to give you your digital workbench. We call it a trading platform. This is the software where all the magic happens. But here's the thing, not all platforms are created equal. Some are great for charting, others offer amazing research reports. This is exactly why demo accounts are a godsend. Use them to test drive the platform with fake money before you put any of your own cash on the line.
Okay, so we've got the gear all set up. But a craps person with great tools and no plan? That's not going to work. So now we need the blueprint. This is where we shift from physical tools to the intellectual habits and strategies that separate the pros from the amateurs.
I love this quote because it just hits the nail on the head. The more you research, the stronger a trader you will become. This gets to the very heart of trading. It's not a passive, set it and forget it kind of thing. It's a career that demands constant learning. The best traders I know spend the vast majority of their day just researching, analyzing, and staying plugged into the news.
It's a full-on daily commitment.
You know, to really understand the power of one specific mental tool, let me tell you a quick story. Meet Prince. He's in his second year of full-time trading. But for the last couple of months, man, he's been in a major slump, losing way more trades than he did when he was just a beginner.
So what went wrong? What changed? Well, to figure it out, Prince did something really smart. He went back and read his trading journal. And the answer was right there in his own handwriting. He'd stopped taking his morning walk to clear his head, and he'd started just skimming the news instead of doing a deep dive. He had given up the very habits that made him successful in the first place.
And that story right there, it shows you the real power of a trading journal. It's not just a diary for your trades. It is your single most important diagnostic tool. It lets you analyze your decisions, spot patterns in your own behavior, and actually see your growth over time. For Prince, it was the key that unlocked everything and got him back on track.
All right, we've got the gear, we've got the blueprint, now for the final piece of the puzzle. And honestly, it's probably the trickiest one to master. We're talking about the emotional shield. This is all about the psychology of trading and learning to control the one person who can mess up even the best strategy, you.
I mean, think about it. One of the big reasons the stock market crashed back in 1929 was just pure, raw emotional panic. People got scared, they sold everything at once, and that collective fear literally drove the market right off a cliff. It's a huge reminder that the biggest risk isn't the market. It's letting your own fear and greed take the wheel. And when you take a loss, and trust me, you will take losses, it's totally normal to go through something that looks a lot like the 5 stages of grief. You know, first there's denial. Oh, it'll turn around, it's fine. Then comes anger at the market or yourself. Then bargaining, right? Oh, if I can just break even, I promise I'll get out. Then maybe even depression. The key is to recognize these stages. Your goal is to get to acceptance as fast as possible, because that's where the real learning happens.
So that brings up a big question, right? How do we actually use this emotional shield? Well, it all comes down to learning from our mistakes. Look, mistakes are going to happen. It's part of the game. The real difference between a pro and an amateur is how they handle them. It's about taking the heat from those errors and forging new, stronger tools from them.
So let's just ask the question straight up. How do you reframe a loss? How do you take something that feels like a total failure and literally forge it into a tool that makes you a stronger, smarter trader tomorrow?
Okay, here's the playbook for that. The absolute key is to analyze, not agonize. Instead of beating yourself up, you have to consciously shift that little voice in your head. Stop asking, why was I so stupid? And start asking, okay, what can I learn from this? That simple change lets you pull a lesson out of the loss, helps you avoid making the same mistake again, and, this is crucial, it protects your confidence.
So, let's put it all together. What's in the complete swing trading toolkit? You've got your gear, that secure device, a broker you trust, and a platform that works for you. You've got your blueprint, that daily commitment to research and journaling. And you've got your shield, the emotional discipline to manage your fear and learn from every single trade, win or lose.
And there you have it. That's the whole shebang. The essential tools every single beginner swing trader needs to get started. So now the only question left is, you've seen the tools. Are you ready to get to work and build your craft? Welcome to The Explainer. So today we're going to tackle a really fascinating question. Can a classic tool for long-term investors actually be a secret weapon for short-term traders? We're going to break down how you can use fundamental analysis to find your next winning trade. Okay, let's just dive right in, because there's this huge debate in the trading world. Is it even worth your time to look at a company's financial health if you're only planning to hold a stock for a few weeks, maybe a couple of months? You know, a lot of traders think it's just overkill. But there's a really strong case that it's not just useful, it's absolutely essential. Before we go any further, let's just demystify what we're even talking about here. Forget the complicated spreadsheets and the accounting jargon for a minute. Fundamental analysis is really just common sense. I mean, think about it. You wouldn't just hand over your hard-earned cash to your cousin for their new business idea without asking a few questions, right? You'd want to know if they're making money, if they have a solid plan. Well, that's all this is. You're just applying that same logic to the stock market. So, this is where we get to the heart of the matter for swing traders. Do you really need to go as deep as someone like Warren Buffett who plans to hold a stock forever? Well, the short answer is no, of course not. But that doesn't mean you should just ignore it altogether.
A little bit of this kind of analysis can go a really, really long way.
And look, let's be super clear about this. If your trading style involves holding positions for weeks or maybe a couple of months, then getting a basic handle on the company's health can give you a massive edge. It's how you separate the truly solid opportunities from all the speculative noise out there.
All right, so why? Why does any of this looking at the company's books actually matter for a shorter-term trade? Well, it all comes down to one simple idea: following the big money. And this is the absolute core of the strategy. Think about it. You've got these huge investment firms, pension funds. They're managing billions of dollars. And they pour that money into companies with solid, healthy financials. That kind of massive cash infusion doesn't just create a one-day blip on the chart. It creates these long, sustained uptrends that can last for months. As a swing trader, your job isn't to start that trend. It's to spot it and ride that wave.
Okay, let's get into the practical stuff, your toolkit. And don't worry, you absolutely do not need an accounting degree for this. We're going to look at 4 really simple metrics you can check in just a few minutes that will give you a quick, powerful snapshot of a company's health. First up, we've got earnings per share, or EPS. And really, this is just the bottom line. It's a straight-up measure of profitability. It tells you exactly how much profit a company is making for every single share of its stock.
But here's the thing, the real magic here is in the comparison. You know, an EPS of $2 doesn't mean a whole lot by itself, but if you see company A has a steadily growing EPS and its biggest competitor's EPS is totally flat, well, now you have a crystal clear signal of who's winning in that market.
Next up, something you've probably heard of, the P/E ratio. This little number is all about putting a stock's price into context. It basically answers the question, okay, am I paying a fair price for this company's profits?
And this is how you can sniff out potential bargains. But, and this is a huge but, context is everything. A low PE for a boring utility company might be totally normal, but that same PE for a super fast-growing tech company could be an incredible deal. You always have to compare it to its direct competition.
Okay, so if the PE ratio tells us about now, the PEG ratio is kind of like our crystal ball. It takes that PE ratio and adds in a crucial new piece of information: future growth. It doesn't just ask if a stock is cheap today, it asks if it's cheap relative to how fast it's expected to grow.
And this is why it's perfect for us as swing traders. As a general rule of thumb, a PEG ratio under 1 can suggest that a stock might be undervalued, given its growth prospects. It helps you find companies that have a real fundamental reason to move higher over the exact 90 to 180-day time frame you care about.
And last on our quick scan list is the price-to-book ratio. The easiest way to think about this is, what's the company actually worth on paper? It compares the stock market's price tag to the company's actual net value on its financial statements.
Now, a low P to B can be a huge green flag, signaling a deeply undervalued company, if you're looking at the right kind of company, like a bank or a manufacturer with lots of physical assets. But for a software company whose main assets are just code and smart people, this metric isn't nearly as useful. Again, context is absolutely everything.
Okay, so we've got our tools. Now let's talk about how to use them to find those hidden gems, the opportunities that purely technical traders might be missing completely. This is where you can really develop an edge, just by digging one layer deeper than everyone else. Here's a great pro tip for you. Always, always take a quick look at the debt. If a company is piling on a ton of debt, that can be a major red flag. This is especially true if it's a company known for paying a nice dividend. The second investors start to think that dividend might be at risk because of high debt payments, they'll start selling. You want to be way ahead of that move, not caught in the middle of it.
All right, let's talk about something that trips up a lot of people: earnings calls. They create these massive price swings, right? But trying to trade them is often a lot more like a coin flip at a casino than it is strategic trading. Why? Because you're basically flying blind.
See, here's the trap you fall into. If you try to trade before the announcement, you're just guessing. It's pure speculation. But if you wait until after the numbers are out, the price often moves so violently and so fast that it's almost impossible for an individual trader to get a good entry. You end up missing the entire move. It's a classic catch-22.
But here is an absolutely brilliant counterintuitive play. And honestly, this might be the single best takeaway from this whole explainer. Instead of trying to gamble on the call itself, you look for a really good, profitable company that reports bad earnings. The key is to then do a little detective work and figure out why they were bad. If they miss their numbers because they made a huge one-time investment in new technology that's going to supercharge their future profits, well, the market's short-term panic just became your massive long-term opportunity. Okay, so let's tie this all together. Let's build your final checklist, a simple, actionable game plan you can literally use on your very next trade. This is how you put that fundamental edge to work.
So here it is, your 6-point checklist. When you're looking at a potential trade, you're going to ask yourself these 6 simple questions. Is its profitability growing? Are you getting a good value compared to its peers? Does it have strong potential for future growth? Are you spotting any red flags with its debt? And are you on the lookout for those unique opportunities hiding inside a bad earnings report? This is your quick scan guide.
And really, that's the whole game, isn't it? Using fundamental analysis as a swing trader isn't about becoming a certified accountant. It's about learning to read the story that the numbers are telling you. It's all about asking this one simple question to find an edge that other traders are completely missing. And that can make all the difference.
Welcome. Okay, so if you're just getting into trading, you know how it is. It feels like you're drowning in information, right? Well, today we're going to cut through all of that noise. We're going to talk about the psychology behind what actually works and show you a simple, powerful path that can really make all the difference. Let's dive in. And this right here, this quote really hits the nail on the head. This is the heart of the problem for so many people. There's this massive misconception that to win, you need some kind of super secret, really complex formula. But as we're about to find out, the truth is, well, it's the exact opposite. Exactly. It is so easy to fall into this trap. You've seen those trading setups that look like a NASA command center, right? Screens everywhere, a million charts, jargon you can't even pronounce. And you think, man, I guess I need all that to make it. But that whole intellectual chase can totally distract you from the real goal, which is just making smart, profitable decisions. So let's just establish the core idea for our entire conversation today. When it comes to trading, simplicity isn't just a nice idea, it's way more effective. Your goal isn't to be the smartest person with the most complicated charts. It's to have a crystal clear, simple process you can actually follow. Now, let's break this down because this is huge. On the left, you see what we think success looks like. You know, the Hollywood version, the crazy screens, dozens of indicators being glued to your desk 24/7. But look at the right side. That's the reality. Real success is all in your head. It's being flexible enough to change your mind, having the guts to admit you were wrong, and being disciplined enough to only focus on good information. Okay, so if simplicity is the key, how in the world do we actually do that? You can't just be simple. You need a system. So let's talk about how to build one using a framework that's been proven in the business world for decades. It's called the PDCA cycle. PDCA. It stands for plan, do, check, and act. It's just a super straightforward, logical loop for getting better over time. Instead of trading randomly, you create a plan, you go execute it, you review what happened, and then you act based on what you learned. It's this simple cycle that builds true discipline. First things first, the plan. And honestly, this is probably the biggest mindset shift you need to make. Trading is a business, period. You wouldn't open a restaurant without a business plan, would you? Of course not. The same thing applies here. Your goal is not to guess, it's to operate based on a well-thought-out, calculated plan. So, what actually goes into this plan? Well, here are the absolute must-haves. You have to decide in black and white how you'll get into a trade, how you'll get out, how you'll manage your money, and what your hard risk limits are. Things like how much to risk on a trade, what markets you're even allowed to trade, all of that needs to be decided before you put a single dollar on the line. Next up is do, and this is all about pure execution. Now, notice something really important here. The goal isn't make X amount of money. The goal is simply to be as disciplined as possible and only trade according to your plan. See, if your goal is just a dollar amount, you're going to start forcing trades that aren't there, and that is a recipe for disaster. And this leads us to what is easily one of the most powerful and most difficult skills a trader can ever learn. Sometimes, the most profitable move you can make is to do nothing at all. That itch to always be doing something is your enemy. It will chip away at your account. Learning to just sit on your hands when your plan says there's no signal, that's what the pros do. This slide just lays it out perfectly. It's the two paths. You have the disciplined trader who follows the plan and trusts the process. And then you have the impulsive trader who's chasing dollar signs, trading because they're bored, and letting fear and greed call the shots. The only question is, which one are you building the habits to become? And finally, we get to check and act. This is where you look back at your performance and learn from it. But there's a big, flashing warning sign here. Avoid the temptation to constantly tinker and add complexity. Don't start making your winning plan overly complicated. The goal is to make small, simple, logical adjustments, not to reinvent the wheel after every single trade. The whole magic of this PDCA cycle is that it keeps you simple. In the check and act phase, you're just asking what worked, what didn't. And then you make a simple choice. Should I adopt this change, get rid of it, or maybe test it again? You're slowly refining a clean process, not building some Frankenstein's monster of a strategy. So how do you actually check and act effectively? I mean, you can't just rely on your memory. That's a terrible idea. This brings us to what might be the single most powerful tool for any trader's growth, the trading journal. A trading journal is basically your personal trading history book. It's where you write down not just the numbers, but your thoughts, your reasoning, and what you were feeling. This is how you learn from your wins, and, maybe more importantly, how you learn from your losses. You know those moments where you just go, oh, what was I thinking? Your journal has the answer. So what should you be writing down? This is a great place to start. You need the basics, of course, like the date and the stock, but the real gold is in the why. Why did you get in? What signal did you see? Why did you get out? Did you move your stop loss when your plan said not to? Writing this stuff down forces you to be accountable to yourself and your strategy. Now, keeping the journal is step one, but step two is actually reviewing it. And this part is absolutely non-negotiable. You have to schedule time to sit down and take a cold, hard, brutally honest look at your decisions. This is where you find your patterns, your recurring mistakes, and see where your discipline really shines, or where it falls apart. I absolutely love this metaphor. It just perfectly captures what a journal is all about. It's not a chore, it's not just a boring logbook. It's the soil. It's where you plant the seeds of your experience and you nurture them until they grow into real, valuable lessons. All right, so let's pull all of this together. We've journeyed from getting stuck in that horrible complexity trap all the way to building a simple, repeatable system that can actually lead to success. And that really is the ultimate takeaway. Real, sustainable success in trading isn't found in some magic indicator or a top-secret algorithm. It's found in simple discipline, a clear plan you can actually stick to, and the kind of honest self-reflection that only a trading journal can give you. It's all about building your process. So, I'll leave you with this one question to really think about. After all this, what is the very first simple, non-negotiable rule that you are going to write down in your trading plan? Just start there. Start with one simple rule.
Money management. You know, for a lot of us, just hearing those two words can bring on a wave of stress. But what if I told you it doesn't have to be that complicated? Today, we're going to cut through all that noise and lay out a really simple, clear path from feeling anxious about your finances to feeling successful. Let's dive in.
I love this quote because it just flips the whole script, right? We're so used to thinking that managing money is all about restriction, a long list of things we can't buy or can't do. But the real goal, it's all about empowerment. It's about setting up your life so you can say yes to the things that truly matter to you.
So, here's our roadmap for today. We'll kick things off with the basics, then figure out exactly where you stand right now. After that, we'll get into the good stuff, the why, before laying out a super simple action plan. And finally, we'll look at a few common traps to watch out for. It's a straightforward journey, so let's get going.
Okay, first up, what are we even talking about when we say money management? It's a phrase that gets tossed around a ton, but what it really means is actually pretty powerful.
See, it's not just one thing. It's the whole shebang. It's a process. It's how you handle everything, from your morning coffee purchase all the way to your retirement investments. The idea is to create a system where all these little pieces work together to get you where you really want to go in life.
So, where do you begin? Well, before you can plan any kind of journey, you have to know where you're starting from. That means it's time to take a clear, honest financial snapshot. And listen, this isn't about judging yourself, it's just about gathering the facts.
Your financial snapshot basically has two key parts. On one side, you've got your assets. That's everything you own that has value, like the money in your bank accounts or your retirement funds. And on the other side, you have your liabilities. That's all the stuff you owe, from credit card debt to a car loan.
And this simple little formula brings us to the most important number in your snapshot, your net worth. You just subtract what you owe from what you own. This single number becomes your financial starting line. It's not a grade, it's just a baseline you can use to measure all your amazing progress from here on out.
Okay, so you've taken your snapshot, you've done the math, but you might be thinking, why go through all this trouble? What's the actual payoff? Let's talk about the rewards, because trust me, they're huge and they can totally change your life.
When you take control of your money, it means you can handle a surprise emergency without panicking. It means when a great investment or business idea comes your way, you're actually ready to jump on it. It can boost your credit score, which saves you thousands on loans. And maybe the most important one of all, it seriously reduces your stress, giving you this incredible peace of mind.
I mean, that all sounds great, doesn't it? So the million-dollar question is, how do you actually do it? How do you get from wherever you are right now to that place of financial confidence and calm?
This is where the rubber meets the road. We're going to get super practical and break it all down into a simple 4-step action plan. Think of these as the core skills, the foundation for really great money management.
First, you got to create a budget. That just gives you a clear picture of what's coming in versus what's going out. Second, track your spending. This is all about accountability, and you might be seriously surprised where your money is actually going. Third, set some clear goals. This gives your money a mission, a purpose. And fourth, build a savings habit. Make it automatic, just a non-negotiable part of your routine.
And hey, here's a little pro tip that makes a huge difference with that last step. Keep your savings in a separate account. Out of sight, out of mind. That simple barrier makes it so much easier to resist dipping into your savings for random stuff, helping you stay locked in on your big goals.
Okay, now that we have a solid plan, let's talk about what can go wrong. Being aware of these common pitfalls, these little tripwires, can be the very thing that keeps you on track while you're building all this positive momentum. All right, check this out. There is a hidden danger to your money, and it's called inflation. So let's say your savings account is earning you 1% interest, but inflation, the rate at which prices go up, is at 3%. Well, that means your money is actually losing 2% of its buying power every single year. It feels like you're saving, but you're actually falling behind.
And that leads us to 3 major traps. First is the safety trap, thinking your cash is perfectly safe in the bank, while inflation is secretly eating away at it. Then there's the inaction trap, being so scared of risk that you never invest, and you miss out on all that crucial growth. And finally, the concentration trap. That's putting all your eggs in one basket instead of spreading out your investments.
So, the main takeaway here is this. Managing your money well isn't a passive sport. It's not just about hoarding cash. The real goal, the game changer, is to put your money to work so that it starts growing and building your wealth for you.
And you know, the good news is you don't have to do this all by yourself with a pen and paper. There are so many incredible apps out there that can pretty much automate everything for you, from tracking your spending and remembering bills to setting up automatic investments. Technology can really be your best friend on this journey.
So let's end this right back where we started. Remember, money management isn't about saying no. It's about giving yourself the power to say yes to the life you really want. So, I'll leave you with this question to think about. What's the first big, important yes that you are going to start planning for today?
Welcome to The Explainer. Today, we're talking about the one thing in trading that isn't just important, it's literally everything. It is the razor-thin line between having a long, successful career and completely blowing up your account in a few weeks. And here's a spoiler. It has absolutely nothing to do with picking the perfect stock. It's all about survival.
So let's just dive right in with the big question, the one that honestly seems to trip up every single new trader.
You know, the answer is so simple, it's almost frustrating. And it is hands down the hardest lesson most people in the market ever learn. See, it's not that your strategy is bad, it's all about how you handle the risk inside that strategy. And this quote, man, it just hits the nail on the head. Think about it. You could have a trading system that's right 70% of the time, which is amazing. But if you let 1 or 2 of those losing trades get out of control, they can wipe out all your hard-earned wins and maybe even your entire account.
Okay, so if searching for that magical holy grail strategy is just a myth, what's the actual secret? What is the one skill that every single professional trader has absolutely mastered?
This is it, right here, risk management. And look, this isn't about being scared to lose. Losing is just a part of the game. It's a cost of doing business.
This is about making sure that when you do lose, your losses are small, they're controlled, and they are never, ever catastrophic.
And here's the big aha moment. You know, new traders are always looking for the perfect offense, that one strategy that never, ever loses. But the pros, they know this entire game is one with defense. It's all about protecting your capital, no matter what. So how do we actually do this, right? This isn't just some high-level theory. It's a very specific set of tools that you have to apply to every single trade you make. And I mean no exceptions. This is your emergency exit. It's the point you decide before you even get into a trade where you say, okay, I was wrong, and you get out. By setting it ahead of time, you rip emotion completely out of the decision.
And just as important, you have to know when to cash in your chips. A take-profit target stops greed from turning a beautiful winning trade back into a loser. You define your goal beforehand, and when you hit it, you stick to the plan.
Now this slide, I think this is so revealing because it shows you the huge difference in mindset. Amateurs, they just get mesmerized by how much they could make. Professionals, on the other hand, are absolutely obsessed with how much they stand to lose. This is just a perfect way to think about risk versus reward. I mean, would you seriously risk $1,000 just to make 100? No way! The risk is way bigger than the potential reward. But risking $1,000 to potentially make $2,000? Okay, now we're talking. That's a deal worth looking at because your potential upside is double your potential downside.
And here's what that looks like in the real world. Professionals almost never take a trade unless the potential reward is at least 2 or even better, 3 times greater than the amount they're risking. This is how you make sure that your wins are big enough to more than cover your small, controlled losses. It's simple math.
All right, so having the right tools, that's actually the easy part. The real battle, the true challenge, is the mental game. It's having the discipline to actually use those tools when your emotions are just screaming at you to do the exact opposite.
This number right here, the single number, is probably the most powerful rule in all of trading for protecting your account. It's like a mathematical shield that protects you from bad luck and, more importantly, protects you from yourself.
So let's break that down because this is so crucial. If you have a $10,000 account, this rule says the absolute most you can lose on one trade is $100. Period. Just think about that for a second. You could be wrong 10 times in a row, and you'd still have 90% of your starting capital. That's surviving to trade another day.
These right here, these are your personal commandments. They would keep your risk management plan from going off the rails. You have a plan, you have rules, and your only job is to execute that plan flawlessly. You don't get creative, you don't get emotional, you just follow the system.
And that brings us to the final piece of this puzzle. This is the one habit, the one tool that forces you to be accountable and turns every single trade, whether it's a win or a loss, into a powerful lesson.
Think of this as your own personal data analytics department. Seriously, it's not a diary to write down your feelings. It is an objective, cold, hard record of your trading performance. It's what shows you what's working, what isn't, and exactly where your discipline might be breaking down. By tracking these key details for every single trade, you create this incredible feedback loop. A journal doesn't lie. It's going to show you in black and white exactly why you're winning or losing. And that allows you to improve based on data, not just on guesswork. And really, that's the question you have to ask yourself. The difference between a professional trader and a gambler boils down to this one idea we've been talking about. Gamblers focus on the win, professionals focus on managing the risk. One is just a hope, the other, that's a business.
All right, let's jump right in. Today, we are getting to the heart of it all, the final, most critical lesson you'll find in pretty much any trading guide out there. This is that one piece of the puzzle that, honestly, separates the people who stick around from those who don't. So what is this ultimate secret?
So, yeah, what is this final lesson? I mean, after you've gone through all the charts, the patterns, the complex strategies, what is the one single thing that every guide really truly wants to leave you with? It's a fantastic question. And you know what? The answer isn't some secret formula. It's something much, much more fundamental.
But before we get to the good stuff, the how-to, we got to cover the stuff you can't skip. You got to think of this as the absolute foundation you build everything else on. Seriously, every single trading book has a section just like this, and it is there for a very, very good reason. Let's just call it the unskippable fine print.
I know. It is so tempting to just blow right past this part.
But that is a huge mistake. Don't think of these points as just some boring legal stuff. Think of them as your armor. The market doesn't give you any guarantees, right? And going in without a licensed pro is kind of like trying to fly blind. This isn't just a disclaimer, folks. It's your first and most important strategy for managing risk.
And this right here, this brings us to the core truth of the whole thing. Just let that sink in for a second. It doesn't matter if you're a day trader, a swing trader, or a long-term investor. You are taking a risk. There is always the potential to lose money. Now, acknowledging this isn't about being negative or pessimistic. It's about being realistic and, most importantly, being prepared.
Okay, with that essential foundation firmly in place, let's switch gears. Now we get to the fun part, the constructive part, building your very own personal trading blueprint. This is where you stop being just a passive learner and you start becoming an active strategist.
Now here it is, probably the simplest and yet the most powerful sentence in all of trading. Make a plan and stick to it. You know, for day traders especially, this isn't just some friendly suggestion. It's your lifeline. It is the one thing that will guide you when the market decides to just go completely haywire.
So how do you actually build this plan? Well, the source material lays it out perfectly. First, you have to know yourself. Are you a day trader, a swing trader? Your style changes everything. Next, choose your tools, your broker, your platform, the whole setup. And this one is crucial. Decide on your position size before you even think about entering a trade, not when things are getting emotional. And finally, don't try to be a jack of all trades. Just master a couple of core strategies. This preparation is what's going to save you when the market gets wild.
And this slide just perfectly illustrates the difference, doesn't it? With a plan, you've got clarity, you've got discipline, you've got preparation, you have a system. Without one, well, you're just running on emotion and chaos. The source uses this great phrase for it. You get lost in the weeds before you even realize it. And believe me, deviating from your plan is the fastest way to get there.
Okay, so we've covered the big warnings, and we've talked about why you absolutely need a blueprint. But there is one final essential key to all of this. It's the one single action that actually activates everything you've learned. It's the step that turns all this theory into reality.
So after all the reading, all the planning, all the preparation, what is the final instruction? What's the one thing that will actually finally make you a trader?
And there it is. The final secret isn't a secret at all. It's practice, practice, practice. I mean, you can read every single book, watch every video, but until you actually place a trade, you're not a trader. Knowledge gets you to the starting line for sure, but practice is what makes you run the race.
And let's be crystal clear here, the source is really emphatic about this. It's not one of the ways, it is the only way. You can read 100 books about how to swim, but you're only going to learn by actually getting in the water, right? It is exactly the same with trading. You have to get in there, learn your lessons, figure out how to separate your emotions from your actions, and just keep going.
So, we end on this final thought. You can have the perfect plan, the perfect blueprint. You can understand all the risks and master all the strategies. But the final lesson really just comes down to you. The plan? That's the easy part. The real question is this. After you've built that blueprint, do you have the discipline to follow it and to practice it day in and day out? Because that is what separates the wishful from the successful.